Another day, another round of Trump tariff boxing match. And this time we have a winner in the form of the Ontario Premier who stared him down and seemed to have walked away from this round with a win.
Absolutely. It's actually made Trump think that should I now take it back or what should I do, right? And I think clearly in this kind of a scenario, it's the moment you're fearing Trump, that's exactly what we were discussing earlier, that's when he would come to you. But the moment you go back to him, that's when he sits down, right? And he calms down. So, and the fears with regards to recession that we were talking about are again slowing down.
Yeah, so, I mean, I think that is, so the jury is out on that one, maybe, right, if you will. But yeah, it's certainly gripping the markets because the US markets didn't have a particularly great day despite the ceasefire conversation around Ukraine, Russia. Yeah. So that is a bit of a difficult one.
Yeah, but the ceasefire, so if you look at the timeline, the ceasefire conversation has come after US markets have perhaps closed for the night, which is why you'll see futures looking relatively okay. But if I talk you through how markets have closed, it's another weekday for US markets as tariff talk continues to spook investors. The Dow was down nearly 500 points, in fact. And look at what Trump is saying. This is a quote from him. He's saying markets are going to go up and they're going to go down. But you know what? We have to rebuild our country. So he's taking it in his stride. I mean, some theory is doing the rounds that they're preparing and they're okay with the recession because they know that this will bring down inflation. They want a cleanup at one go instead of kicking the can down the road. In fact, before I move ahead, let me just play out for you what he is saying on recession. Remember, that has been the big talk of the town. A day earlier in an interview, he said he can't really rule out a recession, and that was what led to the bleed on Wall Street. Listen in.
Your comments the other day not ruling out a potential recession seemed to rattle the stock markets. The Commerce Secretary said there wouldn't be one.
Boom. Just so you know.
Just specifically on the recession.
Yeah.
Do you think there will be a recession?
I don't see it at all. I think this country is going to boom. But as I said, I can do it the easy way or the hard way. The hard way to do it is exactly what I'm doing, but the results are going to be 20 times greater.
Mr. President, you asked...
And remember, Trump is always right.
And what do you say to Americans?
If you look at what I've said over the last 10 years, Trump has been right.
Trump is always right. Well, he got a taste of his own medicine when it came to Ontario. So here's what happened, and this is what we were referring to. Ontario decided to add 25% charge on electricity exported to the United States. In return, Trump responded by saying that he's raising tariffs on Canadian steel to 50%. Remember, 25% tariffs come into effect from today on Canadian steel and aluminum. Now, both sides, by the end of the day, took back that decision. But having said that, 25% steel and aluminum tariffs do kick in from midnight. So you're going to see that pressure coming in. Another important data set, because if you're going to talk about recession fears, every high frequency data is going to be seen very, very clearly. So the CPI data, that's the consumer inflation data which comes out today, is important. Estimates are that in February, for a monthly basis, inflation would have risen 0.3% and 2.9% for the year. So we'll have to wait and see what those numbers actually look like. But you did see Treasury yields rising ahead of that report. 10-year was at 4.27%. Oil has also rebounded from its lows. Brent has stayed below $70 mark. And perhaps in part because of what has been announced with Ukraine. So Ukraine and the Ukrainian Premier Zelensky has been meeting with Saudi Arabia. Saudi Arabia is actually the mediator in this case. The Americans are there and they have come to a conclusion that for now there will be a ceasefire. There is a deal on the table. The ball is now in Moscow's court. That deal has been taken to Putin. So that's where it comes. Or it stands as far as the Ukraine-Russia war is concerned. Let's look at Asia, though. A mixed opening for Asia. At least the opening rates were pretty mixed, continues to be, as this tariff uncertainty is reigning supreme. Let me pull up the India implied as well, just for a second for you to look at what we seem to be opening at. Yeah, just flat, but 9 points down. So not too much of a pain point there after a very, very tough day on the street yesterday as far as India is concerned. But let's get the global review. Steve Englander, global head of G10 FX Research and North America Macro Strategy at Standard Chartered Bank, joining us this morning. Steve, great to speak with you always. Thank you so much for your time. on a scale of 1 to 10, and let me phrase this question best I can. On a scale of 1 to 10, how serious do you think Trump is on actually going ahead with everything he's stating on tariffs?
If you put the emphasis on everything, I'd say 2.
Okay.
If you put the emphasis on some of it, I'd say 7 or 8. So, I don't think he's ever going to do everything he says. It would do a lot of damage to American industry, and I'm sure he's getting an earful from companies that trade with Canada and Mexico because production's very integrated. But I think that he intends to do something. And Europe is going to be the next target. Ultimately, India will be a target, but I don't think it's got the same priorities that Europe and Canada and Mexico and China have right now.
Okay, so having said that, just on the point of recession, because that's the big talk right now, various theories out there. One of the theories, and maybe that's a bit far out, is that the Trump administration is okay with some recessionary signs because they look at this as the great cleanup of the American economy. They're deep in debt. They don't want to kick the can down the road. They know that there's going to be short-term pain and they're okay with it. Do you think that's what's going on, or there's no real thought to what's going on?
I would say if only that was the logic and the hope. I think from their perspective that if there's a negative quarter in GDP in Q1, it's Biden's fault. And if they talk a little bearish in terms of the economy, and it turns out that the economy does better than expected, then they'll get the credit and they'll be fine. I don't think that they'll be as casual about talking about recession in Q2 and Q3. I think they're okay with kind of weakness in Q1 because they won't be carrying the can on that one.
Steve, good morning. Hiral on this side. To this, how do you see Fed responding to this? Do you think they will go ahead and increase rates again, threatening to slow economic growth? Or will it cut rates to stimulate growth? Because then it'll potentially allow inflation to then increase.
I think in the short term, they're going to be guided by what the economy is doing. We're not going to get stimulus from, fiscal policy and certainly not from trade policy. The fiscal, stimulus will likely come in Q2, probably late in Q3, maybe Q4. So if the economy looks soft, then it doesn't have to be a recession. It just has to be soft, and we expect inflation to turn down. There's nothing wrong with cutting, but I think they'll make it clear that, they're cutting because the economy is soft. But, if it turns out that there's inflationary pressures that emerge or that the economy looks like it's overheating, either on its own or because of fiscal stimulus, then they'll hike again. I don't think they'll be hung up on the idea that you can't cut for you can't cut today and take it back in 6 months. I think that they'll be perfectly fine with that.
Steve, good evening to you. The euro is now really wrapping up against the dollar. To your mind, which is the most important currency combination to look at? Because while the dollar index is also at 103.5, there is a lot of intercurrency permutations and combinations that might be more important. To your mind, what is it that you would watch out for the most?
Well, I think it's, euro is still the number 2 currency. And so you have to pay attention to it. It does have coattails for most other currencies. And you can see year to date that European currencies are the best performers globally, but everybody's kind of up. I mean, the rupee is a bit soft, but 9 out of 10 major currencies are kind of on the stronger side. But I think that the market recognizes that there's some very particular aspects to the euro, that the fiscal stimulus, the hopes of a ceasefire in the Ukraine, those are very euro specific. The rest of the world, I think, is looking at the U.S. economy. We always thought that the market was too optimistic on the U.S. for H1. Rates ramped up severely in Q4, the dollar went up, but there was no stimulus coming in Q1. so I think that this kind of soft patch is helping everyone else, and now the market expects, I believe, they have 3.5 cuts priced in. We think that's too much, but it tells you that they're paying attention to soft indicators in the U.S. economy. We don't think the U.S. is going into recession, by the way, but we think the economy will be soft enough for the Fed to cut twice.
Okay, Steve, we'll leave it at that. Thanks so much for taking the time out and being with us and giving us your thoughts. Have a great evening.
You too. Thank you so much. Be well.
Or maybe a great night. I'm not quite sure what's the time in New York right now, but yeah, thank you for staying up for us as well. But okay, this is interesting because, every day there are Trump, which is why we have a Trump tracker on the screen. Every day there is something or the other comes out from the Donald Trump side. One just wonders if geopolitics is ebbing or it is flowing, because the other piece that I also saw this morning is the Houthi rebels have said that, we are going to attack all of the Israeli ships because of the issues. So at one end, if geopolitics tends to come off, the other end, it tends to flare up as well. A lot of moving parts here.
A lot of moving parts. But what's interesting from what Steve was also mentioning when you spoke about the euro is, I think in a recent note, HSBC taking the entire Trump recession into consideration, Alistair, if I'm not mistaken, has gone ahead and upgraded Europe and downgraded US. So there is that movement of funds that's happening from US to Europe as well, probably. And that's where there is some bit of resilience coming in the European markets.
Okay, let's take a look at how the day was yesterday. Tough day.
Tough day. It was very interesting because a volatile session. And though seeing that volatility, there were probably in-betweens that we thought that we might see some bit of positivity, but we absolutely ended on a flat note. If you see, we recouped almost 183 points yesterday from the day's low. So that was a healthy comeback that we saw, and we ended nearly at the day's highest levels. Now, there was selective buying that was happening in heavyweights, and that's what helped recover the losses in yesterday's session. But what's interesting is what kept the traders cautious, and this was the mixed sectoral trend yesterday. Realty, financials, and metals, these were the sectors which posted gains, whereas absolute pressure in banking and IT. In fact, that's what kept the investors worried as well. The broader markets were also pretty interesting because it was a very divergent trend that we saw. You had the mid-cap index, which rose nearly over 0.5% in trade, whereas you had the small-cap index, which actually slipped into the negative territory, and the market breadth overall was absolutely weak. In terms of stocks, Sun Pharma, BPCL, Trent, ICICI Bank, and BEL, these were the top gainers, whereas the laggards on Nifty included IndusInd Bank, Infosys, Bajaj Finserv, Wipro, and a Tech Mahindra. So clearly, there is that sell on rise kind of strategy that is still prevalent, but from here on, that 22,500 is an important level we should be watching out for. Though we are below that, your GIFT Nifty today is indicating a 22,555.
Yeah, so that's the trade setup for the day today, viewers. The range bound trade continues. The good part is that even on a tough day for the global markets, there was resilience being seen in the Indian markets in yesterday's session, which to my mind was a big takeaway, really. And the way the Nifty IT perked up as well from the lows of the day. And if you just look at both the call and the put positions, it seems that the range is currently between 22,200 to 22,700. So broadly, that is what you watch out for. Even if we were to take out some key levels today, if we were to go higher, I think there is resistance at 22,700 that you need to keep in mind. And on the downside, 22,200, that range is becoming very important. And which is why yesterday when I was working out, there was a trader who came up to me and asked me for the opinion, and I said, okay, what are you guys doing? So he said, sir, I'm not going to war these days, so I'm fine. And I realized that now not doing anything is also such an important thing in these markets, right? Because you don't want to go out and lose your money. It's okay if you let go of 15, 20, 30, 40 days, 60 days of trading income. Yeah. It's fine, but don't lose money. And I think that statement stayed with me, that I'm not going to war and therefore I'm okay. Yeah. So that was very
capital preservation becomes important.
Yeah. Not doing anything is so important. People believe that they have to do something every single day. No, just sit out and don't do anything. Don't make mistakes. You don't lose capital, and that'll be important. Just one last thing. It was interesting to see the NSE launching the Nifty Chemicals Index. Now, at times, at times it's the winner's curse. An index stock comes into the Nifty, it doesn't do well in the next 1 month. I don't know if an index launch leads to this, but it was very interesting. We don't have any Nifty presence at the chemical stocks here.
Yeah.
A few stocks in the Nifty 100 as well. So it's not very large cap dominated index space per se, but could be interesting.
But there has been pressure in the third quarter anyways with regards to chemical space. So I think this is going to be an interesting parameter to watch out for from here on.
I love the way Neeraj has, put in that he's working out and his celebrity status. That people come up to you while you work out. So well done.
No, I mean, I live in a Gujarati stronghold. Everybody invests in the Gujarati culture in the markets.
So you're a star beyond your stronghold. But having said that, let's pick some of the winners, at least possible winners for you today, depending on how the markets react and what the mood is like. But I'm starting off with Tata Motors. So Tata Motors has gone ahead and met investors, and it's a thumbs up from my side on this investor meet. Their growth and cash flow has improved, and we've actually put some points out there. They have gone ahead and they've said they think there will be improvement as far as JLR is concerned. So that's important as far as Tata Motors is concerned. There's a Macquarie note which also has maintained an outperform with a target price of 826. They say growth and cash flow focus on JLR's margin upside will improve. So the big point is that to improve the JLR performance, Tata Motors has penciled in, an amount of 1.5 million Great Britain pounds. And where is that money going to come from becomes the question. But seeing how hammered the stock has been, Tata Motors is one that I would definitely look at. I also want to look at Keynes Tech for a second, because Keynes Tech is a thumbs down. So this is what's happened. SEBI has issued a show cause notice to the MD, Ramesh Kunikanan. They've alleged violations of structured digital database regarding financial results of Q4 FY23. The notice has alleged suspected violations in maintenance of the structured digital database, and this pertains, of course, to the March 31st, 2023 results. The company says they're currently reviewing the contents of the notice. So now, what is this structural digital database? Just going to take a second to explain that. SEBI requires key officials and management of any company to maintain their own database for information which is not put out on exchanges, but then has been reported or has come out into the public domain. So whenever that happens, they have to maintain their own digital database, and they have found that this, in SEBI's view, did not happen for the fourth quarter of 2023 as far as Keynes Tech is concerned. So this is something that Keynes Tech is saying they're coming back on, could be a sentimental downer for the stock for today. RVNL though is a thumbs up. They've emerged as the lowest bidder for 554 crore rupee project from NHAI. The order is on for the construction of a 6-lane access controlled connectivity to Visakhapatnam Port Road. So you might see some action there. And then of course Bharti Airtel is the other big story today. They've penned a deal with Elon Musk-owned Starlink, a move that could have major implications for the future of telecom in India. So Amit is joining in to explain more.
Well, yes, the opportunity is huge when it comes to this Airtel Starlink tie-up, but do remember that the tie-up is not exclusive to Airtel, so don't be surprised if Starlink comes up with a tie-up with other telecom operators as well. As speaking about the opportunity, yes, nearly 30% of the India's population currently do not have an full-fledged internet access. So it means that out of the 1.4 billion population of India, nearly 400 million users still do not have a full-fledged internet connection, and that could also be because of the lay of land that is there in India. Laying fiber cable becomes quite difficult in certain areas, and hence there is not a full-fledged internet connectivity, and Starlink could solve that problem for the country. Apart from that, going forward, Starlink could also start offering direct-to-cell services to Airtel subscribers, so that also comes out as a big opportunity for Starlink going forward. But the one binary factor on which the success of this product will be dependent is pricing, because India is a market with a rock bottom ARPU, that is the average revenue that a telecom operator generates from every user. Now, if you look at the cost of Starlink or OneWeb, which also offers similar services globally, for Starlink, the cheapest mobile and broadband plan starts at around $50, and for broadband, it's around $120 per month in the US market. Apart from that, for broadband users also have to incur hardware cost of nearly $349, which is an upfront payment that they need to make. Now, Starlink also offers services in various other emerging markets or developing countries also. In Nigeria, in fact, if you look at Starlink's cheapest broadband plan is offered at around $25 per month with a hardware cost of around $262 per month. One-time cost, that is hardware cost. But do remember that in Nigeria, the government has actually capped Starlink's offering, pricing of Starlink's offer that it is giving currently. Apart from that, if you look at OneWeb's cheapest broadband plan, it stands at around $395 per month. But in India, you get unlimited mobile and broadband plans at less than $3 and $5 per month. And moreover, there is no hardware cost that a user has to incur when it's installing broadband. So the success of this product or Starlink's product will be completely dependent on how they are pricing the product in the Indian market. If the prices are at current levels, then potential market for them could be the ultra HNI individual who might look to get this service. Apart from that, there could be some enterprises like healthcare and airlines or the defense sector might be interested in this product of Starlink. At this moment, what it means for Airtel, sentimentally positive, given the fact that this tie-up reduces the risk of competitive intensity increasing going forward, because OneWeb, which is a service offered by Bharti Airtel's promoters, also has a tie-up with Bharti Airtel, and with Starlink also tying up with Bharti Airtel, the competitive intensity for this product could be less going forward. On earnings side, the impact or the potential upside at this moment is largely nil as per various analysts.
All right, interesting. Sumit, thanks for putting that into perspective. And let's try and add more perspective to this with Sanjay Kapoor, former CEO of Bharti Airtel, joins us right now on the show to give us his verdict or two on this. Sanjay, good morning. Thank you so much for agreeing to talk to us this early in the morning. This is Neeraj here. Good talking to you. What do you make of this announcement and this tie-up, if you will?
So Neeraj, good morning to you and the viewers. Nothing surprising. We need to look at some cardinal rules of telecommunications. Walled garden doesn't work in telecommunications. It's all about interoperability. And over time, I think telecoms have demonstrated that how important it is to collaborate than only to be focused on competing. And if I take as that as the premise, then very clearly Airtel or anybody else is agnostic as a telecom service provider to technology. Whosoever gets the best technology, if it's 5G today, it will be 6G tomorrow, or it's satellite telecommunications, they will be open to any technology that comes in. Now, whether it's Starlink or it's OneWeb, I think the winner and the jury is still out. And therefore, I think it is just prudent for them to collaborate with all of them. For me, the services from satellite service providers will complement the services of the TSPs. I don't think they will supplement them. Because these are those areas which are not covered. Not covered either because of viability and commercial returns, or because the terrains are really, really tough and it doesn't make any sense. So if that is true, then of course, like what you stated in your commentary, we have to see that more expensive services going out in the wilderness, will there be takers at those prices? But if you look at Airtel's announcement, they have said they want to focus on the B2B offerings. And I think that's more sensible, because even if they are in the remotest part of the country, they'll be funded by somebody, either the defense or the government or some offshore drilling or some, large corporate that has got some minerals to be dug out, or, something else that's far-fetched. So considering that, B2B is better. Now, selling these goods out of their stores or their CPs out of their stores, I think makes a lot of sense. That gives an oversight to Airtel on how the services are moving, how are they selling, how are they penetrating, and therefore they can control their destiny much finer. If they let them loose, then they're guessing a lot of things. I think this gives them a better control. So for now, what the consumer experience will be and what the price equation will determine how far these services will go. But there's no harm at this stage to go ahead and sign up. And finally, all these services have to cross the hurdles of regulation in our country. It's a shared spectrum. It's not a dedicated spectrum. How the spectrum will be priced, those rules are still not firmed up. How will lawful interception happen? How will they be charged, even if it's not auction and it's, say some sort of an administrative charge. So I think those things have to be determined. And, you rightly said, India is not a country where too many people can pay you $20 or $25 in the wilderness. And if there are some corporates who can pay, that will be for a very limited use. So I think right now it's very experimental. Everybody is speculating. It's a good move from Airtel. I would have done the same thing if I was there. And let's see what happens.
Sanjay, interesting point where you made about the regulatory part of it. So operating within the industry as well earlier, what are the kind of timelines we should be watching out for as to when they will secure the necessary authorizations? And secondly, clearly, as you mentioned with OneWeb, and they coming up with a partnership with Starlink, this is going to be clearly strengthening their position to cover the underserved areas as well. So becomes absolutely important in terms of the target they are able to achieve. But clearly, what's the timeline?
So I think as far as the readiness of the technologies are, I've just returned from the Mobile World Congress in Barcelona, and a lot of debate around these technologies as well. I think as far as these technologies are concerned, they are ready to be brought into the country and go commercial because, Starlink, as you know, in African countries is already serving many customers. So they can come to India as well. I think it is all sitting with the licensors and the regulators to provide a clear guidance and when they can come in. But I think if we really want to serve the unserved, then give them at least a fair chance to complement the terrestrial service providers, then it should be sooner than later. I mean, I think to delay it further down than this calendar year, we'll be doing this service to ourselves. When the world is moving to these new technologies, why would India be laggards? So I think the regulators and the licensors should try that they clear all the risk away and get them sooner than later, not later than the end of this financial year to go commercial, because there'll be some trials that they will be doing. They'll be setting up their operations here. So I think sooner the better.
Hi, good morning. Tamanna here. An absolute pleasure speaking with you. Just wondering what you make of the impact on the other large competitor. What does this mean for Jio and the whole fight in that space? Because there was a whole host of domestic players who came out and said, no, don't let Starlink come in.
So yes, every time a new entrant with a new technology comes in, it creates the fear of the uncertain and uncertainty, and I think that's what is keeping them away. I do not believe personally, having spent decades in this industry, that the satellite service providers can displace the terrestrial service providers. That ain't happening. Right, just the customer experience and the economics wouldn't allow the satellite guys to come in and take over. But I think that it's that fear of the uncertain, which keeps people a little defensive. And as you know, this deal with Airtel is not exclusive. I'll be very surprised if tomorrow Jio will not sign up for this as well. And Jio will not sign up with OneWeb. They are open to sign up with any one of these. These companies who are satellite service providers will not survive in a walled garden environment. So I think they're open. They will collaborate with everybody. They'll sign up with everybody. Jio is probably waiting and watching. And generally, we have seen that though Airtel is number 2, they are generally the first ones to take moves on many initiatives. And therefore, they've gone ahead and done it. But I don't think Jio will be overly worried about getting displaced by any of this.
No, I mean the question also because of the extent of protest which came in when Elon Musk first said he wants to bring Starlink to India. But yes, here he is one way or the other, whether it's through Starlink or whether it's through Tesla. Thank you so much, Sanjay Kapoor, for speaking with us. Always a pleasure. And we'll take a very short break. We're just talking about Elon Musk. He's ensuring, that more and more people have his Tesla, including Trump. Look at this footage from about an hour ago outside the White House. Elon Musk getting Trump to pick the Tesla he wants. He seemed to have picked the red one. Trump has also said that anyone attacking Tesla showrooms, we'll stick to the original footage, please. Anyone attacking the Tesla showrooms will be deemed as a terrorist act. A lot of interesting things going on right now. We'll take a very short break. On the other side, we come back with what your top calls should be for the day.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back. You're watching India Market Open. Clearly, if you see in terms of implied open, 22,555, that's the number that we have been tracking. Slightly above that, a 0.2% up move is what is indicated so far. But moving on, if you see in terms of the stocks that are on my radar today, two of the IT majors, you have Infosys. Why Infosys is interesting, where Neeraj, I'm sure, will be taking you through the entire report as well. But you have a Morgan Stanley which has downgraded Infosys to an equal weight from an overweight, and they've cut the target price. Now, the ADR in overnight trade actually saw cuts to the tune of around 4%. Ended almost 2.5% lower, and I think, if I'm not mistaken, this is the first downgrade from a Morgan Stanley to an Infosys in the last 4 years. So there could be some pressure that could be building in on this one as well. On the other side, we have a TCS which will be in focus as well. They will be acquiring Darshita Southern India, and this is for around 2,250 odd crores. The acquisition to acquire the company by using call option to buy at least 100% stake in the entity after 2 years. They will be acquiring the land and building held by the entity as well, and that will be serving as a delivery center. So that's a thumbs up with regards to where TCS goes. And very lastly, you have Zydus Life Science that will be in focus. They've made an announcement with regards to the 85.6% acquisition. And clearly, this did come just during the close with regards to market hours. But after the con call, what they've come out and said is that they have been working on the medtech segment over the last couple of years. And medtech can be for India what pharma was 30 years back. So that's where they are seeing a lot of opportunity coming in on this front. The proposed acquisition is a platform to execute global medtech strategy, and the company will focus on expanding its footprint in the global markets as well. So a thumbs up coming in with regards to Zydus as well, Neeraj.
Yep. Also watch out for Adani Enterprises because the real estate business housed there, and the group has bagged the 36,000 crore housing project in Mumbai, and this becomes very large because in Mumbai now with the Dharaviri development and 36,000 crore another project, they're large. Now of course anything would get dwarfed in front of what Dharaviri development would be per se, but 36,000 crores is a large project. So do watch out for Adani Enterprises. It's a thumbs up. Standard disclaimer, of course, the Adani Group owns NDTV and you're watching NDTV Profit. CG Power, given a thumbs up because it's won an order for supply of servicing of railway products. It's the first phase of the order value is 450 crores. So therefore my takeaway from this is that one, yes, it's an order win, but it's only the first phase, and therefore more orders in this particular piece might come through for CG Power. So keep an eye out for that as well. Thumbs up on that. Let's see how it does today. And while the IT index may have recovered yesterday, Morgan Stanley's come out with a note, and we'll talk about it in detail later on, but it's effectively downgraded or cut target prices on most stocks. So they say they see downside risks emerging for revenue growth as well as the valuation multiples for the IT space. The key trades according to Morgan Stanley: TCS over Infosys, Tech Mahindra over HCL Tech, Coforge over Emphasis. So very interesting. Interestingly on Infosys, maybe Hiral you marked, but the fact that S. Shibulal has bought about 30 lakh shares. Interesting development. Okay, let's get in our guest then to try and understand what to do in a market like this. Sudeep Shah of SBI Cap Securities on the derivatives and the technicals, and Meuresh Joshi of MarketSmith India on the fundamentals. Gentlemen, both of you, thank you so much for taking the time out and being with us. Sudeep, how are you viewing trade? Because it did seem like yesterday was a day of resilience relative to global markets, but that doesn't mean that we'll go up. We may be resilient by falling less as well. Do you believe there can be upsides on the indices? And are you therefore trading that way on the Nifty or the Nifty Bank?
Morning, Neeraj. Neeraj, I agree with both the points that you have made. Firstly, we can attempt to move higher also, and we even will be resilient with respect in comparison to the S&P 500 also. Now, before we move on to the Nifty, it's just a small piece of analysis that we have done yesterday within the SBI Securities research team here. That what we have seen is that when we had plotted Nifty with respect to the S&P 500 on a ratio chart, this is after at least 3 to 4 weeks of time we have seen the first signs of outperformance in favor of Nifty, whether it is on a daily chart, whether it is on a weekly chart. So we feel from here on, there might be an occasion that we would see this in the light of that whether even if the US is faring badly, we will fare less bad than them, and first signs of a revival in US, we might outperform them. So keeping that in mind, I feel 22,300, 22,350 zone will now act as an important support. Till the time indices are holding well above this zone of 22,300, there could be a gush around 22,750 and 22,900. And this is a positional view, just not for a day or two. But I feel this could be the trend for the coming few days.
Okay. What are your picks this morning, Sudeep?
See, the first pick is Macrotech developers. Now here, what we've seen is there is some kind of a double bottom formation that is happening on the charts. And yesterday, as well as day before yesterday, we have seen a lot of these real estate names starting to show some signs of a recovery. So I feel Macrotech developers from here could be bought with a stop loss of somewhere around 1100. And on the upside, the targets could be 1180 and 1200 in the few coming sessions. The second stock that we like is Phoenix Mills. Now here also, if you see the daily and the weekly chart put together, the stock was in a decent uptrend between October 2023 and July 24, and then thereafter it has slid into a period of consolidation. Unlike all other mid caps, even quality mid caps, where we have seen cuts of 35, 40, 45%, this stock is still around in the vicinity of 15 to 20% from its all-time highs. So in a way, it is displaying some kind of an outperformance here. And yesterday we have seen a decent buying support for decent buying from the lower support zone. So this could be bought with a stop loss of 1600 on the downside, and the first target here could be 1740 followed by 1800 in the coming few weeks.
Okay, just very quickly, Mayuresh, the key question I want to ask you is about this Starlink entry. Does everything, all things being equal, then get neutralized in that sense? Because yesterday Airtel announced that it has a partnership with Starlink. Jio has just announced they have a partnership with Starlink. So I'm going off the bat on that, which is the big thought over here. Both of these companies, RIL as well as Airtel, have been under pressure with the Starlink threat, but they've decided to now join forces. Does that neutralize any concern of what Starlink will come to India and do to their market shares?
Morning, Taman. I think two aspects here. One, obviously, in terms of the ultimate fee that is going to get levied as far as the spectrum communication auction is concerned, or spectrum communication fee itself. I think what is the fee that TRAI fixes? That is something to be watched out for. Second, I think in terms of the macro broadband size itself, from an enterprise perspective, a rough estimate is anywhere between 280 to 320 million households that are unserved at this juncture, and therefore there is a huge market opportunity that probably exists. Let's also consider the fact that a large part of this opportunity is in rural areas, where sensitivity to price is going to be an extremely critical issue. If you probably look at the cost structure itself, a standard equipment cost that Starlink probably proposes on their sites for residential purposes is anywhere between $349 to around $599 itself. So how are Airtel and Jio probably going to utilize this, specifically in districts and talukas that they're going to probably give these services, and at what price points are they going to offer, is going to be very, very critical. The second aspect itself is from a penetration perspective. It's 13% in terms of the wired broadband or the fixed broadband penetration that we've seen. Obviously, I think Airtel and other operators, including Jio, haven't used air fiber. So how are they going to leverage this aspect is going to be extremely critical as well. And therefore, I think, yes, it does bring in neutrality as far as both these players are concerned. But how is pricing going to happen and all the facets related to this? I think that's what the street will probably be looking at going forward.
Absolutely. Thanks, Mayuresh, for it. And taking the pricing into consideration does not seem to be a mass product, at least in the beginning. Could be for a niche who could afford it, taking into consideration the current pricing structure, what we've been hearing here and there. But overall, Bharti Airtel and Reliance, both these stocks will be in focus. Now, moving on, with the recent sell-off that has pushed several stocks way below their lowest targets, and these stocks, by the way, have a pretty good amount of analyst coverage. The question from here on is, what we are asking is, do analysts actually need to go ahead and rework their target prices on these counters? Mika joins us with the entire list. Mika, over to you.
So yes, the key question we're asking is, do analysts need to rework their targets, or could we see potential upgrades on the cards? Now the criteria is most analyst coverage. So out of the entire Indian stock market, there are 309 Indian stocks that are currently covered by over 10 analysts, and that's our key criteria. And when you talk about this, 101 stocks are currently trading even below their lowest target. Let's not take consideration the consensus target. Now in terms of the difference from their lowest target, the top is Sunteck Realty, consensus target at 705, lowest target at 625, current market price at 387. The difference from the lowest target is 38%. Same thing with Sonata Software, it's a 27% difference, and from something like a Dhanuka Agritech, it's 27%, and all of these companies have at least 11 to 13 analysts actively tracking the stock. We also have three more, something like an REC, Moltech Packaging and Samani Ceramics, which have a 22 to 25% difference from even their lowest target. And some of these stocks have 12 to 22 analysts tracking the stock. Now, just looking at the counters with the highest difference from lowest target, we've taken the top 5. Suntech Realty, well, why analysts are bullish, well, there's a steady progress across projects and a sustained portfolio expansion. The company is now debt-free and net cash positive as of Q3. Some key concerns is the exposure to the single MMR market and regulatory partnerships as well as macro risk. For something like a Sonata Software, well, the bullish stance stands on because of the strong order book and AI deals, traction in healthcare, banking and finance, which is expected to continue. But the key concerns, well, management has guided for a fall in revenue in Q4 of FY25 and issues with tech, media and telecom clients is why the near-term pressure could be seen. For something like a Dhanuka Agritech, a satellite business model is fueled by a strong launch pipeline and the healthy volume growth seen by the company even in a tough environment. But the key concern is management has lowered their revenue and EBITDA guidance for FY25 and they have issues with scaling up the technical plant. For something like an REC, well, steady AUM growth and profitability growth, and analysts are also seeing lower credit risk and strong return on equities. However, the key concerns rise in the increase in the competitive industry as well as soft power demand that we've seen since August of 2024. And lastly, something with the Moltech Packaging, well, the bullish stance lands because volumes are expected to be aided by timely capacity additions and the company is also entering into high value products. Well, the key concerns are elevated costs and lower volumes in the past and struggling paint segments as well as a cut in growth guidance by the management itself.
Very interesting piece, so then 2 questions from here. Will analysts have to rework their target prices, and were the target prices well thought of in the first place? I think both things in that sense come into place as well. What is the basis of those target prices and do they hold up in terms of uncertainties? Okay, one can argue that who knows what Trump is going to do, but having said that, then maybe your fundamental reasons for those target prices are a little shaky.
Yeah, and therefore, of course, begs to warrant how much of the target upside do you believe in the first place.
Correct.
But yeah, I mean, sometimes just take the rationale as opposed to anything else and ignore the target prices when you're looking at a report, Tamanna. Maybe that's the best way to approach it in these times.
Yeah, tough time. Mayuresh, I wonder if you have a take on this. And, I'll get to you on real estate and some of the other sectors that are buzzing. But just on the piece that we've done, and very detailed piece there from Mihika. A question at tough times, in lowering tides, that is when most stuff gets exposed. That's when the question comes at what are analysts really looking at?
Absolutely, Tamanna. So I think what really transpires is that when a market probably goes into a correction phase like we have in the past, I think the correction has been brutal. And therefore, I think a large part of the broader market universe where earnings might not catch up in terms of analyst estimates and expectations as well, compared to their own historical averages, because it's impossible for a company to probably just compound its earnings year after year, specifically looking at cyclical trends, regulatory changes or otherwise, which probably might affect earnings. You might have to draw down your earnings 2 years forward. And therefore, I think as the derating probably happens, your price targets definitely reduced. But I've never really understood the fact, Tamanna, for a lot of these broking houses where target prices gets reduced marginally, and then the downgrade from an overweight to an equal weight status happens, where earnings are going to come off significantly. I think risk management is something which should be at the forefront. And therefore, I think from an even price recovery perspective, even if the targets are maintained close to the earlier levels, for a stock to recover from the falls that it has, say a stock is corrected 50%, it needs to have a full reversal, which is a 100% reversal to get back to the target price, which probably might be improbable in a few cases if time consolidation in the market continues.
Right, so that's going to be an interesting aspect that we need to consider as well, whether we should look at the rationale or the target price. But let's look at IT. The sector is in focus. Yesterday, we did see a good rebound. You have a Morgan Stanley, which has gone ahead and reduced target prices across. Sudeep, what are charts indicating? Because clearly, you are seeing some bit of pressure, at least in terms of the Infosys ADR goes. What would your call be if you have to look at IT?
If you have a look at the IT index, whether on a daily basis or on a weekly basis, I guess the writing was on the wall a week back only when the IT index slipped below 39,000, 39,200 levels, where it tried to held See, even in August 2024, there was this moment where there was some kind of a downfall which started in IT, but that was an important support zone. And this time around, also this was getting held, but below this there was a free fall. And we feel that even though yesterday the index has held out, we still feel that it's time before we see a major reversal. And below 36,900, 37,000, the index can continue its downward momentum up to 36,000, 35,800. So 36,900, 37,000 on the downside will be an important support. The reversal trade would play out only if IT index now manages to cross and sustain above 37,800, 37,900. So it's in a consolidation range with a negative bias, and I feel every day there's a lot of these news regarding downgrades and Trump comments and US markets, Nasdaq falling. So it's not going well with the IT index, and I feel one should wait and watch before taking major exposure into the IT stocks.
Right, so that's with regards to overall IT as a segment goes. Mayuresh, your view with regards to IT, seeing the way it has performed so far and the kind of order bookings that we are watching out for, your Oracle also which reported numbers yesterday, what would you advise investors to do?
I think, Hiral, morning to you. I think wait and watch. I think wait for the numbers to come through. I think matter of 3 or 4 weeks when the Q4 numbers will be out for the sector as a whole. The second aspect, obviously, is that in terms of the legacy network or the legacy services that IT companies are probably following, obviously, a lot has happened over the last few quarters. What you're seeing in terms of innovation, Chinese companies like a DeepSeek are going to change the evolution of how the sector is probably looked at. And therefore, I think AI, Gen AI, I think our companies need to ramp this up pretty aggressively and pretty innovatively as well, if I have to say. And therefore, I think the kind of work that they're doing as outsourcers for global companies have to be more innovative in these aspects, which will give value addition, which will give that margin expansion criteria that the industry or the analysts are probably looking at. Obviously, I think news like a Cognizant deferring its salary hikes, along with what Trump is doing, as Sudeep mentioned, what will happen to discretionary client budgets, whether they are held up in the manner that one are foreseeing, whether there are no pricing issues coming through, that puts additional pressure in terms of EBIT margins reported. I think all these aspects are getting played out. So in our opinion and how we see it at Markets with India, I think when in a wait and watch mode, we'll watch out for Q4 numbers and take a call on this.
Wait and watch mode. I'm wondering if you look at any kind of improvement in BFSI. The story that we're going to get into a bit of detail in a bit is, of course, IndusInd Bank, big story yesterday, ended about 27% down. The management, the promoters tried to calm the fire by making a lot of positive statements everywhere. It doesn't quite seem to have worked. Mayuresh, I'm sure you heard what the management had to say. You've tracked the story, and we're, of course, going to be posing our 7 questions to IndusInd Bank because they just don't want to talk to us and answer our questions. That's fine. But do you think that there is any kind of confidence coming in the street with what we know in the public domain so far on IndusInd Bank?
Very unlikely, Tamanna. I think the entire industry is based on trust. I think that's the foremost point. And therefore, I think if there have been legacy issues that have been plaguing the bank, and it's not just this issue, I think there have been past issues as well. That is going to create some element of a detrimental effect as far as the overall structure is concerned. Second, I think the questions that are now getting raised, were these lapses or is this a corporate governance issue? I think so that is the biggest issue that the bank probably has to deal with. And let's not forget, I think, in terms of the overall book structure itself, even if it's cheaply valued at this juncture, does it give confidence to depositors? Does it give confidence to the guys who are trading or tracking this bank as well, and probably ensuring banking services are taken into account? I received 3 calls, Tamanna, very frankly, that should I keep deposits in IndusInd Bank? I mean, that is how serious I think the issue is probably getting into. And therefore, I think the trust factor will probably play out on this bank. And serious questions that have been levied, I think the management should be answering this as soon as possible.
All right. Now stay with us, Mayuresh and Sudeep. And this is, something we want to take up. So what has happened with IndusInd Bank in the last 24 hours is very, very important. Can this really be cooled off and covered up with a few statements from the promoter, from the MD CEO saying all is well, nothing to look here. Please, carry on. It's business as usual. And that's exactly what we're asking. Vishwanath Nair joining us and our banking editor. Vishy, you have been speaking to all stakeholders in this story. We've been getting into the depths of it. And to be fair, we have requested the management to come and speak to us. We've requested the promoters to speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it. So then let's put it to our viewers as well. This is what we aim to ask IndusInd Bank if they come, because these are the questions that really need to be answered.
That's right, Tamana. So 7 key questions, right? And it's very easy to just wave your hand and say that, this is not really relevant, but the fact is that it is, and you're seeing that in the stock. You've seen how people have reacted to the clarifications that the bank has provided. That is because the clarifications actually leave too many questions unanswered. The first of which is this so-called internal leg of the transaction of the foreign currency borrowing conversions. Why were they not marked to market all through the entire period that you were holding them? According to the bank, this is common practice, and then it converges later on by the end of that contract, but that does not make sense, because that is the core of any accounting practice. The second question, and before that I just want to show a quote that is being displayed on the screen right now. The bank's annual report very clearly says that we are required to mark to market this swap cost. This is something that is a specified practice. And if that is the case, if that was required to do by the bank, why did they not do it? And if they are claiming that they did do it, then what is the reason behind such a big sort of hit on the balance sheet to 1,500, 2,000 crore, very wide range of numbers? But there seems to be no explanation why, if you were following the practices, why you still have to account for such a large gap on your balance sheet. The third question is, what were the internal and external auditors actually doing in this entire process? These auditors have to regularly look at the bank's existing portfolio, their positions, and then account for them. This is common accounting practice that is followed by all banks in the ecosystem. IndusInd Bank somehow has missed this entire 2,000 crore gap. I was talking to one of the bankers who said that the 4th decimal point in a number was actually throwing off the balance sheet by about 3 odd crores, and the entire accounting had to stop to try and figure out how this happened. This is the story of a foreign bank that is currently working in India. How is it that 2,000 crore goes unnoticed by all of these auditors? The fourth important question then is whether the bank was misstating its treasury and trading income as part of its quarterly results announcements. Because if you were over accounting for numbers in the past and now you have to adjust for that, that means that the previous numbers all will have to be restated. At least for the 3 quarters of this financial year, they will have to be restated. The fifth important question then is, if the so-called RBI guidelines were coming in effect from April 2024, the bank has gone out and found out these gaps only in October of 2024. For 6 months, you had no idea that this guideline exists, and I am not in compliance with those guidelines. Then the sixth question that we want to ask the management is whether the regulator in its communication is making it clear that the CEO of the bank has to go and a new CEO has to be appointed. Now, the CEO is saying that I was just placing some conjecture into reading into how the RBI is thinking, and I believe that the RBI is uncomfortable with me. But I don't believe that the RBI communicates this way. It tells you exactly what it needs. Yeah. And the last question here is whether the RBI will have to tighten processes across the banking system, specifically IndusInd Bank.
Yeah, but that question then to the RBI. Yeah. Question to IndusInd Bank is, how did you not know? Another question that I want to add is what Harsh has got to the fore. It has come to light that IndusInd Bank's CEO and deputy CEO sold 80% of their own holdings near the peak. Considering the admission of accounting discrepancies that came in recently, this stake sale raises many questions. Harsh, give us more details.
So Tamanna, they've sold this right at the peak in June of 2024. Mind you, this is at a time when IndusInd Bank has come out as part of its Q1 FY25 numbers and suggested a slowdown in microfinance. They've called it and they've said that there will be a recovery starting Q2. But Q2, the asset quality cycle just got worse. So the timing of this is just extremely questionable because they've sold at the 52-week high and or near the 52-week high. The 52-week high was at 1,567 rupees a share. The CEO, Sumant Katpalia, sold 80% of his holding, which, by the way, was given to him in ESOPs at 518 rupees per share. So he's made quite a large number in terms of profit on this one. He sold 28 crore worth of shares. His annual compensation is roughly 7.5 crore. And the deputy CEO has sold 32 crore worth of shares at 1,499 rupees a piece. And his annual compensation is 5 crore rupees. And therefore, they've made significantly large numbers in terms of amounts from these share sales near peaks. And that's where the big question comes in.
A lot of food for thought here, and especially why the two top guys were selling at their peak, then in hindsight saying we didn't know this was happening. Something doesn't fit right here. Once again, we welcome IndusInd Bank. Come and speak to us. We want these questions answered. We want transparency from your side. We want to give you a fair chance to answer all of our questions. We hope you do that. We'll take a very short break. We're coming right back with the pre-open rates. Stay tuned.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction
Welcome back. You're watching India Market Open. Let me also welcome in Chandan Taparia, Head Technical and Derivative Research at Motilal Oswal. Chandan, good morning and welcome to the show. What's the setup for you looking like currently? Because everyone's been watching out for 22,500, but that's something which the markets are not able to sustain. The moment you cross that, you are seeing a sell on rise kind of a strategy that's coming in. What should be the levels one should be tracking, and what would your strategy be for Nifty and Bank Nifty?
Good morning. Thanks for having me. So we have seen some recovery from lower levels as index formed a bottom near 21,964, headed to 22,650 marks. But from last 3 days, it has been struggling to hold about the same. On last trading session, it opened negative but managed to hold 22,300, headed to 22,500 zone. So supply is clearly visible because the structure of the market remained negative from last couple of months, as it has been making lower top, lower bottom. But the good part is on weekly and the daily chart, the index has started to witness some sort of stability in buying interest from lower zone. So I believe it would be tough. Market requires more time consolidation or some follow-up activity or formation of higher base. But as of now, till it holds above 22,222, we are expecting this bounce to extend towards 22,800 to 22,900. So we have to play the broader range between 22,222 to 22,900 for slightly positive to range bound bias with capped upside in the index.
Right. So Chandan, that's with Nifty. And how are you looking at Bank Nifty? Because again, Bank Nifty, 48,000 is a crucial level that everyone's tracking.
Yeah, so Bank Nifty was slightly holding well, but on last trading session, it fell down due to the sharp decline in counter like IndusInd Bank. It drifted to 47,700, but managed to close near 47,850. So here structure is slightly negative because of one counter, but if manages to move beyond 48,000, then short-term recovery led by bullish crossover or bullish divergence could be seen. So here the trade will be very conditional to buy only on hold above 48,000 for a bounce towards 48,500 kind of level. And in that scenario, 47,650 will be major support. So conditional trade with hold above 48,000 will give the intraday trade. Otherwise, we have to be with negative bias in the Bank Nifty.
I'm going to come to your picks in just a second. Chandan, good morning. Great to have you on. Just let's look at early movers in the pre-open session. About 4 minutes done. IndusInd Bank 10% down once again. Expect another rough day. Keynes Tech feeling the heat. We told you about the notice which has gone to the management on non-disclosure of digital data by SEBI. 3% down on Keynes Tech as well. What's working? Let's pull up Bharti Airtel. I want to see Bharti Airtel and I want to see RIL as well. Both have announced their tie-up with Starlink. Bharti Airtel about 4% up this morning. Let's see Reliance Industries, what they're doing, just about 1% up. RVNL on order wins, also buzzing this morning, and it was on our watch list as well. So you have a good amount of movers and shakers, not looking half bad, frankly, compared to what a bad start we had yesterday and then how we follow through. Chandan, let me come to your picks and then tell me what you make of Bharti Airtel and RIL. I'll ask you on both.
Yeah, so first I'll discuss about the stock which I want to share here. We need to keep in mind that market momentum is slightly choppy, upside is being kept. So look for a small bounce and looking for some relative strength. First it is buy on NTPC. After the consolidative move of last 2 days, it managed to hold support near 323. On weekly chart, early sign of bottom out process are clearly visible. So with support of 322, looking for a recovery towards 345 in NTPC. Second trade is buy on BPCL. Here the stock has negated its lower top, lower bottom after the corrective move of 23 weeks. We witnessed a positive price action and now it is holding above its 50-day exponential moving average after a long journey or decline of 100 days. So because of this setup, some recovery could be there in the counter. One can buy with support of 257 for a bounce towards 278. Now looking at the two name, Reliance, we believe that short-term bottom has been placed in the counter. It has been making high top, high bottom from last 3-4 days. So I believe with support of 1220, it can head towards 1280 to 1300 level. Looking at Bharti Airtel, one of the strongest name, but has been moving in a broader range. Whenever it comes to 1570, 1580, it witnesses buying interest and now forming the higher base. So with support of 1620, Bharti Airtel can head to a 1730 kind of level.
1709 maybe or 1700 or thereabouts for Airtel in the first 6 minutes. IndusInd as we marked, not 10% lower but still 4.5% lower for sure. So that one reels under a bit of pressure. I wonder if Adani Enterprises is showing any kind of moves in the session today. That's one more that we should try and keep in mind. So those are a few stocks really from the newsmakers list, if you will. Tata Motors will be the last one, right? I mean, will be the another one that will be important because there are two sides to their release. One, the management is confident of meeting the JLR guidance, but at the same time, the numbers around FY26 don't seem to be too constructive. So Mayuresh, come in on what does this Tata Motors release about meeting guidance on EBITDA as well as revenue for FY25, but FY26 not looking that strong mean for the stock?
So Neeraj, interestingly, I think I was going through a global report on autos and I'll forward that report to you as well in some time. Very interesting perspective on three key aspects. One, obviously, in terms of the adoption of the EV mobility platforms and the growth thereof. The report probably suggests that there might be some element of slowdown in both the adoption and pickup as far as EV mobility and platform adoption is concerned, specifically for the next calendar year itself, which is the current calendar year. The second aspect, obviously, is in terms of pricing and competition intensity. And therefore, I think with newer models expected to come through, more content per car getting added, and therefore how pricing is probably going to get placed across the European ecosystem, the North American ecosystem, and the Indian ecosystem as well. I think that's going to be very, very interesting to probably observe. And third, I think in terms of the infrastructure requirements for all these elements put together, I think there is going to be massive investments that probably need to be put in. And companies are going back on two counts. One, both in terms of R&D for new platforms, for development in terms of aspects related to the powertrain, batteries, etc., and the charging infrastructure as well. So I think all these three aspects probably point out that the auto sector might go through a period of consolidation, and that might probably reflect in numbers. So our take at this juncture is for the OEMs, we are on the sidelines. Selectively, auto ancillaries, Neeraj, in my opinion, can perform relatively better compared to the OEM.
That's with regards to auto sector overall, taking into consideration the kind of EV infrastructure build that we have been seeing progressing in India. But moving on to a big brokerage call today. IT sector is in focus after it has been lacking in trade. Morgan Stanley, in fact, has gone ahead and cut the target price for most of the IT sector players. Rucha joins in with more from the report. Rucha, good morning. What are the key highlights?
Right, as you rightly mentioned, they have cut target prices for most of the IT companies, but big downgrade has happened for Infosys, downgrade to equal weight from overweight. In terms of target price, it has been cut to 1740 rupees from 2150 rupees. And in terms of the other stocks, well, LTI, Mindtree, TCS, Coforge are all maintained overweight with a target price of 5,800, 4660 and 11,500 for Coforge respectively. Now, in terms of sector as a whole, they believe that the growth and multiples are being recalibrated. However, the shifts in macro environment and technology are actually happening fast, and therefore they see downside risks emerging for both the revenue growth of IT services as well as the valuation multiples. And remember that valuations were a big concern for most of the investors over the last couple of quarters, and therefore they say that for selected stocks, multiples could also become polarized. Now, in terms of currency, well, this one supports the margins and earnings. However, as I mentioned, valuation multiples have more room for downside risks. Now, in terms of key trades, they prefer TCS over Infosys, Tech Mahindra over HCL Technologies, and Coforge over Emphasis.
Okay, and that's that's the key thing, right? That play. Rucha, thank you so much for that. But that's the key play that we spoke about: TCS over Infi, Tech Mahindra over HCL Tech, and Coforge over Emphasis. But largely, as I said on the trade setup as well, they believe multiples will come off. Now, Sudeep, come in on the IT stocks. Yesterday was a bit of a roller coaster move, down 2%, then gained to close nearly at the day's highs. Nasdaq under a bit of a cloud. How would you trade any of these IT names? Let's pick the large ones. Let's pick the more active ones. Let's say Infosys. Let's say Coforge, and I'll throw in a TCS there.
Neeraj, if we have all these three names put together, I feel the way TCS as well as Infosys have their chart patterns, whether on a daily basis, weekly, or the monthly basis, it's hinting at a downtrend and a stronger downtrend, because the way the stocks have broken there. In fact, if you take TCS's example, it has broken entire 2024's bottom also. So what we feel is that the structure is getting a bit weaker over here, whether it's in case of the large cap names. Tech Mahindra is still holding out of all these larger names. And compare that with the Coforge. Now, Coforge also had its share of problems earlier. We had seen some kind of a downtrend, but in the last few sessions, we are seeing some kind of a bottom being formed closer to 7,400, 7,500. And now 74.50, 74.70 will act as a strong support here. Until the time this is held, we feel a move up to 8,000, 8,100 is likely. So in the short term, we feel Coforge could outperform Infosys as well as TCS from a extreme short-term perspective.
So that's with regards to where IT stocks go. That's the play that Sudeep is recommending. But we're just around 2.5 minutes away from open. But let's quickly look at a few of the other names as well that are in focus. Let's pull up a PB Fintech. Investment in terms of its healthcare arm, that could be a stock that could see some bit of moves. 1.5% downtick is what is indicated. Mayuresh, what's your view on a PB Fintech?
I think a lot of things happening to and fro, specifically where PB Fintech is concerned. And therefore, I think the core dynamics in terms of how reported numbers will be is going to be extremely critical. As we see it at Markets with India, I think there has been a large move, it's consolidating, but I think it's all going to point down to numbers and management outlook going ahead.
What is the top call? Let me come to Chandan and Sudeep very quickly if we can. I don't know if you have time. But Chandan, what is your top call after the pre-open session has ended? I see a Godrej Agro buzzing this morning. So is a Honasa. Let's see what happens with Swiggy. There's an upgrade as well. Any of these that you like or what your call is?
So I'll focus on BPCL, the name which I've recommended here. I want to be very selective in this scenario. So BPCL, I'll again recommend or suggest or repeat with support of 257. We are looking for 278 kind of level. On reply to your question on Honasa, I think yes, some recovery could be there. Stock has potential to rally by 3 to 5% from current level.
Not surprised with BPCL. Remember today, Avendas has also gone out and upgraded the oil marketing companies. So BPCL is Chandan Taparia's top call. Sudeep, your top one call for trade today?
Neeraj, I feel Navin Fluorine could do well. The structure is quite good on the daily, weekly charts, and we feel that Navin Fluorine from here could outperform in the coming few months. So it's not just for a day, but from a positional perspective, this stock could outperform.
Interesting. Positional perspective, Navin Fluorine outperformance. So watch out for that as well. And Chandan has gone for BPCL. Remember, as I said, HPCL yesterday had an HSBC, or day before yesterday had an HSBC upgrade. Yesterday or overnight, Avendas has come out with a report on HPCL and oil marketing companies. So watch out for that bucket. But here's how markets are starting off this Wednesday morning. Will we see green? Yes, we are seeing green. This is really impressive from the Indian markets because they were resilient yesterday. They are in the green yesterday, as is Asia, by the way. A lot of Asia is in the green today. So keep that in mind. But banks, it's a quiet start. Nifty IT is down, I presume because of the Morgan Stanley downgrade and NASDAQ kind of contributing to it. Mid caps 0.5% higher, small caps more than 0.5% higher. These also recovered, by the way, in trade yesterday. Remember that. Put up the heat map. I believe a fair spattering of green. Yes, we have. But I'll start with the red first because IndusInd continues to sulk. Infosys continues to sulk. We also have Wipro, HCL Tech, TCS, TechM. This is the Morgan Stanley and the NASDAQ report NASDAQ impact combined here, but Info in particular because that is a downgrade that has come in 2.5% lower. Yesterday the ADR was a dead giveaway and it's doing the same. Trend, yesterday's top performer slightly lower today. Shriram Finance slightly lower today. Tata Consumer slightly lower today. But that's the long and short of it. IndusInd Bank and IT on the losing side. On the gaining side, Bharti Airtel, the Starlink tie-up is certainly helping the stock today. 2.5% higher. Tata Motors, the street seems to like the fact that Tata Motors has reiterated both the margin and the revenue guidance for FY25. I still ask, what about FY26? It doesn't promising enough growth, but be that as it may, it's up. HDFC Bank takes its turn today. Yesterday was ICICI Bank, top gainer in the banking space. Today it's HDFC Bank, helping the index as well. And then a Power Grid, Adani Enterprises, a sentimental benefit, Sun Pharma, NTPC, etc. But yes, it is Airtel, which is actually on the gaining side, doing the roost. And Tamanna, IndusInd Bank, yes, I think it has got to do with the revelation that the CEO and the CFO sold some shares, which is again bringing the stock down to its knees, 7% lower after a near 40% downtick in the last 15 days. This is not looking good.
Not looking good, and I think also to the extent, Neeraj, it's also a lesson in what damage control should look like. I mean, I can understand that damage control is required, but then you have to be honest, transparent, and take the questions that matter. Look at the market cap wipeout. on IndusInd Bank. I mean, it's just today, in the first couple of minutes of trade, 2,700 crores gone, and this is only going to get deeper. So tough on IndusInd Bank. Unfortunately, I mean, if you look at the shareholding structure, a lot of DII, a lot of shareholding over there, so a lot of retail investors stuck in this counter right now. But let's look at the broader markets as well. Let's pull up the small cap and mid cap indices for you. Spot of green there, 0.5% up on the mid cap, 150, not bad at all. Small cap also up in the green. We'll pull up the sectoral indices very quickly and see what's buzzing this morning. Oil and gas up and about 1% up. Brent staying below the $70 mark. Ukraine agreeing to some deals and a ceasefire. This is after their drone attack yesterday. Ball now in Putin's court. Is there hope that something picks up there? That's perhaps what is reflecting on the Nifty oil and gas and on the Nifty energy as well. And that's of course the other indices which are pushing up. Another tough day for IT. IT can't catch a break, 1% down right now. Nasdaq also pummeled yesterday, not to the extent of day before yesterday, but Nifty IT down once again. Bond deals aren't helping either. And look at the stark difference between what's happening on the Nifty IT and the Nifty FMCG. So this is a clear pocket of pain as a sector. The downgrades coming in from brokerages not helping either, and that's an important one. Specific stocks. Let's look at specific stocks. I'm going to revisit IndusInd Bank as the first stock that we look at. A couple of minutes of trade gone by, and let's see what really is happening with it. Is there any recovery? 4% down even now. I mean, if you look at the 27% down on it yesterday, it's definitely looking better, but IndusInd Bank under pressure, definitely continuing. Bharti and RIL, I found this interesting. Let's get those two stocks side by side because both have announced a deal with Starlink, and both up in the green right now, nearly 2% on Bharti Airtel and RIL 1% up. What's interesting is that when Starlink first started, knocking the doors of the Indian government to come in, both had suffered with the idea of competition. Very, very smart to go and tie up with a new player instead of trying to keep them out strategically. Keynes Tech is the other one that we're tracking. A SEBI notice to management has put it in a spot of pain. This was on our watch list as well. 8% down and counting on Keynes Tech. There's a digital database they did not maintain in the fourth quarter of financial year 2023, and that's coming back to haunt them. The company says they're looking into it. RVNL, let's see what RVNL is doing. Again on our watch list, 2% up, order win impact, and that really has worked for RVNL this morning. So quite a few stocks in focus, but Hiral, what else are you spotting?
What's interesting right now is the oil and gas space. Interesting moves coming in there. As Tamanna also mentioned, the top gaining sector in terms of oil and gas. Just quickly look at HPCL, BPCL, ONGC. These are a few of the names which are seeing some strong moves. In fact, let me head across to Mayuresh to get his perspective. Mayuresh, what would your view be with regards to where oil and gas goes? And you have Brent, which is still sustaining below the $70 per barrel mark. So positive for some, negative for some, right? How would you expect investors to play this space?
Very logical, Hiral. You probably assume that if oil stays in the range that it is, I think a lot of the end user application industries, including paints, your tire makers, aviation companies, are going to benefit quite significantly. Obviously, the kind of inventory that they're carrying and the kind of pricing that probably persists over the next few weeks or months, there will be an adjustment required in terms of both inventory gains, stroke losses, which will be a reflection of how OMCs will probably report. But to a large extent, I think that is obviously beneficial for oil marketing companies and a whole host of these end user industries. Obviously, for upstream, because the prices remain lower, and if they do persistently remain lower, the average realization per barrel of crude oil with the volumes that they are doing obviously starts coming off. But the respite is also that Singapore GRMs are holding up, which were languishing over the last few weeks and months, which also aid to the overall refining part of the business as far as downstream companies and companies like Reliance is concerned. The only segment within this space is the petchem segment, because I think the pricing is still on the lower side as far as downstream products are concerned. The delta spreads between a lot of these downstream products itself, as far as the petchem chain is concerned, still seems to be on the lower side. And therefore, I think pricing might be a concern as far as the petchem part of the business is concerned. But Hiral, to answer your question, I think tires, paints, aviation stocks, OFCs might sentimentally benefit if oil persists and keeps at these lower levels.
Okay, Sudeep, quick opening thoughts and a word on oil marketing companies. Chandan has reiterated a buy on BPCL too. A lot of brokerages have come out and given a thumbs up to the oil marketing companies. Do you like any of the three?
Neeraj, if you see the markets post opening, we are seeing some kind of a volatility. 25,550, 22,550, 22,570 is not able to hold, and there is some kind of a choppiness. But overall, we feel 22,400 for the day and 22,300, 350 positionally will still remain an important support. And till the time this is held, there could be case for a pullback up to 22,750, 22,850, as we discussed in the opening remark. But now, within the oil marketing space, if we have to see, I feel BPCL as well as HPCL both are looking good. So both can be bought with a 2.5% stop loss or 3% stop loss. And positionally, this has to be carried because it's just not a day trade. And these companies don't give you an intraday or a couple of days move. You have to buy and hold them for a week or so for making decent gains here.
All right, Chandan, just a quick word from you on Top Call. After the first few minutes have settled in, let me actually get to you on Tata Motors. Tata Motors seeing recovery after a while, after that management meet. Would you use this opportunity to exit positions or add on?
No, this stock is recovering after a long time. It has gone into the deep oversold territory. If I look at the price behavior, it has been falling down from last almost 8 months. Corrected from 1176 to 600 marks, almost 40% decline from the top. So now as the stock is turning from the key support zone and turning from the deep oversold zone, so short covering could be there. So I believe one can play the short covering or even can add the Tata Motors here for investment point of view with the view to get 20-30% surge in the prices on positional. But on intraday point of view, I believe with support of 650, one can look for a recovery towards 685 to 690 zone in this counter.
Right. Some upticks there for this one too. Gentlemen, all three of you, thank you so much for taking the time out and being with us. Really appreciate your time. And it's Q to get in a very important market voice. Somebody who looks at cycles very, very closely, or maybe looks at the markets as parts of a cycle. And Kenneth Andrade, founder and CEO of Old Bridge Mutual Fund, Johnson right now on the show. Kenneth, so good having you. It's been a while. Thanks for joining in.
My pleasure. Good to be on the show.
Yeah, great to have you. How do you view the current landscape, Kenneth? Did 2024 mark the end of a previous bull run, if you will? Are we setting the stage for a new cycle, or is it difficult to predict that right now because of the glorious number of uncertainties, including Donald Trump around us?
Well, there are a lot of uncertainties, which is why we are in this position at this point in time. But it's been a while since the market's actually consolidated. And if you put all statistics together with number of lows, price earning multiples actually coming off, we're probably 1 year away from this consolidation point. See, I don't expect markets to go to react very negatively despite incremental bad news.
Okay.
But it needs to take our time at this place. Okay. You have struggling domestic macros. You've got weak commentary coming up from the rest of the world. But the biggest positive to this entire change that is happening domestically and internationally is, I think now you're going to see a significantly massive capex cycle, not just in India, but in the rest of the world. And this is the time where the international, or should I say, the developed markets have started putting money to work. So the capex cycle is around the corner. It's going to be a bigger one than you've seen last time. What's going to benefit? How are we going to feed into that supply chain? I think the landscape's pretty much open. So look at it from in this consolidation round, how do we feed into that supply chain? It's more of an opportunity than any risk that you're actually looking at.
That's interesting you say that, Kenneth. So, yes, Europe, Germany led large capex, China presumably large capex. India, we've shown a tilt towards also favoring the consumer in the budget gone by. But yeah, the capex spend still stay at about 11.5 lakh crores. So when you think of a large capex cycle, is it the turn of companies which feed into the global cycle? Because you always say that look at that as a wider piece, which benefit out of it, or do you believe India at large also will go a heavy capex cycle continuously and that will benefit?
So just let's step back a little bit into financial history. 2000 India tech, you had a tech boom, but that participated what happened in the rest of the world. 2007, 8, 2006, 7, and some part of 8, it was a commodities capex cycle driven by the Chinese, and India participated with the second largest, fastest growing. So you need a consolidation. You need a consolidated global shift in capital towards one particular industry or one particular segment of the marketplace, and that's how we will participate. Okay, I'm not too sure that the consumers in any part of the world is coming back, because if you have government spending that's coming in this stage, if you have corporate balance sheets that are going to expand, it's going to be I would say it's going to be a tad inflationary, and inflation is not very good for the consumer cycle anywhere in the world. So if I can say, incomes will just match inflation, which doesn't give you a higher spending power. And if you look at the commentary even in India, right, people do not lower their consumption volumes. What they do is they shift preferences from a aspirational product to something more affordable. I think that's the cycle that we're going through. We're going through down trading, if you might want to call it, and this is going to be sticky for a while.
So Kenneth, an interesting aspect that you pointed out towards is the cycle that we are seeing with regards to the capex part of it. Now, taking your theory into consideration and the way you invest, do you think now is the best time to stock pick at the bottom? And if so, which are the sectors will you start your exposure to?
I'm not the first one to say it, and I'm not the only one who's going to say it also. Look at where governments are expanding balance sheets, and that's the direction that you need to head, and that's at the macro aspect of it all. If you're going stock picking, honestly, we got a preference to businesses that are at the lower end of their industry cycle, or the opportunity in every industry is large, but then every industry goes through cyclicality, and we need to pick those businesses out. Of course, we like growth, but growth is embedded in how that industry will be over the next probably 5 years or the next decade. And our preference has largely been not so much domestic focused businesses. I mean, we got a fairly large weightage on pharmaceuticals. We've been liking commodities for a while now, but I think now you get all the relevant data points to say that this might be a elongated cycle, and you will have pricing actually come back in commodities, and this is basic commodities that we had. And engineering might see an uptick, but those valuations are fairly stretched. So it doesn't fall in our universe of companies, but it could be something that would come through.
Kenneth, I just want to go back to your first response, where you said that you are actually seeing an opportunity. And if you could expand on that opportunity from the Indian context, where we've come off a fair bit or more pain before that opportunity kicks in, and people who are watching this and want to hear your view would want to know, how do you spot that opportunity right now? There's a lot of confusion, right? Every day you wake up and there's a whole different story about tariffs happening, not happening, regulatory issues coming in. It's a bit of a scary place right now, the Indian markets.
Well, it's not different from what we've all experienced over the last 10 years, right?
Yeah.
You wake up to a pandemic, you wake up to regulatory changes or tax changes in the system. So that's what's happened over the last 8 years or 10 years. And I think that's continuing to happen. So every time you get a negative construct in terms of the news flows, you'll get volatility in the system. And you'll have to use this volatility to your advantage. So go back to 2018 and look at the consensus where it was. Okay, that didn't follow through in how stocks performed from 2020 to 2024. 2018, you had consumers, you had private sector banks, everything that was at the top of their performance, right? It wasn't so in 2020 to 2024.
Oh, no, but you could say a pandemic is a black swan event.
It wasn't pandemic, it was just valuations, right? You needed an excuse for valuations to correct. You got an excuse for valuations to correct. Now you'll have to figure out where you want to allocate capital to.
Are you happy with where the valuations are now? Is there more comfort, or there's still more room?
See, if markets remain where they are for the next year, maybe 2 years, you're staring at 17 times 2027. And that's why we've historically been. So what I've also said is that we've been waiting for a consolidation around these levels.
Yeah.
Corporate balance sheets are nowhere close to anything going insolvent.
Yeah.
No.
Okay.
Yeah. No.
And as long as you have insolvency risk off the table, a business is in continuity.
Yeah.
Now you're looking at how you will grow. So you just have to have a moderation of expectation levels, which is happening right now. Valuations are correcting, whether they'll go back to 17 times, whether they'll go back to 20 times, or they'll stop at 20 times. I'm not even sitting on the judgment seat on that. But there, within that, you have to look for spaces that will do well. And there are a lot of industries and a lot of companies that have done nothing for the last 4 years. Okay, look at India's largest automotive business. You look at the entire pharmaceuticals landscape from 2015 to 2000, and this is the export-driven pharmaceutical landscape that is there, right? 2015 to 2024, the CAGRs in that business is less than a single digit. Okay.
No, so just, sorry, one follow-up. So because you've marked out auto and pharma, for some would argue most tariff sensitive.
Why worry about tariffs?
Really?
Okay.
Why not?
Yeah.
So which country has got the right to win? Or which company has the right to win? I mean, it's basically the companies that have the lowest cost of production, right? Look, you're trying to compete with a per capita income of $3,000, okay, in a country that's putting tariffs at a per capita income of $60,000. No, I mean, with all the tariff regime, I think the entire world's essentially trying to figure out an end game. And we are also trying to do the same thing, right? But if you've got the lowest cost of production in the world, or in segments of the market where you have the lowest cost of production in the world, you will come out on top in certain industries. And you've seen that happen from the Japanese economy in the 80s to the Korean economy to the Chinese to where we stand right now. So shift the matrix, shift the. I mean, we're worried about what's happening in the next 6 months, but if you look at the next, say, put a number to it, which we do is 2030, I think things will be very, very different at that point in time.
So, hypothesize 2030 for us, Kenneth. From here on until 2030, is it these sectors which haven't done too much and which have the right to win? Pharmaceuticals, for example, are they the likely big winners over the next 5 years? And are you playing that game, therefore, for 5 years?
So look at it from 2001 to 2008 and look at how technology delivered what is delivered till now, IT services delivered till it's delivered now. And we're looking at something very similar happening at this point in time in pharma. Okay, same thing with commodities. We are setting up one of the largest steel mills in the world, and undoubtedly we got the lowest cost of production in a number of those materials. Now, if you've got the base materials, or the base infrastructure, which makes every value-added product competitive, I don't know what could be. Okay, you still have a cost advantage in the rest of the world. So obviously things will move dramatically from here.
That's very interesting. And viewers, I just want to, I'll kind of expand on that point with Kenneth and Radhe, because what I do want to ask him is whether to look at the export-driven businesses which are US focused, Kenneth, and which is, just for nomenclature work, for the viewers understand the Sun Pharma's, Lupins, etc. is what I'm describing, or do I look at CDMO companies which are a slightly differentiated business model, or do you like the domestic healthcare businesses, the hospitals, the diagnostics? What fits the bill, if you will, from a 5-year, 6-year perspective?
So it all feeds one into the other, right? So what do let me. I come back to the pharmaceutical specific example for now. What feeds into Bangalore real estate?
IT services, GCCs.
Exactly. Yeah, exactly. So how does per capita income come up anywhere in any part of this country? You need an industry to drive per capita income.
I would be very worried about Bangalore real estate by that measure.
No, but sorry, finish your point, sorry.
So you need large industries, and you need to go out and capture per capita, arbitrage wage incomes globally to domestic wage incomes and take per capita income up in those respective geographies. That's what's happened in South India, largely because of the IT franchise. It might happen in manufacturing. Within manufacturing, it might happen in pharmaceuticals first, and then progressively go forward. So as long as you traverse that way from where we are right now to a higher trending per capita GDP, all services linked, including healthcare businesses, will do extremely well. Now, valuations in healthcare are front loaded. Wait for a cyclical change that will happen, and it will happen. And you'll get bigger opportunities and much scalable opportunities post that also.
And Kenneth, the other aspect with all of these segments that we're talking about is the way you look at the broader markets as well, right? I mean, currently, if you see the portfolio, equal weightage in terms of large caps and small caps. How would you expect someone to play both these segments? Because one place the argument is, let's look at growth. One place the argument is, let's look at value. In such a market scenario, what would you pick? I know you just mentioned earlier as well that you will not ignore growth, but what will a stock picker's market be now?
So we've got an affinity for businesses that have already put capex to work. Now, whether they're large companies or whether they're small companies, we are indifferent to that. Most of the small companies that we have also are category leaders. So you pick up any one of them that you want to pick up. I think one of the trading companies are amongst our top two, but he's the largest company in India, or has a leading market share from the rest in whichever market he operates, right? So I wouldn't want to distinguish in terms of whether we are large cap or we are small cap, but we buy the largest companies on the in their particular area. Second is that how these companies invested in the past. So let's take a look at India's largest automotive passenger car vehicle. You're moving from 2 million cars to 4 million cars. Okay, but the maths doesn't add up if India's automotive demand is growing single digit.
Correct.
Okay, math doesn't add up. So what are the markets that they're heading for, and on what legs are they standing, right? Now, so if the average realization per car is about, say, 6 lakhs or 6.5 lakhs for the first 2 million cars that he sells, what happens if the next 2 million cars, the average per capita vehicle realization is 12 lakhs? How does that change the financials, the balance sheet, the cash flows of that one particular business? Now, what's going to drive that business to get that number? Okay, and where can you get that number from?
Yeah.
Okay, and we all know it. I mean, it's all of this is in public domain.
Kenneth, how are you feeling about financials? And just off the cuff, I know you might not want to answer. Have you felt stuck with IndusInd Bank and what has happened with IndusInd Bank? And overall, your view on financials right now? Because you spoke about auto, you spoke about pharma, and if you're looking for opportunity, a country is on a growth trajectory. Is financials the bet?
So, step back to 2008 and we had this large capex boom. I think financial services or lending businesses were about 9% of the index. Okay, we are going into another cycle. It's at 30% of the index right now, or close to that number. So the first cycle, we really didn't need market cap of financials to be large enough to hit that trajectory of about 10% growth 10% nominal GDP growth during that period of time. So I'm not too sure that nomenclature is that if GDP grows, financials will follow. It will. Balance sheets will follow out that. But how much pricing power do they have on the ground at this point in time? Not too much. Okay, and if I look at how each of these companies have transitioned, all of them in the initial period of growth had an extremely high capital efficiency. That's trended lower. Okay, and that's trended lower. And the question to ask is, if they will it go back to where it came from? I doubt it very much. Okay, so as you grow larger, as industries mature significantly, I think you'll have a adjustment in your return on capital employed or return on net worth, and I think that's the structural change that is happening with financials. The low hanging fruits are gone. Okay, so should a 2.5-3 times price to book be at peak valuations for these companies in this cycle? Probably, I think so. Okay. So compared to what has happened in the past, where they've given you a multiplier effect in capitalization, that opportunity, I think, is behind us. Okay, I don't know if that answers your question, but it will be a part of your portfolio, but it's not going to be, it will give you market returns.
Okay, so if I have to, in terms of answering my question, Kenneth Andrade not too hot on financials.
I've never been for a while.
Yeah, and continuing not to be. Yeah, so then what are you liking apart from pharma and auto?
No, I think it's a fairly diversified mix out there. So I try to explain my investment thought process or our preferences through smaller industries, smaller components of the industries. Like I said, it's we have one automotive stock, so we don't have a whole host of automotive businesses. We've got about 23 companies in our portfolio, and that's where it stays. In terms of industries, I think commodities, pharmaceuticals, and some part of IT is the main construct. After that, they are all individual companies that dominate their industry. So it's a lot more stock picking, but a lot of it is hedged against just the domestic market. I say hedged against the domestic market. If there's a slowdown domestically or macros are slowing down domestically, I think we've got enough of our portfolio is robust enough, or I think their business models are robust enough that they can go outside and take incremental market shares.
One question I have is with regards to telecom. You have some bit of exposure to telecom as well, but how are you looking at Starlink's entry into India, taking into consideration a partnership with Jio as well as Bharti Airtel so far that's been announced? Do you think any landscape will change?
It's good for the consumer, I guess. So I'd start with it there. But in telecom, I think this is going to be 1 year where the return on capital employed for one of India's telecom companies is going to be higher than the cost of debt. After a long time, that's going to happen. Okay. I haven't seen that happen for almost a decade. But I think we're hitting that inflection point. Pricing power is coming back. So it's a gradual change. Cash flows are going to be extremely robust. And there's no competition in the landscape.
Interesting. Can I debate just one last point? And you started off by saying that it might be inflationary for the consumer, and during inflationary times, consumers don't benefit. But maybe the WPI goes up, but the CPI seems that it's not going to be heading higher. Plus, as small as it may sound, or as medium as it may sound, the $12,000 per month of tax benefits seems to be directed as a benefit to the consumer. Shouldn't consumer-facing firms, be it staples, be it discretionary, what have you, shouldn't they benefit out of this over the next 12 months, 18 months, 24 months?
See, that number isn't perpetual in nature. Okay, so it's not just one time. It's going to be there for a long period of time. But it's not, I don't think it's going to move the needle that much. It's not going to move the needle too much. See, inflation is extremely good for corporate profitability.
That's true.
So let's focus on that, right?
Okay, fine. So you're choosing. Okay,
you have to, because capital actually moves that way. I mean, everyone heads towards the most profitable part of the world.
Got it. Okay. Kenneth Andrade, it's so special talking to you. Thank you for being with us today. Lovely having you.
Thank you.
Absolute pleasure. Yes. All right, Kenneth Andrade there does not like financials, likes pharma, and says, why worry about tariffs? I think that's the headline I'm definitely going to remember, since everyone's got themselves in a bunch over tariffs. But focus on Dixon Tech. Dixon Tech has forayed into display fabrication segment with a total capex of $2.7 billion. We'll be joined by the management shortly to talk about their plans and more. But first, Puneet is setting up the conversation for us.
Thanks for that. So it's a very big venture that Dixon Tech, India's largest EMS company, is venturing into. And while the stock price performance might have impacted after Q3 earnings, based on the large amount of capex, I think the market as well as brokerages and analysts are warming up to the idea and seeing this as the next big play for Dixon Tech, something that they've not refrained to from getting into a tough industry, but they're looking at the long term. That's what brokerages are saying. But one of the key aspects of this big investment is, of course, the government subsidy. Under the India Semiconductor Mission, it is expected to subsidize roughly 75% of the total project cost, 50% from the center, 25% from the states. And with this, most brokerages are building in a very positive outlook for Dixon Tech. Some brokerages like the Kotak as well as Investec have reaffirmed their positive view on this venture after the Q3 valuation re-rating as well as fall. And one key aspect that they are saying, that by FY31, Dixon will have EBITDA of 2,000 crores from this new venture, something that they're going to do in FY26 from the current business. So it's essentially a new business created in the next 5 to 6 years. And it'll be key to see if management might affirm that number. But it's a new venture that's going to be, drive the valuation as well as stock performance going forward as well.
Well, Puneet, thanks for that. And let's pose some of those questions to Saurabh Gupta, CFO of Dixon Technologies, joins us right now on the show. Saurabh, great having you. Thanks for taking the time out. And one of the notes, Saurabh, that I read on this display, let me start off with that micro, right? The display fabrication entry. It says bold ambition, high stakes. Tell us how you think about it.
Yeah, absolutely. We also feel it's a large kind of commitment that Dixon is giving. Dixon would be doing. We have historically not done that kind of capex, but we feel it's very important for us for the next 3-4 years, because we already have a large opportunity in mobiles, IT hardware, and also in TVs, and at some point of time automotive displays as well. And we think that getting into display would add another revenue stream. It's a highly profitable business, and there is a duty arbitrage to it. And since we already have a large customer base, and with a decent government policy with 75% of the capex being subsidized, I think so we can generate decent paybacks, less than 3-year paybacks, and also good ROCs in this business. So it will not be ROC dilutive for us, and it can in fact be positive for us.
Saurabh, one of the views that comes, and I would love to understand how you think about it, is that because there is a fair degree of technology disruption, heightened competitive pressures from one country, and therefore for any player, not just you, there might be continued government subsidies as well as trade barriers which might be required for any business doing this to start off and thrive. Do you believe that to be the case, that will be necessary, and if so, do you reckon that you can bank upon it?
Yeah, for display fab, I think so government support is required, and that is not only the case in India. Globally also, if you look at any large semiconductor capacities or display capacities, a large amount of that is supported by the government, either in form of equity participation or subsidy, or some kind of a subsidy, which is the current existing government in India also trying to do. So we feel it's a large opportunity because India imports almost 11 billion worth of displays now. And that number is expected to go to 23 billion. And display and semiconductors both are very critical component which goes into any electronic product. And so it's very important that only when the government comes out with the ISM2 plan, then only we'll go ahead with this project. But apart from that, I think so in other categories where we are already beneficiary of PLI, I think so there we now no more require government kind of support. Like in mobiles, we have come to a position where we have a large scale. We are now looking to get into backward integration. We have a decent manufacturing cost. And there, the initial support provided by the government has really helped us. But now I think so we can really stand on our own feet and compete globally.
Saurabh, hi, good morning. Tamanna here. I just want to go back to the point about what is expected under the ISM scheme. This display unit is under the ISM scheme, as you explained. What is it dependent on? What is the kind of intake or support that you need from the government and the conditionality of that? If you can give us some idea there.
So broadly, there are three policies of the government, and I'll come specifically on ISM. So one is the production link incentive scheme, where we are already beneficiary of across 5 categories of ours. Second is a component PLI scheme, which is expected to be announced anytime before this end of this financial year. And third is the ISM-2. ISM is basically the Indian Semiconductor Mission, which is majorly targeting towards semiconductors and displays. The first scheme was basically the beneficiaries were Tata, the CG Group, and we understand that the government is planning to roll out another ISM-2. Only when they roll out, then we do definitely decide to go ahead with this display fab. But as far as our existing component play is concerned, we are definitely getting into the display assembly of mobile phones, IT hardware, and also looking to get into the camera modules.
Just to reiterate, this $2.7 billion capex is contingent on the rollout of this government scheme and clarity of what is the extent of subsidy that is coming from the government, correct?
Absolutely, absolutely. Okay. I think so 75% needs to be subsidized.
75%?
Yeah, so 50%, the way it happens, the 50% is generally given on a pari passu basis by the central government, and the state government generally gives around 25%, whichever state you plan to set those capacities. So balance is 25%, and within that 25%, we feel our equity partner should also bring in around 25-26% of equity. So our outflow effectively will be only 75% of that 25%. So it will be a not that large outflow, and we feel confident that it is a project which will be.
What's the figure, Saurabh? That mental math I'm not able to do at the rate you've done. So what's the figure you've pegged in?
Yeah, so 3 billion. Suppose 3 billion is the total capex. 75% subsidized both by central and state governments. So we are talking about $100 million, which is 25 broadly somewhere around $800 million. In $800 million, 26% comes from the equity partner. So we are talking about effectively $600 million, which has to be done over a period of 3 years by us.
Okay.
And we generate, the maths is very good. We can generate different revenues and EBITDAs of almost 20% of the business.
Okay. So $600 million. And that makes sense because the display space is a low growth, high disruption and high tech change space, isn't it? With quite a bit of competition from China.
Yeah, absolutely. But I think so India has an advantage because there is 11% duty arbitrage state. And you already have a large customer base. So the overall cost of manufacturing, cost of capital comes down. And it adds another revenue stream and adds to our profitability and after a period of 3 years. So clearly we think we will definitely make a strong attempt to get into this. But yeah, of course we'll wait for the guidelines from the government on that.
One more question on this, lest this sound like a display only conversation, it's not, but just one more conversation or question on this. Because India is such a large consumer market itself, right? And with all the duties, etc. and support that you spoke about, do you believe that there is, you would have a right to win into almost anything that you enter into because of your size. But I'm just wondering, with the existing players out there in this market, do you believe that there is a market to be captured from others because of the fact that you are a large manufacturer, you are based in the country which is consuming large amounts of these products? Is there a right to win out there ready from day one?
Yeah, we believe strongly because we have a large infrastructure, a good team, a strong balance sheet, and clearly we are investing a lot, whether it's digitization, backward integration. So we think, of course, there's an opportunity for everybody to grow. India's share in global EMS space is just 3 to 4%, and it is expected to go into high double digits with the kind of policy framework the government is having. So we feel that we will be a large beneficiary, but of course there will be other players who will also be committing investments in this category. But it is good for the overall, I would say, for the country, for India, for the industry, if more players come in this category of components and overall electronic products.
Okay. Saurabh, what else? I mean, in terms of, we're trying to think of this at the start of the quarter, that maybe towards the end of March or mid-March, we'll ask companies about how is it that growth has looked like in the quarter gone by. Maybe not as much in your space, but in other pockets as well. But just wanted to understand, we are virtually mid-March right now. how have things been? We saw a bit of growth coming back in quarter 3, which is the October to December quarter, relative to quarter 2. Have things looked like picking up further, to your mind, for your business and for businesses at large?
Yeah, so I said the initial part of the starting of the quarter, the demand was slightly slower, but lately we are seeing some uptake in consumption, especially the rural demand. And clearly the government policies also, they have kind of relaxed those weightages on bank financing or NBFC, which is a large part of the consumer financing. So that is a positive. So overall sentiment is turning slightly positive, I would say. But in our case, I think so. What our growth would be decent because we have been continuously taking higher share of wallet from existing customers and also continuously adding more customers. And so it has been a mixed bag for us. So something like variables, telecom has done really well. Mobiles is kind of okay, and TV and lighting is slightly slower. So it has been a mixed bag, I would say, for us. But still, we have 15, 16 days to go in this quarter. So let's see.
I'm just wondering, Saurabh, for the business, is there any exposure to imports that could be impacted by tariffs? Or reciprocal tariffs could be one end of it between India and the United States. A global tariff war could push up your component costs. I'm sure there's a conversation internally and a back of the envelope calculation. Is there anything that you can share with us?
So we feel, of course, negotiations are going on, and the government is also, we are in discussions with the government as well. We feel, though the contours are still not out, it's negotiations still going on, but we feel it will be positive for India. Because if you look at India's export of electronic products to US, it's just 2 to 3%, while China is around 35%, Mexico is around 23%. So they are large, they have large share. And clearly in both the countries, the tariffs have been levied to the extent of 20%, which was almost negligible. So we feel that India is at a slightly competitive advantage. Now, if you look at the reciprocal tariff, the way it works is that either you can put the same tariff on the same product, or you put a weighted average tariff across a basket of products. Now, the import and export basket across US, with US can be different. So we feel that the weighted average tariffs for electronic products for India is a lower number. So the mobiles can be a 15% overall, but since a lot of components are lower, sub-assemblies of components are lower, IT hardware comes at a 0% import duty. So weighted average tariff is still 3 to 4%. So if the government, if this negotiation goes in terms of weighted average tariff, we will gain significantly. And if it goes in favor of, say, zero duty on US kind of import on, say, smartphones, which is the largest export from India, then also we feel that as far as manufacturing in US is concerned, it looks slightly difficult. Reason being, of course, one, it's a low value addition product for them. Secondly, the wage rate differential is almost 10x. And third is the strengthening of the US dollar, which of course makes the manufacturing in US more expensive. So overall, considering all the parameters, whether it's tariffs on a neighboring country, whether US can manufacture smartphones, and if you even offer a zero duty to them, in all these respects, I think so India should gain. Yeah, but one has to wait and watch and see what happens in the next 15, 16 days, whenever they are, April 2nd, we are talking about. Yeah.
Okay, thank you so much, Saurabh Gupta there of Dixon Tech. This display, business component has been rated as one which could bring in as much as EMS. The only thing to remember is that it's contingent on the ISM policy. That's the Indian semiconductor manufacturing policy that the government is expected to roll out. 75% of this is expected to be subsidized by government. So important details coming out of that conversation. The Dixon stock under a bit of pressure today. We'll take a very short break, but on the other side, we get you all the top stories from the market right now. And we also have this great conversation with Aditya Birla Sun Life AMC CIO Mahesh Patil to discuss markets and more.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
a life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Back with India Market Open right here on NDTV Profit. It's a quiet market, but for Nifty IT, bring up Nifty IT. Boy, if a research report can do something like this to an index, quite something. I would suspect that NASDAQ has a big role to play in this. But the fact that Morgan Stanley, which traditionally has been fairly constructive on tech, has gone out and just said that they believe that valuation multiples and growth rates will come into question mark. Look at the pain in that index. It is more than the pain was yesterday when NASDAQ had really cracked. I would like to bring the top losers and gainers, hardly any gainers I'm sure, but the top losers on the Nifty IT index out there. Look at the pain there. Wipro 4.5%, Infosys 4%, HCL Tech persistent, considered a double upgrade by, I believe, CLSA day before yesterday, is down as well. Coforge, a large order win, down about 2%. There is serious pain in the IT index in the session today. Part of it, like I said, has to be the fact that NASDAQ is also sulking, but it's also got to do with the fact that more and more people are now realizing that business may be a bit sketchy in the near term. Could it be the impact of the US economy also not looking as strong, which is resulting in this happening? So the index to watch out for the most today has to be Nifty IT. Keep an eye out for this. We'll try and get some experts during the course of the remaining shows. And of course, when Mahesh Patil comes in, we'll try and talk to him about this as well. But there's also telecom to talk to. GS signed a deal with Elon Musk owned Starlink, a move that could have major implications for the future of satellite communications in India. Somit Johnson with the details. Somit.
Well, yes, Jio and Airtel both have signed a partnership with Starlink where they will be selling and marketing Starlink's products and equipments. Now, the opportunity for this product in Indian market is huge, but the success of this will be dependent on one binary factor. Now, if you look at the opportunity, nearly 30% of the India's population do not have a full-fledged internet access currently. Out of the 1.4 billion population, nearly 400 million people still do not have a full-fledged internet connection, and this product could solve that issue given the fact that at laying fiber in India is quite difficult given the lay of land that is there in the country. Apart from that, this going forward, they could also launch the product where they could offer direct to cell services to both Airtel and Jio subscribers. So that could also be a big opportunity for Starlink in India. But again, the success of this product will be dependent on one binary factor, and that is pricing. Because if in India, if you look at the market, it has a rock bottom ARPU, that is the average revenue per user that the telecom company generates from one user. And if you look at the cost of Starlink or OneWeb, which also provides similar services, for Starlink in US, the cheapest mobile and broadband plan starts from around $50 and $120 per month. Apart from that, for broadband plan, users also have to pay a hardware cost of around $349, which is an upfront fees that they need to pay. Starlink also has operations in many other emerging markets and developing countries. Even in that countries, if you look at specifically Nigeria, where Starlink has the cheapest global plan of around $25 per month with a hardware cost of $262, which is the upfront fees. Even these plan is more expensive compared to what it is in India. In fact, in India, if you look at the unlimited mobile and broadband plans are offered at less than $3 and $5 per month, and for broadband plan, even users do not have to bear any hardware cost as well. So pricing would be the most important factor for the success of Starlink's product in India. Now, if pricing continues to remain at a global level, then probably the potential market for Starlink could be very niche, ultra HNI individuals. It could also find traction in defense segment or enterprise segments like healthcare and airline currently. Now, if you look at the stock impact for Airtel and Jio, sentimentally it's positive given the fact that there won't be any competitive intensity in the market, given the fact that Starlink has a tie-up with Airtel and Jio as well, and Jio also has its own product in satellite communication, where Airtel through its promoter entity also has a tie-up with OneWeb. But on the earnings side, analysts are not expecting much of an upside to come in from this partnership that Jio and Airtel has done with Starlink currently.
All right, interesting. Just want to pull up what Bharti Airtel and RIL are both doing this morning. Bharti Airtel has come off after a very strong start, about 0.5% down. RIL still up in the green. A lot of reversals this morning in trade, but IT sector in focus, and we were talking about the deep cuts today, actually looking quite painful. Infosys, Wipro, all of them lagging, the Nifty IT itself about 3% down. Now, while there could be many factors, what's important to note is what Morgan Stanley is saying. They've come out on a note where they have marked some key trades and laid out the road ahead for the sector. Rucha joining in with more details. Rucha, what are they saying?
Yes, so Morgan Stanley has come out with a report on IT wherein they have cut target prices for most of the IT companies. But pertinent to mention is Infosys, wherein they have downgraded the stock to equal weight from an overweight rating and cut the target price to 1740 from 2,150 rupees. So this is what they have on Infosys. Now, in terms of LTI, Mindtree, TCS, Coforge, they have maintained their overweight rating. They have an equal weight rating in Tech Mahindra, HCL Technologies, and the mid-cap names like Emphasis, LTTS. But underweight rating on Tata Elxsi, Cyient and Wipro. Now, in terms of the sector as a whole, the brokerage house mentions that though there is a shift in macro environment and technology is evolving, this is happening on a very fast pace, and therefore for selected stocks, multiple could also become more polarized, and therefore they also see downside risks emerging for both the revenue growth and as well as the valuation multiples. And now they also say that though the currency supports the kind of margin level that these IT companies have, but valuations are the major risk and room for downside. Therefore, another important point that I want to highlight is the key trades that Morgan Stanley prefers. Number one, they prefer TCS over Infosys. Number two, they prefer Tech Mahindra over HCL Technologies. And lastly, in terms of mid-cap names, they prefer Coforge over Emphasis.
But, well, you may prefer X and Y, Rucha. Sadly, all of them are down in the session today. And is that of the thanks, of course, for bringing us that note. But that brings us to the key question as we start off a conversation, a very important conversation with Mahesh Patil, CIO of Aditya Birla Sun Life AMC. Remember, in the latest note that I see from them, Mahesh and team argue that why this might be a good time to invest. Mahesh, great having you. It's been a really long time. Thank you so much for joining in. And I ask this question to you. Good morning. Is this the right time to wade into the waters when there is a fair degree of uncertainty around the growth of the mother market itself? If the US is going through a slowdown phase, if not a recession, could it pull markets across the world lower?
Yeah, good morning. So you're right. I think the Indian market started the correction much earlier, right? Okay, we saw when Trump came to power, we saw the US dollar rally and sell off amongst the emerging markets, and again our economy also started to slow down much earlier, whereas other economies across the world actually were starting to improve over there. So we have already seen a kind of a correction in our markets. If you look at from a peak, Nifty is down by around 15-16%. The mid cap index and the small cap will be down 20-25% or so. But more importantly, even the wider market, we've seen stocks are down. Like if you look at in the BSE 500, the stocks which are down by more than 30%, that number is almost 60%, which is kind of a level what we have seen only going higher during the global financial crisis and during the COVID crisis. So clearly the market is slightly oversold at this point in time. And some of the factors, which were hurting our growth, we think that the margin they are trying to kind of normalize. So be it on the monetary policy side, where the RBI is now trying to be more accommodative in terms of, they have already done a rate cut. They are trying to infuse liquidity into the wider market by doing OMO, the forex swaps, and ensure that the liquidity eases off. And also the restrictive measures which were there on the banks, those are slightly getting eased off a bit. So I think that should help. While the fiscal continues to consolidate, I think the focus on consumption, which is the need of the hour in terms of stimulant and demand side, I think that should also start to kind of flow through in the next financial year. So I think that should help. All these factors we think will help a recovery in our market, at least on the economy side, and getting our growth back to around 6.5%. So that's the first premise, what we're seeing. And a follow-up of that would be in terms of the earnings growth, which had kind of got significantly downgraded in this fiscal year from around 16% to, probably will touch this year around 5% or so. Again, I think if growth comes back, domestic GDP growth, I think we should see that growth again coming back to around, say, 12-13% or so. So I think given that the most of the negatives are behind us from the domestic side, though I would argue that the recovery will be slightly slower, and the fact that the valuations, especially for the Nifty, is somewhere near the long-term average or slightly below that, which makes us saying that this is a good time to invest. Market can always undershoot on the downside. You're right. The global environment, especially in the US, right, where the data points in the last few weeks have turned a bit negative, and it's showing that there could be a slowdown over there, which could impact a few sectors which are export-oriented from here. But by and large, I think what we're seeing is that even the dollar strength, which was hurting the emerging market, that is starting to now weaken. And if US growth slows down, you could see policy rate cuts by the Fed. I think the chances of that are now gone up. And that could be good for risk assets. So I think given these factors, I would say that it's a reasonable time for long-term investors to buy into this market. Obviously, the markets are not going to go up in a hurry. You will see ups and downs over here. But clearly, there is some value which is emerging in a few stocks.
Okay, Mahesh. So therefore, do you say that it could well be that the screen is suggesting a value zone, go out and do your investments, but brace for maybe some more excesses on the downside as well. And I wonder if you believe that if there is more downside from here, is that an excess, or could it merely be, let's say, valuations reverting to mean?
So again, there are pockets in the market, where the valuations could still be higher, right? We've seen that. So and the fact that when the sentiment is negative, right, we've seen that sentiment and indicators have turned negatives, and even foreign selling. So that can lead to further downside over here. I'm not saying that this is the bottom, but what we're seeing is that the valuations are at a fair zone. The outlook in terms of growth is likely to improve from what we've seen in the last 6-9 months. And that's why I think for a long-term investors, I think this is the time to dip in. Obviously, we're not saying that you go and buy everything at one go. I think for the next 6 months or so, until I think the mid of this calendar year, I think the markets will remain kind of a range bound. I think earnings recovery also will take some time, probably say from the first quarter of next fiscal year when the base will start to look favorable. And that's how we need to spread out. And again, we're not saying that you go aggressive in the market in terms of increasing the risk or the beta. I think the focus will be, for example, for investors who are investing into mutual funds. We are saying that they should look at the large cap or the flexi cap space, not necessarily the mid and small cap, which is slightly more aggressive. I think where I think the market breadth, which is weakened, can continue to do so for some period of time, whether before it bottoms out. Also look at multi-asset allocation strategies. That would be a good way to invest, okay, for investors, because even fixed income and say gold as an hedge also looks reasonably good. So a multi-asset strategy, which includes equities, fixed income, REITs, gold, would also do well, because we think the return across asset classes on a risk-reward basis look to be reasonably okay. I mean, nothing is looking to give you any outsized return. So I think that's the approach is what we are advising investors to do at this point in time, because you never know where the bottom is, right? You can't time that. And I think in the next 3 months or 6 months would be a good time where any market dips can be an opportunity to further average and then build the portfolio for the next 3 to 5 years period.
Mahesh, hi, Tamanna here, and great to speak with you. I'm just wondering at this point, how are you looking at some core sectors which are seeing pain because of what's happening globally? The big talk on whether America is going into a recession may not, in that conversation, tariffs, all of that changes on a day-to-day basis. One sector which seems consistently hit no matter what the news flow is IT. So if I ask you about the bucket of IT, pharmaceuticals, and then let me add an auto, how would you look at these spaces? Is this something that perhaps investors, viewers who are watching you right now should stay away from till the dust clears, or are there opportunities there?
Yeah, so I think all these three sectors you mentioned have been called out by Trump in terms of having reciprocal tariffs and increasing tariffs on some of these sectors. So I think clearly I think the narrative has changed now in the last 1 month or so, especially on the US growth outlook, right? Some of these Trump policies which are being played out in terms of imposing tariffs, and I think all these factors are likely to impact domestic growth. And we're seeing the data. The labor market is starting to weaken, and I think there are chances now of a downgrade to US GDP growth further from these levels. And I think that is likely to hurt. One is the tariffs. I think if you look at the IT sector, for example, in particular, I don't think the tariffs per se impact on the services side or on the visa side. We don't see much of a challenge. But if the US growth is likely to slow down and the probability of that has increased, then the recovery, what we are looking at next year in the IT sector, and we were fairly positive on the IT sector around, say, 3 months back or 6 months back, and we have been carrying that kind of an outlook. But I think in the context of the recent developments, I think one would want to wait out, because we are seeing the commentary is slightly starting to weaken. The discretionary spend, which is supposed to come back, I think that could get delayed. Also, dollar strength, okay, which was kind of supporting some of the exporters. I think that is also, I think the outlook there, okay, if US growth slows down and there are Fed rate cuts, then you could see the dollar kind of weakening, or rupee also, which was kind of depreciating. I think that could normally, you can even see some appreciation over there. So all these factors need to be considered, and that's the reason why I think one would be a bit cautious. Having said that, I would say the IT sector still looks to be a fairly decent. I mean, the downgrades, what we are looking at in terms of growth, is probably 1 or 2 percentage points. It's not like a big difference. And if there is a correction and valuations normalize, I think the sector still looks to be reasonably good, because I think the whole trends towards AI and the spends toward digital over a medium to long term, that should continue. Pharma sector, I think clearly, I think the tariff cut, I think the US, we are more positive on the domestic pharma names. I think the big benefit for the US generics plays into the margin improvement, what we saw this year, because of the prices came down, raw material price, and that's going to normalize. So, and with the imposition slightly uncertain in the US, domestic pharma is where I think is a place where one can safely hide, is what I would say over there. And the auto sector also, I think, I mean, some of the exporters, auto ancillary companies will have to see how the tariffs play out over there. But clearly, if the US domestic growth is weakening and the auto sector is weak, I think you will see some kind of concerns there for auto exporters. On the domestic auto, though, I would say that we are going through a slightly weak phase. But if some impact of consumption, the discretionary consumption comes up, I think you could see some recovery there in the auto sector sometime in the second half of this the next fiscal year. So auto, and we already seen a decent correction in the auto stocks, right? So I think that sector, especially the OE and the domestic OEMs, can be a good place to look at.
How are you feeling about financials right now, Mahesh? I mean, some regulatory headwinds there. Overall, structural issues like cost of deposit, etc., NIM pressures continue. But in the longer term, do you think it's a safer bet?
So financials, again, we've turned, positive on that since the beginning of this calendar year. Again, a couple of reasons. Okay, the lens, what we look at it is valuations first, okay, which were definitely reasonable compared to where the market was, but also ownership, right? We've seen a huge amount of selling in financials by the FIs in the last one year or 1.5 years. So ownership levels are low, and on the regulatory side, right? Banks underperformed last year because there are a lot of regulatory headwinds which were there. A lot of these LDR ratios, the loan to deposit ratios, okay, which were increased. I think we've seen now some easing off on that front. I think the restrictive conditions which were there, I think, are starting to ease off. The deposit growth remains a challenge, but I think if the overall liquidity in the market improves and RBI is doing measures, I think we should see deposit growth slowly coming back. So I think banks, should, while we might not see a very strong growth in the next fiscal year, because with rate cuts, margins will be under pressure, but I think that is there in the price. So at the margin, we see that the banks, especially the large private banks, I think where their growth should be slightly better than the overall industry growth. And we don't see any major challenge on asset quality. I think that could be a reasonably good trade where there is some under ownership, okay, especially from foreigners. Valuations are reasonable compared to the thing. And on the regulatory side, we're seeing things kind of easing off from the restrictive conditions which were there throughout of last calendar year.
All right, thank you for that, Mahesh Patil. Likes financials, IT might still continue to see some amount of pain. Great conversation there, Mahesh. Always a pleasure to speak with you. Thank you so much for your time with us here on NDTV Profit. All right, some breaking news coming in. Following the IndusInd Bank fiasco, sources have told us that RBI supervisors are seeking details on positions on derivatives across banks. Is that right? Vishwanath Nair, first explain to us who are these supervisors who are seeking information, and what is the implication of this news?
Most large banks across the country have somebody called an SSM, who's a senior supervisory manager, who's an RBI agent who looks at the banks closely. Now, these supervisory agents are responsible for day-to-day supervision of how banks are functioning and whether things are going according to the rules that have been set up here. What we are understanding from sources is that these SSMs are asking banks to submit specific compliance reports. Every quarter, they're supposed to submit a compliance report already, but specific compliance reports on where their foreign currency borrowings are, how much of that has been converted, what portion of that has been properly hedged, what portion of that is currently in mark-to-market losses or profits, all of these details, and whether all of this is in order with the existing regulatory framework, the RBI seems to be asking these banks. That is what our sources are telling us. Now, this is obviously coming on the back of what has happened at IndusInd Bank, where the bank said that there were certain positions on its bank which it discovered only in October, and that's why it's going to make certain provisions during Q4. 1,520 odd crore pre-tax or adjusted for tax. That's what the management is saying. The market estimates close to 2,000 odd crore. So we need to see whether other banks also fall under such open positions, such gaps on their derivatives portfolio, and if they do, then what kind of provisions they will be required to provide. My sources are telling me, however, that most banks are not in such a situation. In fact, they are very clear how exactly they are going to hedge their positions, and the quality of the hedge is perfect to address any market shortfall. Of course, there will be M2M losses when the rupee depreciates to a certain extent, but a 2,000 crore loss is significantly large and most likely is limited to IndusInd Bank.
Okay. Wow. So just to get a sense of is the derivatives portfolio that significant for any of the large listed players that we know of?
It is. So IndusInd Bank alone ran a derivatives portfolio with a notional value of 15 lakh crore, right? And IndusInd Bank is probably number 5 in the private sector banking space. So you can expect most banks have a large derivative position. Having said that, highly unlikely that most banks are sitting on these massive losses which may affect their quarterly reports.
Most specifically, massive losses that they did not know about and they have suddenly discovered.
So that one's a bouncer actually, because I was talking to a senior banker at a private sector bank, a bank much larger than IndusInd Bank, and they were saying that the rules have not changed. Firstly, the RBI has not outlawed any specific kind of a transaction, so they are not sure what clarifications IndusInd Bank is providing. Having said that, even if there was a loss, the minute you find the loss, a loss is a loss. So you account for it and you move on. And if you found that in October, then the December quarter results should have accounted for that loss. Why has this been pushed to March? Anybody's guess at this point in time.
Okay. Lots of questions there on IndusInd Bank and more. We're going to be following the story and a lot more coming in on that. Thanks for that for now, Vishy. Market still on a bit of shaky ground. Some recovery actually in financials, IT having a tough time, but interesting morning to look out for, Neeraj.
Yeah, most certainly. And just a shout out, by the way, just before we wrap up. I mean, Vishy's been on top of this IndusInd piece since the last 36 hours. Not just because he's my colleague, but Vishy, fabulous work on that front, really.
Thanks for that,
and yes, a bit of a worry for the markets, more by IT, not so much by banks, which is the interesting piece. We wrap it up on this level of India Market Open. But up next is Ask Profit, where you can ask all the questions that you want to for specific stocks, including maybe IndusInd Bank.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the trading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the trading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit Conclave, which is themed.
Hello and welcome. You're watching Ask Profit on NDTV Profit with me, Somit Sarkar, and my co-anchor Ruja. Well, the market seems to be quite range bound for the last 4 trading sessions. The Nifty is down around 0.3%. The small cap index is outperforming while the mid cap index is underperforming the benchmark.
Definitely, Somit. So again, this day seems like a bad one for the markets. The Nifty actually is below 22,500, and right now, as we speak, down about 0.3%. IT is the worst one, doing bad, 3.5% down, while those which are doing good, if we can pull up the sectoral heat map, we'll see Nifty, banking index, finance, auto, oil and gas are the ones in the green right now, but we have media, realty, pharma, PSU, metals, all in the red. Banking names as we go, yes, there you are, but let's also look at the advance decline ratio. Advance is to decline is 1:1.4%, but also let's look at the constituents which are driving the Nifty 50 index. Well, down in the red we have most of the IT, in fact all the IT names, Wipro, Infy, HCL, Tech, Mahindra are the ones which are weighing down heavily on the stock. But on the positive side, we have banking names. So it's banking versus IT in this day of trade. HDFC versus Kotak Mahindra. Tata Motors also doing well. Reliance after Jio announced its tie-up with Starlink. But also in case of the Nifty IT, as I mentioned, all the stocks in the red, including the top tier names, but the worst losing ones is Infosys, down about, Infosys and Wipro down about 5%, and those which are losing the least is TCS and Coforge. So definitely a bad day for markets.
Well, yes, the market's been dragged by the Nifty IT index, and let's welcome in our guest for the show today, Nirav Asher from Head of Equity Research, Latin Manharlal Securities, and on the technical side we have Vaishali Parekh, the Vice President Technical Research from Prabhudas Leathers. So starting off, the first query coming in from PK Mahapatra from Bhubaneswar. He has around 1,000 shares of Infosys purchased at a price of 1,270 rupees. He purchased these shares back in September 2021, and he wants to know when should he offload or sell these shares. So Nirav, coming to you first, how's Infosys looking like on the fundamental side?
Good morning and thank you for the invite. I think IT shares have been under a lot of pressure at this point of time, and this is purely attributed to the global scenario. And we have seen the frontline stocks, especially TCS, Infosys, bear the brunt in the markets. HCL Technologies has been doing reasonably well. I think the advice as far as Infosys is concerned, it's advisable to hold from a medium to long term perspective, hope that the market conditions improve, which could have a positive bearing on the stock.
Vaishali, how's Infosys looking on technical front?
Very good morning to all of you. So I think Infosys has come to a previous support, 1580 acts as a prominent support. So if this support breaks, then I think this can go further down towards 1520 to 1500 levels. So if depending on the time horizon that he is trying to hold, if it's a trading strategy, of course, he needs to exit if the levels break. But if for a longer term perspective, I think the downside is limited.
Well, next up is a caller query. We have Ekam Barya from Hyderabad who's holding IRFC 300 shares at 160 a piece. Vaishali, what do you think about IRFC?
So IRFC, of course, this too has seen very good corrective move. And now I'm looking at the weekly chart. I think right from 220 to come to 50% erosion and also sitting on a 100-period moving average. So I would say keep a stop loss of 108 and right through this can give a bounce up to 140 for now.
Thank you, Ekambaria, for calling us from Hyderabad. The next query is coming in from Bhaskar from Tamil Nadu. He wants to know whether is it a right time to buy Hindustan Copper. Nirav, any views on Hindustan Copper?
Well, at this point of time, metals have been a bit wobbly in trade, so I think it's better to keep away from Hindustan Copper for the time being.
Okay.
Okay, well, our next query is on Hindustan Copper. Okay, but I think we're done with that. Okay, let's also take a call on Dabur. We have a query who's asking about long-term outlook on Dabur, and he's also asking whether Dabur is looking good versus Marico. Vaishali, if you can take that.
So I think overall, I would say FMCG counter should be a safe haven right now. And even for a longer term perspective, we have seen good erosion. So I would say Dabur is good right now. But if you're asking me to compare between Dabur and Marico, I'll just have a look. I think Marico is in a better place stock. It is getting into a trend. So I would say that Marico can go into higher targets faster. So yes, that is the favorable pick right now.
Right, the next query is coming in from Bala Subramaniam from Pondicherry. He has around 950 shares of NHPC bought at a price of 88. He wants to know, Nirav, what should he do with this holding? Should he continue to hold this counter or exit at current levels?
Well, at current levels, it is advisable to hold from a medium to long-term perspective.
Okay, well, thank you so much. We have another query which is coming in from Satya. He's asking about the long-term support and resistance for ITD cementation, and he's holding from 100, and he's also asking whether he should book any of those. So this seems to be on technical. So Vaishali, if you can take that over.
In my opinion, the stock is showing a lot of strength in spite of all the choppiness. And since a very long time, it is in a very long consolidation. So that implies that there is something really happening in the stock. So I would say keep 520, 510 as a support level. And since 2 days, we are seeing that there is some momentum setting in and good volume coming up as well. So for now, 560 acts as a hurdle. Once we see the stock moving above 560 and sustaining above, I think this could go towards 700 levels also in times to come. So in my opinion, this should be a hold.
Right. The next query is coming in from Ram Krishna Sagar from Bangalore. He's holding around 309 shares of Indraprastha Medical bought at an average price of 463. He wants to know whether is it advisable to hold this counter for long term. Nirav, have you tracked this counter, Indraprastha Medical, not chemical, sorry?
Yes, actually there is a good, at this point of time, hospital stocks and healthcare related stocks have been the flavor of the markets. So I think it is advisable to hold Indraprastha Medical from a medium to long term perspective.
Right. On to an NDTV Profit exclusive. More rows was seen for IndusInd Bank. The Department of Finance, Financial Services under the Ministry of Finance has now taken stock of issues related to IndusInd Bank. Shrimi is joining us with more details on the same.
Yeah, so DFS has recognized the issue at IndusInd Bank, which mainly include accounting discrepancies, governance challenges, and the leadership concerns as well. What sources told us that the department is working closely with the central bank, the Reserve Bank of India, to examine the entire matter thoroughly. And the main concern is to sort of ensure the stability and integrity of the financial sector amid this entire challenges, to see whether it's not spreading across the sector or not. So the ministry is ensuring that. They are also sort of examining and trying to get a sense on the governance structure of the IndusInd Bank, and whether the leadership concerns is being addressed or not. So they are in touch with RBI, is what source is telling us. And specific attention, I'm told, is given to the accounting practices to resolve if there is any irregularities there. And Department of Financial Services mainly checks the functioning of the banking system, is aiming to, of course, reassure the investors and public that necessary steps will be taken to safeguard the interest of all stakeholders. So, in a nutshell, DFS is at this point, trying to sort of address this point, taking stock of this, and trying to sort of prevent and understand if there is a similar issue in the other lenders as well. So we are keeping a close watch on this ongoing development at the policy corridor, and we may see some review meeting also happening this week itself. Back to you.
Right. Thank you, Shrami, for that exclusive details coming in on IndusInd Bank. Well, Nirav, coming on to you, any views on the recent developments that have happened on IndusInd Bank? If any investor has been holding IndusInd Bank at higher levels, should he continue to hold on to this counter?
Well, initially the first thing that the first impressions among the investors was that it's available at a very, very reasonable valuation prior to these developments. And I think now that trust too has been broken. We have to understand that markets are very, very, very sensitive and unforgiving with respect to such developments. Now, yesterday, what has happened, we need to clearly evaluate whether this is a professional lapse or is it something which has been done out of some willful malpractices, etc. So I think apart from that, RBI will try to find out the systemic impact of this development on the other banks. And if I were to just recall, there was one private sector bank which had exposure to very, very toxic derivative instruments, and the stock was very badly punished by the markets, and it took several years to set the house in order. So I think this is something which we need to learn out of. And I think it will be a very uphill task as far as the IndusInd Bank is concerned, as far as the current developments go.
Okay, well, yes, that's the trending stock recovered 5% up over there. But we have a caller coming in, Sachin for Kerala on trend. Sachin, what's your query?
Yeah, my query is regarding a good level to enter trend. I feel it is a bit overvalued still, so I would like to know if more downside would come and what would be the correct level to enter trend, and then outlook for 1 year perspective.
Okay, for 1 year, I think, I'll go to you for that.
This is for me?
Yeah.
Yeah. Well, actually, I think Trent has a lot of growth potential going forward. So I think it's necessary to keep the faith. And stocks like Trent always have to be accumulated on dips. So the advice here is to start accumulating in dips with a medium to long-term perspective. We are already beginning to see some signs of life in consumption-based stocks. Yesterday, we saw Phoenix Mills move up in trade. We had ABFRL, which has started moving up in trade, and of course, Trend is also showing some good momentum.
Right. The next caller query is coming in from Dheeraj from Hyderabad. Dheeraj, good morning. Thank you for calling us. You can go ahead and ask your query now. Dheeraj, you can go ahead and ask your query.
Good morning, sir.
Right, Dheeraj.
My query is regarding Jupiter Wagons. Hello.
Yes, Dheeraj, you can go ahead and ask your query.
I'm holding 505 shares of Jupiter Wagons at 502 rupees a piece.
Right, and you want to continue holding this counter for long term?
Can I average its current levels, or should I exit the counter and shift to some other space for the next 6 months?
Right. Okay. For the next 6 months, then I'll come to you, Vaishali, for this query. Any views on the technical front when it comes to Jupiter Wagons? Should he average at current levels or exit?
No, I would not say exit because it's really beaten down and there's nothing wrong with the stock. So I would say wait for some time. Even if it dips up to 250, there's nothing much to worry about. 250 is a level to start averaging the stock if at all it does. And hold on, at least wait for a bounce up to 450. There we can have a relook.
Okay, well, thanks for that. Well, our next query is for Spandana Spurti. Here, our query is coming in as he is took the 23 quantity at 1010 a year back. He's asking for a long term here over there. Can he hold for 1 or 2 years? Whether he should average this one, as we can see, our viewer is around 17,000 loss. So 1 year or 2, Nirav, if you can give us a call.
Well, I advise to exit the position and go to a better quality NBFC, switch to a better quality NBFC, maybe a Bajaj Finance would serve the purpose.
Okay.
Right, the next query is coming in from Vijay Kirti from Tamil Nadu. He's holding 550 shares of REC. Currently, he's incurring a loss of 32% on his holding. He wants to know whether should he book his loss and switch to any other good stock for long term. Nirav, any views on REC? Should he continue to hold with a loss of 30%? And if not, any other stock that you would recommend at the current levels?
Well, the stock, the loss is substantial, but I think it would be advisable to hold on to the position because power sector is doing quite well, and these two are apex agencies, Power Finance Corporation and Rural Electrification Corporation. So I think it's advisable to keep the faith and stay invested.
Okay, keep the faith and stay invested. That's the word that is coming in. But we have a caller query. Pawan from Bangalore. Please go ahead, Pawan.
Sir, I've bought Cochin Shipyard at 1302. For around 500 shares, probably at 6,51,000 or something. My query is, I am ready to hold it for this year end. Will I be able to get? Will the stock be able to get somewhere near 1,700 or 1,800? Is my query. And when will this bear market end? That's my.
So that's a very difficult call to say, but yes, let's go on to Nirav. 1 year perspective, around 13,000 loss. What do you suggest?
I would advise you to widen your horizon a bit because market conditions have not been exactly very good, and I think there's a lot of pressure on margins. Executions have slowed down a bit. So it might take a little bit more time to reach that kind of return trajectory which you are expecting. But I think it's advisable to hold with a slightly more horizon.
Right. The next caller query is coming in from Dinesh Dua from New Delhi. Dinesh, good morning. Thank you for calling us. You can go ahead and ask your query now.
Good morning. Thanks for getting me on the channel. I bought 50 shares of Coforge about 2 months ago. At the rate of 9,000, the share went up significantly for the first 1 week, but then thereafter there was a big meltdown. I'm currently suffering a loss of 81,000 rupees. Should I sell it and arbitrage it for some other shares, or should I hold on as a long-term investor?
Right. Nirav, any views on Coforge? Should Dinesh continue to hold the 50 shares of Coforge that he's holding, or should he exit and buy some other stock?
Yes, I think you should hold on to the position. I know that the losses are quite high, but I think it's important to keep the faith and hold on from a medium-term perspective.
Okay. Next one is on PB Fintech. Actually, our viewer is asking, how does PB Fintech look on charts? Currently, he's not bought any of the stock. But Vaishali, how are technicals looking like in this one?
So technically, we have been seeing a good consolidation. 1350 acts as a good support. So unless and until we see the stock moving above 1500 levels, I would say it's a sideways move. Keep 1350 as support and 1500 as resistance. So anywhere close to support, you can go and buy the stock and wait for a resistance of 1500 to be crossed. There could be a confirmation of a further upside.
Right. The next query is coming in from Satish from Chennai. He wants to know the long-term view on Dalmia Bharat. He's currently holding 50 shares of this company, bought at a price of 1,885. Nirav, any views on Dalmia Bharat?
Well, yes, this company is amongst the lowest cost producers of cement in the country, and I think with the prospects of the cement sector slowly improving, I think it's advisable to hold.
Okay, our next is a caller query, Kumar from Tamil Nadu. Hi Kumar, what's your query on?
Yeah, good morning. Thanks for accepting my call.
Yeah, please go ahead.
Yeah, I bought a Bharat Electronic shares, 500 shares of 283 rupees. So last week. So I'm looking for a short term. So whether the fall will go up or down, I want to know. Like what will be the short term perspective? What will be the target price I can wait for? So I just want to know about this.
Okay, a short-term perspective on this one. Vaishali, what's your take? Our viewer seems to be in around 300 rupees of a loss. What's your take?
Sure. So short term 280, 290 acts as a resistance and 260 acts as a support. So upside is limited from here on because he has bought it much higher in this market. So I would say keep a stop loss of 260 to hold for 280, 290.
Right, the next query is coming in from Kumar from Visakhapatnam. He's holding 1100 shares of Heritage Foods, bought at an average price of 330 rupees per share. He wants to know whether should he continue to hold this counter or exit at current levels. He can hold the counter for the next 3 to 4 years. Nirav, have you tracked Heritage Foods?
Yes, I think basically dairy stocks have been in flavor. The prices of milk products have been going up consistently. Value-added products have also been doing quite well. So I think the Heritage Foods has got very good long-term prospects. So it's advisable to hold.
Okay, our next one is a caller query. Sandeep from Hyderabad. Hi, Sandeep. Good morning. Go ahead with your query.
Hi, Risha. This is Sandeep. I'm from Hyderabad. I'm holding 13,000 shares of Canara Bank at 86.5. So the Canara Bank is consolidating at 82, 83 levels. I just wanted to understand whether there is a possibility for the next up move in next 3 to 6 months.
Okay, next 3 to 6 months is the horizon that Sandeep is looking forward to, loss of around 48,000. Okay, so what do you suggest, Vaishali? Are the technical charts indicating a hold or a sell?
So right now the stock is of course in a downtrend, but near-term support is 80 and 78 would be the final support. So I would say, well, there is a lot of panic. It is not a trader's market right now. If you are having 3 to 6 months, kindly hold for some time. There could be some stability in times to come, and let's wait for a bounce. Right now, it is not a time-stipulated market. You have to wait for market to stabilize.
The next caller query is coming in from Paramjit from Himachal Pradesh. Paramjit, thank you for calling us. You can go ahead and ask your query.
I'm having 400 shares of Landmark Cars at the rate of 421.
Right, and you want to... Yeah, please go ahead.
Long term as well as short term view.
Okay, Nirav, coming to you first. What's the long-term view when it comes to Landmark Cars?
The Landmark Cars is one of those few companies which are related to the auto sector, and they are exclusive franchisees for a lot of companies. So in a way, it is a kind of a concept stock. So I think one should hold with a medium to long-term horizon. Valuations seem to be pretty reasonable at this point of time.
Right, and Vaishali, how's Landmark Cars looking like on charts?
So we have seen good erosion, like the recent high was 660 and from here on it's consolidating at 400. So I would say keep 400 as final support to ride the stock, and maybe in good times we may see a bounce at least to start with for 520, 550. So 400 should act as a support.
Well, that was the view coming in when it comes to Landmark Cars. With that, let's slip into a short break and we'll address more of your queries post that.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
Welcome back. It's time for NDTV Profit Deep Dive, and we'll talk about a stock that has caused a lot of pain to investors in the last 3 months. Well, I'm talking about Vascon. It has dropped over 35% in 2025 due to various issues. Anushi, who tracks this closely, joins in with more details.
Right, thanks for that, Richa. So if you look at what's happening at Vascons and Engineer, despite the kind of correction that we've seen in markets, there are a couple of points that we would like to highlight as to what is happening with Vascon Engineers. Firstly, if you look at the stock price, it did hit a 52-week high of about 84 rupees in July 24, but from then on, from those peak levels, we've seen a 60% of a correction from its 52-week high if you take the current stock price in consideration. But let's look at the overall picture, the company's fundamentals to see how that is shaping up. So the business has divided into two segments, which is mainly the real estate and the EPC segment. So if you look at the order book of the company, so in order book was about 2,109 crore, which was about a 4 times its revenue. Book to bill ratio was in that range. We've seen that in FY22, FY23, there was growth coming in terms of where the orders were with about 2.8 times and 2.1 times the ratio. In 9-month picture, we are seeing an order book of 3,179 crore. Last 2 periods, we are seeing almost 1,026 crore, the revenue figure that we are looking at. It's based on the last 12 months trailing figure as we speak. So it's 3.1 to 3.2 times is the kind of book to bill ratio that we see for the company. But let's focus on the real estate, on where is that happening. So what has happened is that in so far the year, the company has recognized lower revenue in their real estate business as the company follows a percentage completion method. So that is where, and this is on account of several clearance issues which have been highlighted by the company, because of which there's lower revenue recognition. However, for FY26, they are seeing acceleration going forward for this in terms of where the real estate business is concerned. But to just get a segmental revenue breakup, so now because of the percentage completion method, we do see an overall changing mix between the real estate, EPC and the GMP. GMP is their subsidiary in which now they have divested their stake. So while it contributed to around 27 to 28% of stake in FY21 to 23 periods, from FY24, from this 9-month figure, we are not looking at a mix as the company by the quarter end has now divested their stake in the company, and currently about 4% of their business is from the real estate so far and 96% from EPC, which is in a sharp contrast to the 65% and 9.5% of mix that we'd seen earlier. In fact, if you look what is happening, the company, while earlier they had said that they'll be exceeding their revenues in terms of FY25, now they maintain that the revenues for the fiscal would be in the similar range. So we have seen that despite the divesting stake in GMP Technical Solutions, from which they will get a consideration of about 155 to 157 crore, now the revenues for this year would be the same as last year before, without the subsidiary being there as well. But it's from FY26 onwards that we can see this number moving upwards. So even if you look at the margin picture, so now again, because the revenue recognized was lower this year, we are seeing at a negative margin of about 19% as compared to 25% last year. So there is a fluctuation in margins as we speak, but in EPC the margins have remained more or less stabilized around 10%. But let's point out the key concerns which are there on the street and why this is happening. So firstly, on the revenue bit, if we see, the first guidance given was to exceed the 1,053 crore mark, and they said that FY25 would be a much better year than FY24. But now they maintain that the numbers, considering what has happened in the first 3 quarters, now the numbers would remain more or less in the FY24 range. Even if the company was earlier coming up with a QIP till the first quarter onwards to invest those proceeds into their real estate projects, but now the board has put that approval on hold because of the market conditions which are shaping up, and the management does not want to dilute his stake in these prices which are currently going on. So for that reason, they are going to be raising short-term debt for the following and would be growing from that onwards. However, on the management view forward for the company, they expect a 20% growth in the EPC business for the next 3 to 4 years. Along with that, they see a 1,500 crore of a potential in revenue for the next 3 to 5 years onwards. Now, if we consider the FY24 figure, that already stands at about 1,000 crore. So while there was growth earlier, we are seeing this number going down slightly in terms of where the percentage is concerned. Also, they are eyeing to raise about 125 crore through debt now as compared to QIP, which was the plan earlier. Coming to some of the key concerns which are now going to be mentioned, firstly is the real estate business, in which we saw lower revenue sales. Along with that, another factor is the QIP plans which have not now been put on hold. So the question is on the short-term debt and what the debt picture is going to be forward for the company. So this is one concern. Another one is so far we've seen about 500 crore of order inflows being achieved for the company. So the emphasis falls on the fourth quarter to achieve the target of 1,000 crore that they have given. So fourth quarter is a significant one in terms of the order guidance for the EPC business. That is their concern. And along with this, there are some environment clearance issues that they are facing in the state of Maharashtra, which is the segment in which they want to proceed in real estate segment going forward. So if the environment clearance clearances do not flow for the company, the recognition or the revenue and the launch pipeline they have would be affected for FY26 onwards as well. So if these points are in consideration, then these are some of the key concerns which are seen by the street, and this is the overall picture that we are looking for Vascon Engineers.
Well, thank you, Anushi, for that detailed link. Now, to know more about the company, stay tuned into our flagship research show, Know Your Company, at 11:30 today. We speak to Siddharth Murthy, the Managing Director of Vascon Engineers. Well, moving on and taking our next query on the show, it's from Rohit. He's a long-term investor. He has around 900 shares of IDFC First Bank, bought at a price of 72 rupees. He wants to know, can he average these shares today? And also he wants to know whether is it a good time to buy VST Industries. Nirav, coming to you firstly, what's your view when it comes to IDFC First Bank? Should he buy more at current levels to average the share prices?
No, it's not advisable to average at this point of time and just stick to the original holdings. And as far as VST Industries is concerned, yes, it's a compelling buy at these levels.
Well, thank you so much for that. Let's move on to our next query. Our viewer has 5,500 shares of Munjal Auto and an average price of 60 rupees. He's not mentioned the kind of tenure, but I'll go to you, Vaishali. What do you think about this one?
You're asking me about Munjal Auto. So I think, actually, all these stocks have really got a good beating. And currently, they are just in oversold zone. So I think now the downside is quite limited, but I would say keep a stop loss of 65 because that was the recent low that this stock had witnessed. And I think there can be a possibility of a bounce coming up to 80-85.
Right. The next caller query is coming in from V. Murli from Bangalore. He wants to know whether is it... Okay, actually, V. Murli, you can go ahead and ask your query.
Yeah, good morning, sir. Thank you for taking up my query. I want to buy at today's rate of 4,435 TCPL Packaging Limited, which is doing extremely well even in when the poly packaging industry is undergoing some slowdown in the last 2 years. Okay? And it is in the Chennai plant has been commissioned recently on board. Can I go ahead and invest today, at least with 12 to 15 months view?
Right. And how did you come up with TCPL Packaging?
I am observing this in 78 rupees for for many years. Right. But the growth is phenomenal. The last 1 year it has doubled. It's unbelievable. I didn't believe in the story initially compared to Polyflex and other things. But this company seems to be doing differently. Okay. So I thought whether I can venture it.
Right. So Nirav, coming to you with... right. So Nirav, coming to you with TCPL Packaging, the stock has already doubled in the last 1 year. Do you see more value at current prices?
Well, I think we've seen a fast and furious growth in the company, and I think what happens is that when there is such fast growth, markets try to discount a lot of things way ahead in advance. So they would already be starting to look at FY27, FY28 earnings and discounting the same. So I think it's always advisable to go a little slow, wait for a correction in the stock, and then only enter with a medium to long term perspective.
Okay, well, thanks for that. Our next query is coming in from Dinesh. He's asking on Steel Authority of India. He is already holding 500 quantity at 96 and standing around 5,000 of profits. But he's asking whether he should add more pieces or not. So what's your take, Vaishali, on this one?
I won't say add right now because market is just somehow holding on. There is no clarity that we have bottomed out. But I would say, wait for some stability and no problem adding at higher levels. But right now, in all likelihood, it can reach as 100 levels. So, that would be the level to average out.
Right. The next caller query is coming in from Atul from Mumbai. Good morning, Atul. Thank you for calling us. You can go ahead and ask your query now.
Yeah, hi, good morning. Thank you. I have some shares accumulated for Larsen and Tubro, around 148 of them. I accumulated since 2020. My average price is 1769.38. My question is, what should be my approach to hold these shares or to buy or to book some profit? What will be your guidance on that?
Right. And if you want to hold this counter, then how long can you hold it?
I can hold for another 6 months to 1 year time frame, should not be an issue.
Right. Vaishali, coming to you first, do you see any upside when it comes to L&T for the next 6 months on charts?
The trend is down right now, so I think it is just a range of 3,000 to 3,200. So I would say no harm booking partial profit, and if it gets lower, you can add.
Nirav, what would be your view when it comes to L&T from long-term perspective?
Well, stocks like L&T are not meant to be sold. So I think if you don't need the liquidity, it's better to hold on.
So much for that. Our next query is from Dharma from Andhra Pradesh. His query is on Praj Industries. He owns about 82 shares at 615 rupees, and he's asking an outlook for the stock as well as the sector, and it's a bit of a long-term horizon, 2 to 3 years in terms of fundamentals. Nirav, this one is for you then.
Well, very strong and exciting prospects as far as Praj Industries is concerned, but the stock has been going through a bit of a downturn in the current down cycle. So advisable to start accumulating on dips with a medium to long-term perspective.
Right. The next caller query is coming in from Krishna from Kerala. Krishna, you can go ahead and ask your query.
Yes, sir. I'm holding CDSL, quantity of 500.
Right.
And I bought it at an average price of 1157. So I want to know both the short-term and the long-term perspective.
Right. Vaishali, coming to you first. What's the short-term view when it comes to CDSL?
1050 is the near-term support, but I think it can go to 950. That would be the level, and I think that would be the level that you should start buying, adding more.
And Nirav, how's CDSL looking from long-term view?
Well, it is a portfolio stock and it should be accumulated on dips.
Right.
Okay, thank you so much for that. Our next query is from Chandan Jain, and he's asking on BSC. If BSC is the one which has been very volatile over the last couple of sessions, our viewer is a long-term investor. He is actually looking forward for a long-term perspective. BSC at 2,600 is what he's bought, around 85 shares, and good amount of profits over here. So what do you think of this one, Nirav?
Keep the original holdings and keep accumulating this stock on dips. Keep averaging on dips.
Okay, averaging on dips. Vaishali, quickly over to you on this one.
So I would say, well, the trend has been weakened. It was a sell call from our side for 3,800 levels. The target has been met with, but if it sees further erosion, I think it can go towards 3,300. That is the level to add more.
Right, the next query is coming in from Harshad Parekh, and it's on Jyoti CNC. He wants to know whether one should average this counter at current levels. He hasn't mentioned how many stocks he holds, but any long-term view on this, Nirav, Jyoti CNC?
Well, the company is quite good, but the valuations are very, very stretched. So I would not advise averaging at this point of time.
Okay, well, thank you so much for that. Now, next query is from Girish. He's a long-term investor. He's recently bought Gujarat Pipavav Ports at 143 on the basis of healthy valuations. He's bought about 300 quantity, and he's asking whether it is a good buy for the long term. Nirav, if you can answer this one, please.
Yes, the company has embarked upon an expansion program also. So GPPL looks very good. Gujarat Pipavav Port, it looks quite good from a medium to long term perspective.
Right, the next caller query is from Ujjwal from Patna. Ujjwal, thank you for calling us. You can go ahead and ask your query.
Hi, good morning. Actually, I need fundamental view on Nestle India as well as Hindustan Unilever Limited. Which one is the best?
Any one stock, Ujjwal. Which would it be? MapMy India or HUL?
HUL.
From long-term perspective?
Yes, from long-term perspective. For 1 year, 1.5 years.
Right. Nirav, is it a good time to buy HUL for the next 15 months?
I think volume growth has been a challenge for Hindustan Unilever Limited. So I think one can consider the competitors who are more entrenched in the rural markets, who have more exposure towards the rural markets. I think limited volume growth would restrict HUL for the time being.
Okay, thank you so much for that. Our next query is for IOL Chemicals. Well, the stock is our viewer has not mentioned the kind of quantity that he is holding, but he's asking, even he's not mentioned whether long term or short term, but he still holds 500 shares, 68 rupees after the split. So can he still hold, or should he book? Vaishali, if you can answer this one.
The trend is definitely down, but I think it's already seen good erosion. Again, keep a stop loss of 58 and hold.
And Nirav, if you can answer this one, please, since our viewer has not mentioned the horizon.
Well, I think this is a raw material intensive industry, and I think the margins could fluctuate or remain volatile on a quarter-on-quarter basis. But for the time being, it is advisable to hold.
Right. The next query is coming in from Anil from Jalandhar. He's a senior citizen and a retired banker. He wants to know whether can BL be a wealth creator if held for the next 3 years. Nirav, any view on Bharat Electronics?
I think I would not be sure whether it will be a big wealth creator, but I think it can be a slow and a consistent performer going forward.
Right.
Okay, well, thank you so much for that. Our next query is from Rahul from Chandigarh, and he's asking long-term view on Yes Bank. He holds about 1,134 shares of Yes Bank at 17 rupees. Largely, the stock is trading at 16.2. But what's your view on this one, Vaisha? Actually, long-term view, Sunirav.
I think it's advisable to exit the counter and go in for better options. Something like a Federal Bank or IDBI Bank would serve the purpose.
Right. The next query is coming in from Balaji from Chennai. He has around 200 shares of Manali Petrochem bought at a price of 92. He wants to know whether should he average this counter at current levels or just wait or just book losses. He can continue to hold this counter for the next 6 months. Vaishali, any view on Manali Petrochemicals?
I think the stock is consolidating, so I think it's exhausted with the selling thing. So I would say hold on and probably can add more at these levels, because once the stock starts moving, we can see a bounce coming towards 75. So that would be a good view right now to buy.
Okay, thank you so much for that. Moving on to our next query. Queries from Shabina from Tamil Nadu. She holds about 70 shares of VIP Industries at a price of 585 over there, and she's facing about a loss of 20,000. So she's asking whether she should hold, sell, or average this one. Long-term view. So Nirav, over to you.
Well, VIP has been going through a tough phase during the last couple of quarters, but it's advisable to hold and not average. Yeah.
Right. The next caller query is coming in from KBS Raju from Hyderabad. Good morning, Mr. Raju. Thank you for calling us. You can go ahead and ask your query.
Yes, sir. I KBS Raju from Hyderabad. Hello.
Right. You can you go ahead and ask your query?
Yes, sir. KBS Raju from Hyderabad. I have shares of Kotak Bank with 1645, 700 shares. Can I sell today at the rate of 2,000 rupees?
Right. Okay. Vaishali, coming to you. Should Mr. Raju sell the Kotak Mahindra banks today?
I think it's on the verge of a breakout. So wait for 2050. It can go towards 2050. Hold with a trailing stop loss and go for a target of 2050.
Okay, well, thank you so much for that. Our next question is coming in from Hemant from Tirupati, Andhra Pradesh. He is liking to know a technical view. So this one is for you, Vaishali, for HEG. He's bought about 100 shares at the price of 615 rupees, please.
So HEG right now we are seeing there is some bounce back coming in. Near-term resistance comes at 440. So that would be the level to watch. Once it moves above that, then I think it's ready for a recovery. It could go towards 500 levels also. So hold for now.
Right. The next query is coming in from Vinay from Bangalore. He has 32 shares of Bharti Airtel bought at a price of 854. He wants to know whether should he add more at current levels or exit the counter. If he can continue to hold the shares for the next 6 months or next 1 year. Vaishali, what is your view when it comes to Bharti Airtel?
So Bharti has been doing very well over the years. It has totally been unaffected by the market whipsaws. According to me, the way it's going, we have a projected target of around 1800, 1850. And so for now, I would say hold, keep a stop loss of 1600, and I think you will get higher returns.
Okay, next question is from Vipul from Ahmedabad. He's holding shares of Varun Beverages, 70 shares at a price of 657. He's asking for a long-term Nirav. What's your view on this counter?
Well, it's been a disappointment, but I think currently rolling around 480 levels, but the prospects seem to be good. They have embarked upon an expansion plan, so I think he can attempt to average some quantity at these levels.
Queries coming in from Sahil from Haryana. He has 135 shares of Infosys, bought at an average price of 1,342. Given the fact that we are seeing a sharp decline in Infosys, he wants to know whether he should continue to hold this counter exit. Nirav, any views?
Well, I think in the case of Infosys, it is advisable to hold, not make any fresh purchases or not to average at this point of time, but hold with a medium-term horizon.
Okay, our next one is a caller query. Mukund from Bangalore joins in with a query on Sonara Software. Hi, Mukund, please go ahead. Mukund, please go ahead with your query. Okay, I guess he's not connected, but his query was on Sonara Software. He's holding about 430 shares at 560 per piece. Whether he should hold or book the kind of loss that is popping up on the screen. What's your take, Nirav?
Well, it's advisable to hold for the time being because the software sector has been going through its challenges, but it's advisable to hold.
With this, we start our rapid fire show. I would request both our guests to answer the queries quickly on this one. So starting first with Jiffin, he wants to know what are the long-term prospects for MTAR Technologies. Nirav, should he hold or buy MTAR Tech?
Hold.
Right. The next query is from Tom Varghese. He has 200 shares of Power Grid. He at about a 358 price. He wants to know whether should he continue to hold this counter for the next 6 months. Vaishali, any view on this?
I would say hold.
The next query is from Raju. He has 700 shares of Kotak Bank, bought at a price of 1,645. He wants to know whether should he sell this counter today. Vaishali, any view on this?
If it's for today, as I mentioned, keep a stop loss and go for 2050.
The next query is from Rajendra from Chennai. He has 100 shares of Indigo Paints, bought at a price of 1,580. He wants to know whether should he buy more or exit. Nirav, any views on this?
Buy more.
Right. The next query is from Kanak Kothari from Ahmedabad. He has 3,500 shares of Engineers India, bought at a price of 175 rupees. Sell or hold, Nirav?
Hold.
Right. The next query is from Venkat from Hyderabad. He has 300 shares of Zagal, bought at a price of 407. He can hold the shares for the next 2 to 3 years. Nirav, what should he do?
He should hold.
Right. The next query is from John from Chennai. He has 100 shares of TVS Supply Chain, bought at a price of 179. Vaishali, should he hold or add more of this counter at current levels?
TVS Supply, sorry, I'm not tracking.
Okay, the next query is from Ritesh. He's sitting on a 50% loss on Tanla. Nirav, any views on this counter from long-term perspective?
Well, I think it's advisable to hold.
Right, the next query is from Yash from Hyderabad. He has 150 shares of Union Bank of India at 122. He wants to know whether should he add more at current levels. Vaishali, what's your view here?
Add it around 108, 110.
Right. Well, thank you, Vaishali, and thank you, Nirav, for joining us on this Ask Profit edition. With that, it's a wrap on this edition of Ask Profit. Stay tuned and keep watching NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
Hello and welcome. This is KYC, a show designed to show, well, pardon me, this is KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE listed company every single day. Well, today we're talking about a micro cap. This company has a market capitalization of less than 1,000 crores, but there's been a lot of chatter around Vascon Engineers. That's what we're going to talk about today. Now, as I was mentioning, that this one is engaged in the engineering, procurement and construction of real estate construction and development, and it's executed about 220 projects already at the moment, with construction of area of nearly 45 million square feet. In fact, being in focus when it comes to the real estate sector, we've seen a little bit of volatility with respect to the traction and the business for the entire sector. And on account of that, Vascon Engineers is no different. We're going to talk about that in a lot more detail, but for now, it does have real estate projects in key markets like Pune, Nashik and Coimbatore. And moving on, of course, we also have focus in mid-range housing projects. As far as its overall revenue breakup is concerned, in a 9-month basis, we have about nearly 96% of the revenues of the company coming in from engineering, procurement and construction, and the balance coming in from real estate. But do remember, as my colleague Anushi has also pointed out, that it's real estate and the contribution to the real estate sector has been volatile, which is why, at least for the 9-month basis, it's a relatively smaller one, but otherwise it could potentially be slightly larger. That said, as usual, what we do is that we consider all the companies and we actually take them and rate them on several parameters. So we talk about the fundamentals of the company, we talk about the income statement, we talk about the order flows and the order book, the balance sheet, of course, along with that, the cash flows too. And of course, moving on, we also will talk about the shareholding, street credentials and valuation picture, not to forget the outlook. And the reason why we wanted to mention the outlook here is because it becomes a little bit more important with respect to what the company has said very recently. There are a lot of clarifications, and given the size of the company, there naturally will be a lot of volatility coming through. So we'll talk about all of that. But on that note, let me welcome in my colleague Anushi Vakharia, who's also going to join us and shed more light into the company itself. So Anushi, thank you for joining. Let's start by taking a look at the income statement. Some very interesting set of parameters here.
Right. So if you look at always on the income statement side, if you look at the revenue of the year in the last 3 periods, we've seen at a good pickup in terms of where the growth is. In fact, the 3-year revenue CAGR stands at about 28% for the company. FY24, the revenue stood at about 1,053 crore, and this was with their subsidiary contribution as well, which is GMP, from which now the company has divested its stake. So going forward for FY25, now they are guiding that the FY24 number, FY25 revenue number would be the same as what the FY24 number was without the GMP contribution as well. In terms of where the margins are now, FY22 was a COVID year, so we are looking at a lower contribution in terms of margins, and also on account of the real estate contribution also, since they follow a percentage completion method, so the margins of the company keep on varying based on the real estate business. But overall in 23 and 24, we are looking at a mix of around 11.5, and then subsequently this decreased to around 8.1% for FY24. In fact, if we pull up the 9-month picture, we are looking margins again in the range of 7% as compared to 10.5% last year. However, in the 9-month picture, what we are looking at is net profits are about a 98% of an increase, and this is because of higher exceptional items that we've been seeing on account of the company now divesting its stake in GMP Techno, which was their subsidiary to a Japanese firm, for which they got about a 150 crore of consideration. So we are looking at an exceptional item of about 74 crore. So this is the overall income statement we are seeing. 3-year PAT CAGR, if we see Agam, that is also rounding up to about 52%. Yeah.
And what Anushi mentioned in this case is, when it comes to his bottom line, sure, we're looking at the 3-year PAT CAGR around 52%, and for the 9 months ended as well, we're looking at an exceptional element in this case, which is why maybe your profit numbers may not be the best way to look at it. I'd reckon that we will have to look at the operational profitability and the margins thereabouts, and perhaps that will give you a better picture in terms of the returns. But Anushi, we've spoken about the income statement. Tell us also about the kind of order book and how that has grown over the course of the last few years.
Sure. So if you look at the 9-month picture of where the order book stood at, that stood at about 3,179 crore. So what we've done is for the revenue, we have taken the overall last 4 quarters TTM basis revenue, which adds up to about 1,026 crore. So we are looking at a book to bill ratio of around 3 times, which is the similar kind of range that we saw last year as well, which was in FY24. So 3,365 crore was the order book last year. So the expectation for this year is that first half, over the 9 months, we've seen about a 500 crore of an order inflow. The target now is to see the similar kind of an order inflow for the 4th quarter as well, for the company to meet its guidance. So how the order book would shape up at the end of the quarter is something that we'll see. If you go back to the FY23 and 22 period as well, the order book saw growth in the last 3 years. If we see from FY22 to 24, from 1,800 crore to 3,365 crore, how the book to bill has mainly remained in the 3 to 4 times of range is what we are seeing for the order book positioning of the company.
Okay, so that's your overall order book. We'll move on and talk about the balance sheet and some very interesting factors coming through as far as the balance sheet goes as well. So firstly, its net worth at the end of the first half of this ongoing financial year stood at around 1,000 odd crores. Its net worth has gradually increased from around 912 odd crores back in FY23. What's really curious is that if you actually look at the market capitalization of the company, that stands sub 800 crores. Now, this of course is curious. That means that its price to book currently is less than 1. If you look at the cash bank balance, there isn't too much of an issue here. We have pretty steady cash in bank through the course of the last couple of periods that we are considering at least. Let's move on and talk about debt. Is there a big problem in its debt? Not really. So firstly, when it comes to its gross debt at the end of the second half of this FY25, sure, the debt number has gone up. There is no doubt about it. In fact, it has doubled from what we saw back in FY23. Of course, that said, if you just consider this gross debt number with respect to its overall net worth, the gross debt to equity stands around 0.2. There isn't as much cash on the books, so even a net debt to equity will roughly come to just around 0.2. So as far as this balance sheet is concerned, it's in a reasonably comfortable place. One may ask that why is it that the price to book ratio is so low and it's currently sub 1. So it's certainly a curious one, but we're going to try and give you a better picture through the course of the next few variables and parameters as well. But this is as far as the balance sheet is concerned. For now, we'll give the balance sheet a thumbs up because firstly, it's an EPC company, and being an EPC company, its debt to equity is not considerably high. You usually have a number around 1. This one is around 0.2. So it does have some space to go in before we can, start perhaps considering some problems. Not to mention that when it comes to its income statement, the interest component is not considerably high, and hence you have reasonably higher profitability numbers as well. So that's something to consider as far as the balance sheet is concerned. It'll be a thumbs up for the balance sheet. I'll move on and talk about cash flows as well. And as far as the cash flow statements are concerned, this one is a little bit mixed. And the reason here is that while FY23 numbers were very good in terms of not just cash flows from operations, but also net cash flows, which were, of course, positive, and that's plus 84 crores in FY23. That has actually moved to, a negative territory in about 14 odd crores. Look, the difference, in moving into negative is not a considerably high number, and of course, as far as this particular number is concerned on a net cash flow basis, again, it moves in and out of the positive. So again, it's something that you need to consider, and hence I'm going to give this one a neutral stance. I reckon a lot else will depend on what the company does from here on, because as Anushi pointed out, it does have an order book, and if you just go by simple math of 3,000 crore order book and 1,000 crore revenue, that means it has visibility of at least 2 years in terms of execution, provided that there is no growth for the company and it continues to give you the same kind of revenues. So that's something that you need to consider. Overall, a neutral stance as far as cash flows is concerned, but Anushi, why don't you tell us about shareholding as well?
Sure. So if you look at what's happening in the shareholding pattern of the company, promoters now from 31.27% was the stake which they held in September 24, which gradually decreased about 30.9%. In fact, they were also considering a QIP earlier by the first quarter or so, but in Q2 they had put that motion on hold after the kind of stock price movement which they saw. The management was uncomfortable with for diluting further stake in the company given the market pricing environment was for that. So that is on hold right now. Now they're considering more options in regards to raising short-term debt for their internal users as compared to raising through a qualified institutional placement. In terms of where the FII's numbers are concerned, that's the foreign institution buying over your point. It has majorly remained in line, 0.55% to 0.54% decline. DIIs, they don't hold any kind of stake in the company. It's a microcap stock that we are seeing. Majority of the stake, though, lies in the hands of the public, which is in the range of 68%. Agam, you wanted to speak more about this, right?
Yes, actually, I did want to point out that when we spoke about debt as well, about a third of the current promoter holding is also pledged with the banks according to the exchanges. Well, about 28% of the promoter holding, which means on an overall basis, roughly around 10%, is pledged at the moment. So that's something that you need to keep in mind as well. The pledged shareholding, well, the value of it roughly comes to around, maybe 80 odd crores if you go by the market capitalization of around 800 crores. So that's something that you need to bear in mind as well. I'd reckon that considering its overall gross debt currently stands at around 230 odd crores, well, at least a third of that portion is the pledged amount. So that's what we are going to keep an eye on too. But let's move on and talk about what the stock has done. And we must remember that firstly, when it comes to the street credentials, it's been a very, very tough market for microcaps. Naturally, microcaps are the ones which see a significant amount of volatility because liquidity is just not that great in these markets. And if you have seen mid-cap and the small-cap indices come off and correct considerably, then naturally, as far as your 1 year and 3 year returns are concerned, 3 year returns will be good, but 1 year you'll see looking at a 47% decline. Again, it's going to be a victim of the kind of correction that we've seen in broader markets in general. And in this case, Vascon Engineers is no exception. So overall, yeah, I reckon that we would give this one a thumbs down along with the rest. But Anushi, what's interesting now is that because of this correction that we've seen, valuations look extremely cheap.
Yeah, absolutely. Now, if you just compare it with other EPC plus real estate players which are there on the street, comparatively, Vascon Engineer trades at a multiple of 7 times. This is the trailing PE multiple that we are taking. On the other hand, we have something like a Man Infra or rather even PSP projects which trade at much expensive multiples. We are looking at around levels of 20 times and 36 times. So we have cited a lot of reasons as to why we are seeing comparatively lower valuations for this kind of a stock, which is currently in just the range of 7 times. There is price correction as well. Even Agam had pointed out on the book value of the company where it is trading at a much cheaper level. So that's where the peer comparison goes.
I want to also make another mention as far as the peer comparison is concerned. Sure, we're looking at Man Infra and PSP projects in this case, which is the closest in terms of the business model. But we must remember that Man Infra is a 5,500 crore market cap company, and PSP Projects again is a 2,500 crore market cap company, and hence some of these companies do get that premium because of being of slightly larger size. Vascon Engineers will not get that, and simply by virtue of the fact that it is in fact a small cap, and you will have relatively a lot less interest from institutions. In fact, there'll be many institutions which will be mandated not to touch Vascon Engineers because it's a micro cap company. So that's something that to bear in mind as well, whereas that may not be the case for something like a Man Infra or PSP Projects, which is why, or this is also another reason why we're looking at a considerable discount for Vascon Engineering as compared to Man Infra and PSP Projects. But this is as far as your valuations are concerned. We'll perhaps talk about the final factor here, and I'll give you an idea about the the outlook going forward. I can actually talk to you about the concerns specifically. So firstly, we have seen a little bit of a slowdown in the real estate sector. And that's something which has been impacting margins, as Anushi has already pointed out. There are concerns with respect to short-term borrowing, and going in for a QIP is something, once again, which Anushi has also pointed out and spoken about very comprehensively. There are higher order inflows, and the expectation now is, as per the management, is that the execution is expected to pick up. And whether or not there will be more order inflows, if the execution does pick up, then in that case, revenues could likely see a shift of as much as 50% from, the end of the calendar year of FY25, perhaps going into FY26. But it's a wait and watch at the moment. It's going to be something of a challenge. And of course, besides that, the company is facing a lot of challenges with respect to environmental clearances, especially in Mumbai projects. Those are the concerns. However, Anushi, the outlook does look positive as far as the management goes.
So if the environment concerns, the clearances, they flow through for the company, then for real estate business, while FY25 they did point out that real estate is going to be somewhat muted, it's FY26 that needs to be focused on. They are planning to foray in Mumbai and are aiming for a higher mix here. They're seeing a 1,500 crore of a revenue potential as well in the next 3 to 4 years that we are seeing, while the FY24 to 25 picture in terms of revenue growth, we are looking at almost the same number. 26 would be crucial point to how the business would focus going forward. EPC story also, they are seeing about a 20% of growth maintaining for the next 3 to 4 years, which is their largest segment as well. And in terms of where, now the QIP plans are on hold, which they were going to utilize for their Mumbai real estate projects. Now they're going to be raising about 125 crores of short-term borrowings for the same. So this is the overall plan that we are seeing, and how the management is still optimistic on the real estate business, the expansion in Mumbai for redevelopment projects, along with how the EPC picture also pans out for the company. So this is what we are seeing for Vascon Engineers so far. Yeah.
All right, there you have it. So that brings us to an overall rating. So let's see how things are panned out, and maybe then we can talk to the management themselves. So firstly, thumbs up for income statement, order book, along with the balance sheet, and of course cash flows are neutral for reasons mentioned. Shareholding and street credentials not encouraging at all. Valuation picture looking okay, but for many reasons that we've discussed, an outlook is again neutral. So on that note, let's shift focus and hear from the management itself. My colleague Hiral spoke to the managing director, Siddharth Vasudevan Murthy, and here's what he had to say about the company's growth outlook. This is a slice of that conversation.
Mumbai is something that we have been eyeing for a long time now, and we've been trying to identify what would be our sweet spot in Mumbai. And what we realized while we were doing this is that there is no organized player with a reputation and a brand that is playing the redevelopment game, where they're doing under 2 lakh square feet, smaller redevelopment. And we thought that that's a good place to be in. And that's how this has really started into Mumbai. And we have already started work on one of these projects on site, and we are in the final stages of signing the documents on another one.
Okay. So if you have to look at the next 3 to 5 years, what's the kind of potential you think Vascon is sitting on in terms of real estate?
So the work that we already have in hand is around 1,500 crores. Obviously, we will keep adding to this. We are in talks with other societies for redevelopment in Mumbai and Pune. So it looks good going ahead.
Okay. And is it going to be Mumbai in terms of the target, or are you looking at other projects in other cities as well?
So yes, the focus will be on Mumbai and Pune. Pune being our hometown, we would obviously like to do more real estate over there. But yes, we have a small presence in Coimbatore as well, so we'd like to keep that going.
Okay. And with regards to the GDV, what's the overall expected number from the redevelopment projects that you're looking at?
Yeah, so for the first one that we're starting, our our share will be roughly between 250 to 300 crores. And in total, this number will be closer to 600 crores from the projects that we have on hand right now.
Okay, so that's with overall real estate as a business. Now, coming to the numbers that you've given out for the order book pipeline, you're targeting 1500 crores with regards to FY25, and by the first 9 months of FY25, you've managed to achieve around 500 odd crores. How confident are you of achieving the remainder 300? I mean, because we're already at the end, it's just another 20 days for the fourth quarter to get done. So how confident are you for the 1000 odd crores to be done in the fourth quarter?
So for the fourth quarter, I mean, the total that we were looking at this year was actually 1,200 crores, 1,000 crores this year and 1,200 crores next year. The reason for this is that also that we have sold out GMP last year, so we wouldn't get revenues from there. However, last year we did 1,000 crores with around 300 crores coming from GMP, which was our subsidiary. So this year without GMP, we will be doing the same revenue as last year. So it's actually quite good when you look at it that way.
Okay, so 1500 crores is not the number that we should be looking at. It should be 1000 odd crores that we should be looking at in terms of the revenue guidance for FY25.
Yes, 1500, what I mentioned to you was the real estate potential that we have over the next 3 to 5 years.
Okay, okay.
Yes.
And with regards to the current order book, where does it stand right now? Out of that, how much are you completing in the fourth quarter and how much will be passed on to FY26?
Yes, so the order book currently stands at roughly 2,800 crores, the order backlog, and we would be executing another 300 crores in the current quarter out of that. But we already have jobs where we are L1, where we are waiting for the LOIs to get through. So overall, I think we'll be back at around 2,800 at the end of the year.
Okay, so are you saying that out of 2,800, 2,200 odd crores is where you're still awaiting LOIs? Or what portion of the 2,200 odd crores are you awaiting LOIs? And how much of that will be executed in FY26 then?
So we already have an order backlog of 2,800 crores. Those are not dependent on any LOIs.
Okay.
Out of the 2,800 in this final quarter, we'll be executing around 300 crores is what I wanted to mention.
And what about the remainder? What's the execution timeline for the remainder 2,200 which you already bagged?
So these are between 24 and 30 months.
24 and 30, okay.
Yes.
And apart from that, if you see in terms of the margin contribution from all these projects, if you have to look at real estate as well as EPC, we're still in terms of higher single digits right now, right? 14 to 15% is what you've been tracking for EPC, 25% is what you're saying that you will get in terms of real estate. Now, I was just looking at currently, the revenue contribution from real estate is just 4%. That said and done, the reason what we had stated in the third quarter is that the 9 months margins have been lower because of the real estate business. But just a miss in terms of our understanding as to how a 4% contribution can have a major impact in terms of the margins.
Yes, so for our organization, we are following the completion method, which means that we are recognizing all the costs at this point of time, but the revenue is only going to be recognized when we get the occupancy certificate for that project. So even though we have like almost 250 crores of projects under construction at this point of time, we'll only be able to recognize this over the next year or so. So that's the reason why this is impacting our numbers in the balance sheet.
Okay, so by when do you expect your blended margins to be in mid to higher double digit as you're anticipating once real estate starts contributing? From which quarter should analysts look at it?
So in the coming year itself, it will start impacting because we do have a couple of occupancy certificates that are coming in the next financial year. So towards the end of next financial year is where it will start showing.
Okay, well, there you have it. That's the management of Ascon Engineers telling us about all that is in store for the company. But on that note, it's a wrap on this edition of KYC. Stay tuned in. You're watching NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
Hello and welcome. Good afternoon. This is Mallika Mishra and you're watching Markets at 12 only on NDTV Profit. With me is my colleague Anushi Vakharia, who will be joining us for a conversation later in the show. But before that, let's take a look at how the markets are faring. Now, let's take a look at first the benchmarks. The Nifty 50 has fallen from 24,900 levels this morning by 0.5%, and the 30-pack Sensex has dipped by about the same margin, trading around 73,700 levels as we speak at the moment, 73,600 at the moment, in fact. Let's take a look at the broader markets as well, and you would see that the Nifty Mid-Cap 150 is down by 1.5%, trading around 17,800, and the Nifty Small Cap 250 is down by 0.9%, close to 1% down. So it's clearly, the broader market is clearly underperforming the benchmark indices. Let's take a look at the top gainers and losers in the Nifty 50 basket, and you would see that a whole host of IT names are dragging the index down there. You have a lot of stocks like Infosys, Wipro, TCS are all down between 5 to 2%. In fact, Nifty IT has fallen by over 20% from the record high it made back in December. Tech Mahindra, Axis Bank, Nestle are adding pressure too. Let's pull that map again to see what is gaining, and you would see that a couple of names like HDFC Bank, Kotak Mahindra Bank, then there's Tata Motors, IndusInd, others are trying and pulling up the market. Speaking of the gainers, speaking of, the larger picture, let's actually look at the Nifty Metal Index also, because Trump tariffs have come into play. There's 25% tariffs imposed. He's announced to impose 25% tariffs on aluminum and steel imports to the US. And as a result, you would see that all the components in the Nifty Metal basket are low, dragging down the market. That's APL Apollo, GSL, SAIL, NMDC. Welspun Corp is just about in the green, modestly trading at and gaining about 0.13% at the moment. Now, let's get the sectoral map on the screen as well to take a glimpse of the top sectoral losers this afternoon. And you would see we have IT, we have realty, we have media, metals, of course, because of Trump tariffs. All of these low and cracking. Bank and finance are seeming to show some kind of modest strength at the moment. Lastly, let's take a look at the market breadth as well, determined by the advanced decline ratio. And you would see close to 3/4 of the stocks at the moment are declining in trade, with only about 663 or so advancing. So clearly indicating that market breadth is skewed in favor of declines. But moving on, we have Ghulam Zia, Senior Executive Director at Knight Frank India, to talk to me and my colleague Anushi Vakharia, who closely tracks the real estate space, about what's happening with real estate at the moment, what has happened, and what will happen, hopefully. Welcome, sir. I would first want to know, of course, Anushi will help me dive deeper into this, but my first and very forefront question to you would be that we have noticed that there has been a change in trend of the demand in the real estate sector, where premium housing, luxury housing has taken, like there's more favor and favoritism towards these segments. What do you think, how could governments push towards affordable housing, help big real estate giants like Brigade and Lodha Group, make houses for the middle class as well?
Thank you so much, first of all, to call me on this platform, and a good afternoon to you and your viewers. It's a very, this question is discussed all over. Last, I would say, couple of months, everybody's talking about why affordable housing is not where the top developers yet focusing. Somewhere in October, Pradhan Mantri Awas Yojana, in its new avatar, 2.0 as they call it, was launched in 2024 October. And after that, the new scheme has come out with lots of initiatives to ensure that affordable housing market is bouncing back. However, while government is doing enough and more to ensure a level playing field and to attract developers into that domain, government itself has promised to construct 1.24 crore houses in next 5 years block for the PMA 2.0 to be active. Now that still leaves almost about equal amount of houses to be created by private players. So that number is huge. If you look at next 5 years block, you will need about 2.5 odd crore houses. That's the demand for affordable housing. Now developers are not yet coming on block for the simple reason, for them it's the low hanging fruits. And as you started saying that, the upper end of the market is selling so beautifully. They are actually, the velocity of sales was so good. The price appreciation is fabulous. And hence, in last 3 years especially, developers have launched enough of inventory in mid to upper category of the sector. And that is the problem, because if you are selling something in a particular segment, your attention is drawn to something where questions are still there. You will be bringing in lots of inventory, but that segment for last 3 to 4 odd years, or in fact more, almost about 5 years, that sector is lying low, kind of dormant. I'm talking about affordable housing. So there is a clear, it's writing on the wall that for developers to move into affordable housing, the upper end has to slow down for them to realize that there is more business beyond upper end housing. And till such time that's not happening, I don't see much of a possibility of the listed developers or the organized players to focus on affordable housing. In the interim, the focus will remain on the upper end of the market.
Yeah, considering that the main impetus for the listed developers is on the premium and the uber luxury side, considering the kind of demands and the pricing realizations that we've been seeing, what is the trajectory going forward that you see for the top end of the market, how their share would pan out in the next coming, say, 1 to 2 years, and how the affordable, do you see the market share of this continue to see a decline overall? Just wanted to get your sense on the numbers if we go for the near-term picture.
Okay, so if we need to slice and dice and understand various layers of housing segments, what we spoke about, that the uber luxury end, the premium end is doing fabulously well, is still intact. The problem is in the mid end of the upper end, if I have to explain, houses priced from 20 crore to 50 crore is a segment where a lot of supply has come in, but the demand actually is not as much, and especially velocity of sale is affected so much that this is the only segment where the time taken to absorb whatever inventory in the market is going to be almost about 5 years. The upper end, above 50 crore, is a segment where still in 2 years, whatever inventory is there, you will absorb all of that. But this is one segment, which is 20 to 50 crore segment, where the velocity is a lot to something to worry about, and that is where the first sign of crack is appearing. While developers are talking about a little slowdown in both conversion as well as new inquiries knocking their doors, there's a slowdown, but the velocity of sales has continued in other segments except for the one which I spoke about. Even 2 crore to 5 crore, 5 to 20 crore segment has also been doing fairly well, because the velocity of sales or time taken to absorb all the inventory in the market basis the last 10 quarters of a rolling average of velocity of sales would still not be more than 2 to 3 years, which is a comforting zone. The only thing is the middle end of the upper side of the society, of the segment, which is showing cracks, but cracks nonetheless. So my point is, while many of them have already started, writing that the sector is on a slowdown, I would say we need to wait and watch a little, maybe a quarter or two, to see how velocity of sales are shaping up in next 2 to 3 months, 4 months, and then come to a conclusion. In the interim, the business is as usual, except for 1 or 2 segments, which is very specific. Everywhere else, the business, the velocity of sales are going on as usual. So the long-term perspective, another 3 to 4 months or 5 months when you and I would sit together to look at what's happening out there, basis solid data, I don't want to go by the anecdotes that the people are quoting. Based on solid data, I will tell you, if in long term the perspective is changing, developers would in that event start looking at affordable housing if there is any slowdown in mid to upper end.
So, Mr. Zia, my follow-up question, just to understand what you've told me better, is do you see that the gap between these different segments of housing would increase or merge in the future? And the reason why I'm asking you about affordable housing is because there's substantial push from the government's end as well, especially if you go back in Tier 2 and Tier 3 cities. The demand for affordable housing is concrete and it is high. It is very much in demand. But we don't see private players pushing themselves to make affordable houses for various reasons. Do you think because of rising disposable income and rising demand in urban cities due to a rise in the lifestyle of people, the gap between luxury housing and affordable housing would increase in the near term or even in the long run?
Well, it has already increased. If you have to look at, of course, reasons, a lot of reasons, the stock exchange was the major reason. Equity markets outperforming everything else for last two odd years was the reason. But that is one single big reason which has actually changed. In last 2 to 3 months, we are looking at serious distress from the equity side. So a lot of wealth creation that had happened in stock exchanges was actually driven into housing and especially mid to upper end of the housing. And that is what was showing. But you're absolutely right, in times to come, that gap which had widened a lot. I will give you some data again. About 4 years back, overall market size, almost 2/3 used to be affordable housing and only 1/3 was mid to upper end. But in last 4 odd years, the markets have changed drastically. And currently, not even 25% of the share of the overall market pie is cornered by affordable housing. And that's a big gap. The gap that you're talking about is right here, huge gap. Now, going forward, as I said, since the signs are actually there that the markets are going to change, I want to believe developers would once again start looking into affordable housing, because all these big players that you spoke about were all there, all of them were there in affordable housing. But in last 4 to 5 years, they pulled out, focusing all their energies on mid to upper end. But as the game is changing again and the gap is widening, they will once again start looking at affordable housing. But in the interim, while developers are talking about re-looking at their strategies about the market, but time will tell. Another 6 months is crucial to understand whether this gap will widen further, which I don't believe. I believe this gap will actually shrink and things will change in favor of affordable housing in next year and a half. But in the interim, mid to upper end is what sells like hotcake.
Okay, that was quite comprehensive. Mr. Zia, I'll try to club a couple of questions together now. Now, what we've seen is Nifty Realty has been one of the top sectoral laggards for this year. We've seen about a 20% of a drop already. Now, there have been concerns in terms of where the approvals are. Regulatory challenges have been present on the upper end of the side. Many companies would maybe fail to maintain their FY25 guidance given as per the launches. So what we are looking at is in terms of absorption, that we are seeing a little bit of slowdown. So considering slower absorption, regulatory challenges being there in terms of approvals coming in, what is the picture that we'll see forward in the next, say, maybe like next 1 to 2 years for the real estate? Does the demand continue to be healthy, or there are chances of now supply increasing more? How would that impact the pricing growth forward, considering that inventories, as you've pointed out in your reports as well, are still on the lower side or remain at multi-year lows?
To start with, at a very macro level, I want to make a point that approvals is never a problem. Even if you say that it takes time, it's very usual, very normal. In fact, developers have their way of ensuring that the approvals are coming faster. But that, to me, it's not a concern at all. On the other side, it's purely the demand-supply economics that we have to look at. Currently, the demand is intact. The way the sales, velocity of sales, I said, we always catch the last 10 years rolling averages and the last 10 quarters rolling averages. And those rolling averages are still talking about a very favorable side of picture for developers. Going forward, things are expected to change, and primarily the reason remains that whatever is happening, the bloodshed in equity markets is something which will have an impact on real estate as well, albeit in a slightly with a lag of about a quarter or two. And that is already, a lot of people are talking about it, but it is anecdotal, so I don't want to go much into it. Data says that times to come, things may slow down, but in the interim, you spoke about prices. Well, in last 2 years, the prices have actually been increasing a lot, almost 7 to 8% on an average growth. But on the other side, the projects which are in demand from good developers, reputed players, the price growth per annum was as much as 25-30% per annum as well, which is crazy. But then that's usual, because when you look at the whole 10-12 odd year of cycle, in a year or two, prices going at that rate is not bad, because otherwise you would see 3-4%, 5% growth, which is, if you consider inflation, it is net negative. So this 20-25% is not again much to sing and dance about. But overall, the price rise has been, reaching that above the circuit breaker kind of things, where affordability is a concern. We're already reaching there. So price rise, I don't believe that you shall see more of price rise in times to come. Prices will remain stable. And as I said earlier as well, another quarter or two we have to watch, and we may see things changing, where the upper end of the market will definitely show slowdown, and mid to lower end shall come to rescue of the industry, of the sector, where developers quickly have to change their focus, come back into affordable housing. And that's a huge market. The demand there is intact. As I spoke about, in 5 years, you're going to look at 2.5 odd crore of housing requirement. So there is enough for every developer that exists today in listed or organized play. And then, as I said, price rise is already stabilized. It's ultimately going to be how do they quickly change the stance, get into affordable housing, and continue their business as usual.
Thank you so much, Mr. Ghulam Zia, for joining us and having this conversation and giving us such a holistic picture of the real estate market at the moment. And thank you, Anushi, for joining us in this conversation. Moving on, viewers, we have an update. Let's shift our focus to AMFI numbers for the month of February. The industry net inflow stands at 40,063 crore rupees versus net inflow of 1.88 lakh crore rupees last month. This is a huge fall. My colleague Neeraj Shah is joining us to now tell us more. Neeraj, how would you dissect this AMFI data that has just come in?
No, this is, well, the question is whether this is the blink that has happened or is this a one-off. Now, nobody's to know, and I think March will give a better idea. But until mid-Feb, the rumblings were that the Indian investor is not blinking. Now, the active funds equity inflows lower by 26% month on month is a big one. Agreed, February has less number of days compared to January, and therefore that will take into account. But even YOY, the number is not looking all that great. So that is part one. And there is significant dip across the pieces. And you could argue that the AUM number, which is down 7% month on month, is also a factor of the fact that Nifty itself fell about 5.9% in the month of February. So therefore the AUM gets impacted that way. But we're seeing fresh inflows coming off, and this is a bit of a, I would say that this is the first chink in the armor. Now, does this mean that there will be repeated blows on that armor? Remains to be seen. Remember, Malika, that the Macquarie note that came out yesterday, which was talking about what EU investors are doing. They are large global investors which have told a brokerage house in India that we are actively looking to see what is that the Indian retail investor does. And if the Indian retail investor flows go off, then the recovery in the Indian capital markets might get a bit pushed. Are we looking at that? Is the key question. Let's wait and watch.
Okay, just one follow-up to understand this data point better.
Sure.
Since the time we've entered a bear territory, to say, all of us have been talking about the fact that since equity is more vulnerable and volatile to market fluctuations, perhaps investing in index funds, mutual funds is a better option. Now that we've seen a month-on-month drop across segments through the AMFI data, what does that reflect, and what kind of sentiment do you think is, is it posing?
No, I mean, we've seen through the last 4 years that the Indian retail investor has stayed committed to the SIPs through falls. Now, if you look back and dial back the time zones, even 2022, when the start of the Ukraine war, etc. happened, the sound bites were like this, right? I mean, not end of the world really, but things are bad, etc., etc., etc. I think flows may have gotten shaken for maybe a month or thereabouts and then came back, which is why there is a bit of a hope that, in my mind, that If indeed if indeed you believe that India is going to be a larger economy, so on and so forth, and therefore the GDP will go up and therefore the market cap will go up, and then MFs will give you that wealth creation opportunity, then this doesn't get derailed in that fashion. I hope people invest in the right kind of funds, of course, right? So that is prima facie, but be that as it may, one certainly hopes that this is not the end, or the blink is not without reason. So if the markets were to stay low for the next 6 months, then you'll probably see even more instances of this happening.
So this could continue.
You never know. I mean, at some point of time, the Indian mutual fund investor will look back at the last 12 months. Bad idea, but we'll look back at the last 12 months and say, I would have made more in the FD. Is that a good idea? I don't know.
Okay, thank you so much for dissecting that. And we will move on, viewers. News coming in from the Reserve Bank of India following the IndusInd Bank fiasco. Sources have told NDTV Profit that RBI supervisors are seeking details of positions across banks. And my colleague Vishy is joining us to give us the important details.
Right. So, Marika, before we get into the RBI piece of the story, let's set the context a little bit. So, on Monday evening, IndusInd Bank comes out to the public and talks about how they have certain gaps in their derivatives portfolio, which is adding about 1,500 odd crore, 2,000 odd crore actually between that amount of an impact on its net worth. And this is happening because the bank conducted certain internal trades where the swap cost did not match the mark-to-market cost, and this gap in cost is essentially what the bank is providing for. So now the Reserve Bank of India's supervisory officers, each bank has an SSM or a senior supervisory manager who looks at the bank's daily operations, and they are seeking compliance reports on their foreign currency borrowings by these banks. Essentially, they want to see whether these issues are being repeated across other banks or not. From what we can tell from our sources, the supervisors are asking for specific compliance reports on where these positions are as of today. And that will ensure that they will know whether the banks are sitting on large losses or not. The supervisors are also seeking clarity on the mark-to-market positions on these foreign currency borrowings, essentially to see whether a similar situation is repeated in other banks or not. This is important because from what we understand from our sources, other banks are actually probably not sitting on these large sort of issues, and this is most likely localized at IndusInd Bank. But having said that, the RBI's job is to look at all the banks and whether they are in compliance with the Reserve Bank of India's rules, and that is what is being done at this point in time.
So that Vishy, and NDTV Profit has been inviting the management of IndusInd Bank to come on the channel and answer questions posed by shareholders. But the management is reluctant to do so. As we scratch the surface of the accounting discrepancy, we find that the CEO, Sumant Katpalia, and Deputy CEO both had sold 80%, mind you viewers, of their shareholding in the bank during its peak. Now, this raises additional questions about what the management knew beforehand and what they did what they did not disclose to shareholders. My colleague Harsh Saita is joining us to take a look at the claims made by the management of IndusInd Bank in previous quarters. Harsh, what have you found so far?
Well, yes, essentially what we've tried to do is try to question the fact that even if the management had come and spoken to us, whether we should believe the management or not. And I'm trying to break this down a little bit better by looking at commentary across the last 3 quarters and seeing what have we missed. Well, the stock has fallen 30%, and this is between mid-September and late October 2024. So when Q2 results actually were disclosed. In terms of asset quality issues, this is where it actually started with regard to the provisioning which happened in Q2, the asset quality hit that they took, the commentary that they suggested that the 525 crore worth of provisions taken were to rather shore up the balance sheet and try and make the balance sheet more resilient towards everything that's happening, but no indication given in the Q1 conference call with regard to any asset quality issues whatsoever. At the start of Q2 as well, there was no disclosure whatsoever in the pre-earnings release. They spoke about growth, they spoke about how well the bank was growing, but they didn't talk about the asset quality issues altogether. So there's a clear trend of the management not making appropriate disclosures at all where required. And last off, we'll try and further delve also into the misleading claims and hidden facts in each of the con calls. In Q1, they spoke about improved growth trajectory in coming quarters. That's not come through in Q2. The growth slowdown, they said, is because of external disruptions. Well, not at all. It's all because of asset quality. There's nothing relating to disruptions which have happened. And last off, there was also talk of stress observed in credit cards, but no stress at all with regard to microfinance. None of that really spoken about on the Q1 call. Let's, for an instance, believe the fact that none of this was visible at the end of Q1, but they were in fact even in Q2 cautiously optimistic about growth, especially in MFI as well as vehicles. Now in Q3, they're talking about how Q4 will also be bad. They've said that there'll be an improved performance in H2, which is not visible at all. And when you're looking at the contingent provisions of 525 crore was to fortify the balance sheet. Well, okay, you fortified the balance sheet. You've done a 1% ROA in that quarter. You've said ROAs will actually improve. And that's part of my next graphic, where ROA will actually improve going forward. Whereas that's not really happened at all. ROAs have been flat in Q3 and likely going to be lower in Q4 as a result of everything that's playing out. So clearly commentary not at all clear. And mind you, at this point, Mr. Sumant Katpalia was well aware of the fact that there was an investigation in the derivative segment and likely there will be a hit there. The quantum he may not have been aware of. That's part of his commentary currently, but he was aware that there was a problem. And that wasn't disclosed to the market at the end of Q2. That's the other thing which kind of bothers investors, which ought to bother them. There's been no improvement in ROA in Q3. So clearly that hasn't translated. The higher gross slippages from microfinance have continued in Q3 and they've guided for a worse Q4 as well. Slippages are expected to be more elevated in Q4 as well. So you will see some bit of a hit in Q4 as a result of all of this. I mean, the management, well aware of everything that's happening, is still not guiding correctly the street as well as investors. This is a Nifty 50 counter. It's a Nifty 50 stock. Is this actually right? And therefore, rightfully so, by Jan 25, you saw the stock fall another 11% on top of the 30 that we saw. Thereafter, September 2024 was when Mr. Katpalia had been nominated by the board as well as by shareholders for a 3-year extension. RBI did not give that. A truncated extension was offered. There was enough word on the street with regard to that. In fact, the stock had fallen 12% in the last week as a result of just possibilities of him not getting that extension. A truncated extension has actually led to another 14% decline in 6 trading sessions on IndusInd. Another 27% on the back of the hidden derivative losses, which were well aware, which the management was well aware of, just the quantification of which came out this Monday, but the management was well aware that there could be a loss at the end of Q2. And therefore, some of this really puts question marks on whether we even want to listen to the management or not.
Right, Harsh. That makes us definitely contemplate about the misleading claims and commentary made by the management. But you also mentioned that both the CEO and deputy CEO had sold, in fact, 80% of their shareholding in the bank. Could you tell us what was the value of the shareholding sold and why and when did this happen?
Yeah, I'm only going to talk about the June 2024 shareholding sold. And why do I say this? Because in Q1, at the end of Q1, they came out and they gave a very rosy picture. But I want to try and emphasize on the fact that likely they were well aware of everything that was happening at the bank. June 2024, they've come out and they've sold, Mr. Katpalia has sold around 28 crore worth of stock. This stock has costed him just 10 crore rupees. 18.5 crore is what he's made in terms of gains on this stock alone that he sold in June of 2024. This is, of course, prior to the close of the trading window, which generally closes at the start of the quarter because at least till results come out. And he sold most of his stock, 80%, as on that date. Now he holds a very small quantum compared to what he was holding prior. That's my first problem. My second problem is not only has the CEO done that, the deputy CEO has also done that. In fact, insiders have sold nearly 100 crore worth of stock in the June 2024 month alone. Now, I understand that maybe promoters would have bought stock, but this does not give a very good picture, doesn't paint a very good picture for the bank, and it doesn't paint a very good picture for the management either. There's a management which has sold stock at its 52-week high. Thereafter, we saw a series of mishaps which have happened. Stock is now down over 60%. Shareholders have lost wealth. This is a nifty 50 counter. Management comes out, talks to a couple of media houses. Thereafter, you're also seeing that a lot of the commentary that they've given in the past has actually been questionable. Whether you continue to have comfort on what the management says after everything that's happening, well, it's something that I leave to viewers to actually understand. But 18.1 crore is the gain alone made in June of 2024. All of the shares that were sold were part of the ESOPs, which were actually purchased at just 520 rupees per share, sold at 1524. The high, 52-week high on the stock was 1560 rupees, and that was back in April. And therefore, you've sold it at very close to the high. Very similar kind of numbers even for the deputy CEO, nothing different in a material sense. And therefore, essentially trying to understand as to whether management, which was well privy of this, was just trying to take cover in terms of the way they were giving out commentary, and despite having sold most of their stock.
Definitely. It seems like a preemptive move to shrug off risks in the future. But thank you so much for bringing us that perspective, Harsh. And in fact, the Department of Financial Services viewers under Ministry of Finance has now taken a stock of the issues ongoing with IndusInd Bank as well. And my colleague Shrimi has more exclusive details on this.
Yeah, so Department of Financial Services, whose mandate is to see the functioning of financial institution, including banks, is said to have taken a stock of the IndusInd Bank crisis. In fact, sources tells us that the key issues in past few days which have been emerged with respect to, accounting practices, leadership concern, as well as the governance issues is being recognized by the Finance Ministry, and the DFS is, actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And in fact, DFS is also sort of focusing on to maintain the integrity and stability in the banking system, and also try to sort of ensure that all the stakeholders' interests are protected. So DFS may hold some review meeting in the upcoming week, is what sources indicating us, where the ministry would try to sort of see the checks and balances, whether they are at place or not, as far as several such hedging practices are concerned, and trying to sort of gauge that whether these kind of issues are not there with the other banks or not. So such review meeting may soon take place to sort of understand, but at this point of time, the DFS is mainly focused on protecting the interest of the stakeholders, all stakeholders, and to ensure the stability and integrity in the banking system.
Right, Shrimi. Well, viewers, that's all the time we had on this show, but do stay tuned to NDTV Profit for more news and updates.
Very, very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Reviksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Reviksit Bharat.
Headlines you start.
Hello and welcome. My name is Varsha. You're watching Profit Buzzers. With me is Mika Barve. Let's see what our headlines are. Markets are sea of red as both the benchmarks trade over 0.5% lower. Media, metal, realty down, banks shine.
Nifty IT falls to an 8-month low to become the top sectoral laggard as heavyweights Infosys and Wipro drag the index lower. Morgan Stanley says the sector is recalibrating growth and multiples.
Bharti Airtel Jio Inc. parts with Elon Musk's Starlink to bring satellite internet services to India and connect areas with limited access.
After the IndusInd Bank fiasco, Reserve Bank of India takes stock of foreign currency borrowings by banks. Sources tell NDTV Profit that RBI supervisors are seeking compliance reports from all lenders.
EMS companies in focus as Dixon Tech announces foray into display fabrication with a capex worth $2.7 billion predicted on implementation of India's Semiconductor Mission 2.0. While Keynes Tech MD receives show cause notice from SEBI alleging violation in database maintenance.
Canada backs away from its reciprocal tariff hike on electricity exports to the US. White House says Trump's double tariff on Canadian steel and aluminium will no longer take effect tomorrow. Well, those were the headlines for the day, but let's start with how markets are faring right now, and it's a sea of red. The Nifty 50 down about 0.6%. We are now around almost 15% lower than the 52-week high. If you look at the point contribution, some of the laggards for the Nifty 50 is Infosys, followed by an Axis Bank, and then you have the IT counters like TCS, HCL Tech, and Wipro. If you look at some of the counters, that are leading in terms of your stock performance, it's all, the top four are all IT, Infosys, Wipro, Tech Mahindra, HCL Tech, all of these counters seeing cuts of 2 to 4%, followed by an Adani Enterprises, Axis Bank, and a Nestle's. Something that is, seeing stronger movement is an IndusInd Bank after falling almost 26% in trade yesterday. Over 26% trade, but let's just quickly swift on to the Prime Minister Modi, who is currently speaking in Mauritius. Do listen in.
100 किलोमीटर लंबी पानी की पाइपलाइन के आधुनिकीकरण के लिए काम किया जाएगा। कम्युनिटी डेवलपमेंट प्रोजेक्ट के दूसरे चरण में 500 मिलियन मॉरिशियन रुपए के नए प्रोजेक्ट्स शुरू किए जाएंगे। अगले 5 वर्षों में भारत में मॉरिशस के 500 सिविल सर्वेंट्स को ट्रेनिंग दी जाएगी। हमारे बीच लोकल करेंसी में आपसी व्यापार का सेटलमेंट करने पर भी सहमति बनी है। साथियों, प्रधानमंत्री जी और मैं सहमत है कि रक्षा सहयोग और मैरीटाइम सिक्योरिटी हमारी स्ट्रेटेजिक पार्टनरशिप का अहम हिस्सा है। फ्री, ओपन, सिक्योर एंड सेफ इंडियन ओशन हमारी साझी प्राथमिकता है। हम मॉरिशस के एक्सक्लूसिव इकोनॉमिक जोन की सुरक्षा में पूर्ण सहयोग देने के लिए प्रतिबद्ध हैं। इस संदर्भ में कोस्ट गार्ड की जरूरतें पूरी करने में हर संभव सहायता दी जाएगी। मॉरिशस में पुलिस अकादमी और नेशनल मैरीटाइम इंफॉर्मेशन शेयरिंग सेंटर, इसकी स्थापना में भारत सहयोग देगा। वाइट शिपिंग, ब्लू इकोनॉमी और हाइड्रोग्राफी, इस पर सहयोग को और मजबूत किया जाएगा। चागोस के संदर्भ में हम मॉरिशस की संप्रभुता का पूर्ण सम्मान करते हैं। कोलंबो सिक्योरिटी कॉन्क्लेव, इंडियन ओशन रिम एसोसिएशन और इंडियन ओशन कॉन्फ्रेंस जैसे मंचों के तहत हम सहयोग बढ़ाएंगे। साथियों, पीपल टू पीपल संबंध हमारी भागीदारी को मजबूत नींव प्रदान करते हैं। डिजिटल हेल्थ, आयुष सेंटर, स्कूल एजुकेशन, स्किलिंग और मोबिलिटी में सहयोग बढ़ाया जाएगा। हम एआई और डीपीआई यानी डिजिटल पब्लिक इंफ्रास्ट्रक्चर का मानवीय विकास में उपयोग के लिए मिलकर काम करेंगे। मॉरिशस के लोगों के लिए भारत में 4 धाम यात्रा और रामायण ट्रेल के लिए सुविधा दी जाएगी। गिरमिट धरोहर के संरक्षण और संवर्धन को बल दिया जाएगा। साथियों, ग्लोबल साउथ हो, हिंद महासागर हो या अफ्रीका भूभाग, मॉरिशस हमारा महत्वपूर्ण साझेदार है। 10 वर्ष पहले विजन सागर यानी सिक्योरिटी एंड ग्रोथ फॉर ऑल इन द रीजन की आधारशिला यहीं मॉरिशस में रखी गई थी। इस पूरे क्षेत्र की स्थिरता और समृद्धि के लिए हम सागर विजन लेकर चले हैं। आज इसको आगे बढ़ाते हुए मैं कहना चाहूंगा कि ग्लोबल साउथ के लिए हमारा विजन रहेगा सागर से आगे बढ़कर के महासागर, यानी म्यूचुअल एंड होलिस्टिक एडवांसमेंट फॉर सिक्योरिटी एंड ग्रोथ अक्रॉस रीजन्स। इसमें ट्रेड फॉर डेवलपमेंट, कैपेसिटी बिल्डिंग फॉर सस्टेनेबल ग्रोथ और म्यूचुअल सिक्योरिटी फॉर शेयर्ड फ्यूचर की भावना समाहित है। इसके तहत टेक्नोलॉजी शेयरिंग, कंसेशनल लोन और ग्रांट के माध्यम से सहयोग किया जाएगा। एक्सेलेंसी, एक बार फिर मॉरिशस में मिले आत्मीय स्वागत के लिए मैं आपका और मॉरिशस के लोगों का हार्दिक आभार व्यक्त करता हूं। मैं आपको भारत यात्रा करने के लिए निमंत्रण देता हूं। आपका भारत में स्वागत करने के लिए हम तत्परता से प्रतीक्षा करेंगे। बहुत बहुत धन्यवाद।
Well, that was the Prime Minister, speaking at the Mauritius. But, let's go back to markets, and there is pain in your benchmarks as well as your broader markets. We spoke about the benchmark in terms of the broader markets. They are the underperformers. The Nifty Mid Cap 150 down about 1.5%. The Nifty Small Cap seeing cuts of 1%. If I just want to pull up some of the counters on the Nifty Mid Cap 150 and something that's not doing very well in today's day of trade, you have something like a pain in some counters like Asian Paints and Apollo Hospitals, Adani Enterprises as well as Adani Ports. You have around a lot of it in in the red. If we just can pull up the sectoral indices, Varsha, and just see how the sectoral indices are faring there. Okay, yeah. Well, you have all of the sectors in the red, and the TIT being the top loser, down about 4% right now. But there is a massive capex cycle just around the corner, and this is what Kenneth Andrade, founder and CIO of Old Bridge Mutual Fund, said. Now listen in as he talks about what he expects from the markets going forward.
If you put all statistics together with number of lows, price earning multiples actually coming off, we're probably 1 year away from this consolidation point. See, I don't expect markets to go to react very negatively despite incremental bad news. Okay. But it needs to take our time at this place. Okay. You have struggling domestic macros. You've got weak commentary coming up from the rest of the world. But the biggest positive to this entire change that is happening domestically and internationally is, I think now you're going to see a significantly massive capex cycle, not just in India but in the rest of the world. And this is the time where the international, or should I say, the developed markets have started putting money to work. So the capex cycle is around the corner. It's going to be a bigger one than you've seen last time. What's going to benefit? How are we going to feed into that supply chain? I think the landscape's pretty much open. So look at it from in this consolidation round, how do we feed into that supply chain? It's more of an opportunity than any risk that you're actually looking at.
On that note, let's welcome our guest for today, Gaurang Shah, Head Investment Strategist at Geochit Financial Services. Gaurang, welcome to the show. My question to you, do you mirror a similar view? While there is this very strong market setup that we've been seeing for a couple of months now, that it's opening up opportunities?
Thank you, Mika, for having me on this platform. Good afternoon to all of you all. So I think in times of distress, there are going to be not one, but one too many opportunities that are going to come up. And if US is going to do what it has to do in terms of what the President Trump has mentioned, my sense is that not only in our part of the world, but the rest of the emerging market as well as some of the developed pockets will definitely look into focusing and increasing their capabilities and capacities in terms of manufacturing and services, and that will eventually translate into capex going up. In our part of the world, it is all the more necessary because the government has been waiting on sideline to kick off capex for the last 2 years or so. I think this time around in the budget, and of course the need of the hour of what is happening around the world, capex is definitely going to pick up steam, and that will translate into positivity with respect to cap goods engineering, power sector, and of course materials like building materials. All this will definitely translate into positivity. But the government at the center and at the stage need to take that initiative and push it forward.
Right. Well, moving ahead, Airtel and Jio has signed a deal with the Elon Musk-owned Starlink, a move that could major implications for the future of satellite communications in India. Somit has details on this.
Yes, Airtel and Jio, both the telecom operators, have signed a partnership with Starlink where they will be marketing Starlink's product and its hardware as well. Now, the opportunity of Starlink products is huge in the Indian market, given the fact that nearly 30% of India's population still does not have full-fledged internet connectivity. But the key question here is, or the key hindrance for the opportunity is the pricing. Now, if you look at the Indian market, India is a market with a rock bottom ARPU, that is the average revenue per user that a telecom company generates by selling its product to every subscriber, and that is at rock bottom as compared to what Starlink's pricing is in the US market. If you look at the cheapest mobile and the broadband plans offered by Starlink is at around $50 and $120 per month. Apart from that, every broadband user also needs to buy the hardware from Starlink that costs around $349, which is an upfront payment that they need to make to Starlink. Now, Starlink also caters to various other emerging markets and developing nations as well, and the cheapest rate offered by Starlink in the emerging or developing nations is in Nigeria, where it is offering its broadband plans at around $25 per month. Now, this, if you compare it with what is available in India, in fact, in India, if you look at unlimited mobile and broadband plans are offered at a price less than $3 and $5 per month. Apart from that, any subscriber getting a broadband connection does not even need to pay for the hardware, any hardware cost to the operator. So that's the main reason or main hindrance that Starlink could face, that is on the pricing. Unless and until the pricing is as cheap as the current prices, mass adoption of Starlink's product looks very difficult. So if the pricing continues to remain with the international norms, then most likely the users or the potential market for Starlink in India could be a very niche ultra HNI individuals. Apart from that, it could find some traction in the defense or the enterprise segments like healthcare and airlines, but mass adoption looks quite difficult. And what it means for Airtel and Jio, it is sentimentally positive because it would mean a less competitive intensity going forward as and when Starlink launches its product, given the fact that Jio also has its own satellite communication product and Airtel through its promoter entity also has a satellite communication product. When it comes to financial impact, earnings impact is largely negligible for both the telecom operators, that is Reliance Jio and Bharti Airtel at this moment.
Right. Thank you so much, Somit, for all the details. Well, Gaurang, your view when it comes to both these counters, Airtel and Jio. And my second question is the impact on the proxy plays. You have, Indus Towers or all the small companies, listed companies who make towers or cell sites, in theoretical language. So, impact on Airtel and Jio and the proxy players like Indus Towers.
Well, Varsha, so we've been maintaining a positive stance on Reliance Industries because of one too many reasons. One of them is, of course, Jio and the other businesses. Bharti Airtel, second largest cellular service provider in India. We also have coverage on Indus Tower as a disclosure. As your colleague Somit was referring to, Indian customers are very, very sensitive to price. And if the difference is that big, then what are we talking about? That's the big question mark. So your niche users are already used to paying that kind of thing. Your enterprise related users may possibly find some kind of attraction. But the main thing, if you want to penetrate, because the theme was to penetrate into semi-urban and rural India, and more than the bigger cities and smaller cities and towns, price sensitivity is much more there in semi-urban and rural India. So how it is going to help, it's a big question mark. But nevertheless, let's hope that it is able to deliver what it is able to deliver. A little bit too early in terms of making any kind of impact-related statements for this Bharti Jio and Starlink tie-up.
Thank you, Gaurav, for giving us that view. But on that note, we'll just slip into a short break. But do stay tuned. Lots more lineup on the other side.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with
Hello and welcome. You're watching Profit Buzzers. Now we've spoken about the markets, we've spoken about the telecom sector, and the next space you're focusing on is in cement stocks, and they are heavily under pressure. Pull up something like a Ramco Cements or a Dalmia Bharat. We've seen heavy losses for Ramco Cements, down about 7%, Dalmia Bharat under similar pain, and this is because of something that the Tamil Nadu government has announced. They're going to impose a mineral tax of 160 rupees per ton on limestone. Now, limestone is a key raw material for the making of cement, and this increase in mineral taxes is applicable from Feb 20th, 2025. Now, in terms of the impact, one, it's going to lead to a higher cost of production. As per analysts, it's a potential increase of cost of production for 210 to 220 rupees per ton. And if you had to talk about the effective price increase just to cover these additional costs, it would be 16 rupees per bag. Now, in terms of the companies in Tamil Nadu, well, clinker capacity in Tamil Nadu currently stands around 26 million tons per annum. 88% of this capacity comes within three companies: Ramco Cements, Dalmia Bharat, as well as in India Cements. Now, Ramco Cements has around 52% share in the Tamil Nadu clinker capacity, while India Cements and Dalmia Cements holds around 24 to 28%. If you could just lastly pull up an Ultratech Cement, because Ultratech Cement has acquired a good part of India Cements right now. It's trading flat, but with a negative bias nonetheless. Gaurang, I'll come to you. The cement sector has been in focus. We've seen some price hikes come in the last few months. We've seen them sustain, but with this additional mineral tax in the southern... we're just going to shift to Brijesh. Brijesh, welcome to the show. We're joined by Brijesh. Brijesh, how do some cement counters look on the chart if you had to take a Ramco Cements and a Dalmia Bharat in focus specifically?
Hi, good afternoon. So maybe because after the government thing, I think there has been a selling pressure in this counter, and maybe this is likely to stay bearish for next couple of days. Even the derivatives data suggests there can be some further selling pressure. So not too much of upside, maybe at least for this expiry point of view, I think this pressure will be there. The fresh shorts have been added in the JK Cement, Ultratech Cement and the Shree Cement and Ramco Cement. So this is purely from the derivatives data point of view. So the build-ups are pretty short. So this momentum, this negative bias may stay for another couple of weeks. So at least from the expiry point of view, the cement space will see some resistance, and whenever there is a bounce, I think that will be get sold off.
Got it. Thank you, Brijesh, for giving us those details. But we're going to shift focus to the AMFI numbers for the month of February. The industry's net inflow stood at 40,063 crores versus a net inflow of 1.88 lakh crore last month. Now, my colleague Neeraj Shah joins us, and even to speak about the latest numbers, we're joined by Anand Vardarajan, the Chief Business Head of Tata Mutual Fund. Neeraj, take it off.
Thanks so much. Anand Vardarajan is with us, and the numbers. Anand, thanks so much for joining in. Would love a perspective from you here. The SIP flows haven't really shown as big a dip, right? 400 crores could have wherever happened because of the lesser number of days. But the overall equity inflow number lower by 25% as per my math. Is this the Indian consumer blinking, or are there one-offs here?
I think on the SIP, you're right. You'll have to count 3 days lower. Jan had 31 days, so to that extent, I think that explains the dip. And in a full-blown month, I think your number should have been somewhat similar. In as far as the dip in equity numbers are concerned, I think, Neeraj, if you were to look at it, I think February was the first month where even your large cap 1 year returns had become flat, as flat can be. And to my mind, that could have had some sentiment impact, because your mid and small cap 1 year returns had turned negative sometime end of Jan, early Feb. But I think the last straw to my mind would have been, large cap or Nifty returns being flat to slightly negative. And that could have had some recency, impact as far as investor sentiment is concerned.
Yeah. So Anand, please tell us, because two things actually. One, when we were doing some channel checks mid-Feb, things weren't looking iffy when it regards to flows. So is it a factor of the last 15 days that the inflows have dropped out, part one? And part two, whether for Amphi or for your own business, how has March been thus far? Because I mean that 1 year, the mark that happened in February would have only gotten worse in the month of March, right? So are people pulling back on equity flows for the time being? What has been your own experience at Tata AMC?
Yeah, I'll just speak at an industry level. I think it was it was quite visible that flows were kind of ebbing towards the second half of February. For various reasons, I think markets are also in correction mode. I think globally also there were a lot of noise, news flow in terms of tariff wars, etc. And to that extent, that kept the market somewhat kind of busy in terms of fresh data points. And the cues that you were getting, at least from the Western world, was not very great, be it market cues or data. And hence, our markets are also kind of drifting downwards. I think about the last 4 or 5 months experience of the investor. Somewhere, I think then the perception is that if markets are drifting downwards, I might get it even cheaper. Could have been some sentiment which investors would have had, and that could possibly explain why flows have ebbed a bit.
Okay, sorry. So just to get this clarity, Anand, is March also looking slightly skittish in terms of inflows into equity-linked funds?
I think the trend it continues as is. Very difficult to say how March will pan out. I think.
But thus far, is there? I mean, just again, only if you have, if you can answer. I wonder if thus far there is the trend continues on the downside.
Yeah, I would put it this way, that March trends could be very different because there are multiple events. Even from a liquidity standpoint, if you were to look at it, I think due to year-end liquidity becomes tight, and on fixed income side it becomes far more challenging than equity. So next couple of days would become critical on the fixed income side. Equity, I think it is more continuation of February. We're not seeing anything, any different trends from what we've seen in equities.
56% downtick in February in equity-linked funds, even if I account for month-on-month, right? So even if I account for 3 days lesser, it'll still be about, it could still have been about 23% or 22% or thereabouts, a dip month-on-month. So is that something continuing? I'm not happy seeing that, by the way, Anand, because I hope people stick for the long term. I'm not happy seeing that, but are we actually seeing that?
I don't want to hazard a guess for March, Neeraj, at this time, because the month is wide open. Also bear in mind that valuations are also only getting more attractive relative to what it was.
Yeah.
And I really think the core of investing has always been, which we keep saying, is as markets rise, your risk increases, and as markets dip, your risk reduces. And I think this has to be understood well by investors, which I would believe that the retail investors, despite 4 or 5 months of slightly challenging market environment, we have seen strong flows. So I see no reason why they would not continue and stay invested and continue to add more at lower levels, because the valuations are only getting attractive relative to its own past.
Okay, we'll leave it at that. Anand, thank you so much for taking the time out and being with us. Really appreciate your time.
Thank you.
Well, that's view on Amphi flows. Certainly a wrinkle on the banana peel. Varsha, over to you.
Thank you, Neeraj, for joining this conversation. Well, moving on, let's take a look at all the stocks, which are buzzing in trade today, and Anushi joins in for more details.
Okay, thanks for that, Varsha. So one stock that we've been talking on back to back on the basis of their order wins is something like an RVNL. Now they've emerged as the lowest bidder for a 554 crore worth of project from NHAI, and this pertains to construction of 6-lane access-controlled connectivity to Visakhapatnam Road. Order execution period for this is about 2 years. If you look at the order book positioning of the company, now there have been a couple of new orders coming into the business, but the latest current order book picture that we have is around 98,000 crore. Do remember that the company aims to take this number to 1.5 lakh crore next year. In terms of where the guidance is pertained, they expect FY26 to be much better than FY24 as well. They are seeing about a 6 to 8% of growth in FY26 over FY24, and the expectation is also that margins would be higher in the next 1 to 1.5 years. The second stock in radar is something like Godrej Agrovet. Here, the company has decided to acquire about 48% of equity stake in Creamline Dairy Products, and the total cost of acquisition roughly adds up to about 930 crore. The target company, if we see that Creamline Dairy Products is already a material subsidiary of the company, but with this additional stake now it would be wholly owned, that's 100% stake would be owned by Godrej Agrovet. So these are the two stocks which are on my radar today.
Thank you, Anushi, for all the details. Well, Gaurang, before I go to Brijesh for technical charts, let me come to you. How are you viewing this? Of all the stocks that Anushi spoke about, you have RVNL and Godrej Agrovet. Do you cover this stock, and what are your views on both the stocks?
Well, so don't have coverage, but I think RVNL. I'll stick to the sector, that is the Indian Railways. Look, Indian Railways is likely to continue whatever changes we are witnessing for the next 3-5 years or maybe more. And in such cases, whether it's a government-owned company related to Indian Railways or a private-owned company, all these companies are going to get orders. They're going to execute them, and they're going to improve their earnings visibility. So remain optimistic on the sector, that is Indian Railways. Godrej Agrovet, I think this is also relatively a consumption related play, and if you are positive on the consumption post the budget, not only in the cities or tier 2, tier 3 cities or larger cities, but even in semi-urban and rural India, then I think relatively from third quarter onwards, new financial year, that is October, November, December 25, we are going to see all this visibility at ground level in terms of consumption picking up.
Brijesh, how are the charts looking for RVNL and Godrej Agrovet?
So to start with RVNL, the charts are not that great. There has been a continuous profit booking and there has been distribution. Even though after the news and the whatever the order books which RVNL has got, there is nothing. The price action doesn't say anything very clear. So structure is weak and it is looking somewhere, maybe in the near term, some more damage can be there. So I think on its own, it can go back to 300 levels. So let's figure it out. Whenever it comes closest to 300, whether it takes support or not. So chartically, it looks weak. So not too much of keen to whether to take a position or not. Maybe at lower levels, we can figure it out. Coming to Godrej Agro, there is some kind of consolidation which is seen in the charts, both from the weekly and the monthly time frame. So the base is closer to 700, 690 level. This is a strong base which is forming. So, but it also need to be see a base formation breakout, which will come on the way up when 800 level is taken off. So it's kind of a sideways consolidation. So somebody wants to take a position who's already having a position can have a whole kind of a strategy in the Godrej Agrovet. Once the breakout is up, then most probably we can talk of the further upside. But right now, at this current price, the consideration is what I can see in Godrej Agrovet.
Got it. Thank you, Brijesh, for giving those details. We're shifting our focus now to the EMS space. Two counters, two different news flows. Up first, we have Keynes Technologies. Well, the company's MD, Ramesh Kunikanan, has gotten a show cause notice from SEBI, and these are alleged violations of structural digital database regarding the financial results of Q4 FY23. They're suspecting violations in the maintenance of these structural digital databases. And the CEO, the company has said that they're reviewing the contents of the notice and will take the necessary legal steps after doing so. But on the other hand, you have something like a Dixon Technologies, whose management says that India has a competitive advantage compared to something like China and Mexico. And this is said by Saurabh Gupta, and let's hear his rationale behind this.
Negotiations are going on, and the government is also, we are in discussions with the government as well. We feel, though the contrast is still not out, it's negotiations still going on, but we feel it will be positive for India, because if you look at India's export of electronic products to US is just 2 to 3%, while China is around 35%, Mexico is around 23%. So they are large, they have a large share, and clearly in both the countries the tariffs have been levied to the extent of 20%, which was almost negligible. So we feel that India is at a slightly competitive advantage.
That was the management of Dixon Technologies. Gaurang, I'll come to you. You know, your outlook on something like a Dixon Tech. You've seen a new display venture on behalf of the company as well as the Keynes Technologies. Does this space look attractive? And are the entry points now, are the valuations now attractive post the market sell-off?
Because you know what has happened to the entire sector, right? Both in terms of the dependency of India on China, Taiwan for its semiconductor chips, or be it any other electronic manufactured product. Government has been trying to do its best in terms of bring down the dependency and has introduced various measures, policies, including the production link incentive. Keynes Technologies, Dixon Technologies, PG Electroplast, if I'm not mistaken, followed the music when the Pied Piper was playing it. And now with the kind of headwinds, these stocks have corrected. The sector overall looks very encouraging and promising.
Brajesh, I'll come to you. Dixon and a Keynes, what do the charts say?
So I think with the SEBI thing, the Dixon's on somehow there has been buying in today's session, and there has been a good amount of volumes which has seen in in the Keynes Technology. So I think some momentum is there. So maybe some bounce back trade can be seen purely from the technical point of view. Even though the larger trend is negative because there has been a breakdown from the 50 and 200 moving average. So some pullback can be there, some 500 points kind of an odd pullback. Nothing beyond that. Coming to Dixon, I think the structure for the Dixon is not that very positive. In the recent trade, that 14,000 level, there was the major support which has been broken down now. So I think this continuation of the down trend will be there. So maybe there are fair chances that we might break 12,000 on the downside. So we want us to wait for this levels to be broken and then review it.
Right. Now, from telecom and EMS, let us see what is buzzing in pharma. Zydus is in focus after the company cracks its new deal. Zydus is set to acquire 85.6% of Amplitude Surgical, which is a medtech leader in orthopedics market. Now Zydus will acquire this company at 250. So basically, it's going to acquire almost 85% of stake for 256 million euros. Now, if you see the rationale behind this acquisition, Zydus has been doing the background check on medtech for the last couple of years, and medtech can be India's what pharma was 30 years back. That is a sunrise sector, and now this is as per Zydus management what they had said in the yesterday's analyst meet. Among different subsectors, top 5-6 players usually take 60% of market. This is changing now as per the management, and a lot of best practices are also being picked up. Other highlights which management actually said yesterday was the Zydus MedTech aims to be new growth driver for the Zydus group, and they're going to focus on 3 priority segments, that is cardiology, nephrology and arthroplasty. And company will focus on expanding its global footprint, will pursue vertical integration as well, and the acquisition positions MedTech as a key growth driver for Zydus, and they're going to expand into other European countries as well. France still has upside potential, and a company will expand into US once it expands its robotic offerings. And initially there were no plans to expand in India, but they'll be expanding soon. But the brokerages, if I were to, so Investec said that maybe there may be some pressure, going ahead. Even Access Capital had a reduced rating on Zydus. The potential upside was just a mere 1%. So they also came out with some concerns when it comes to this acquisition as well. But Gaurang, let me come to you on Zydus. What is your view? How are you seeing this acquisition? Because the Zydus has acquired this company which has almost 25 to 26% of margin that the company is being doing. So your view when it comes to Zydus on this acquisition plus overall business outlook for the company?
Well, so we have been positive on Zydus Life as well as Zydus Wellness. And our sense is that, of course, the near-term concern remains to be what US does in terms of tariff on the pharma sector and the catering to the US, what Indian company does. But not looking at this short, medium-term hindrance We remain structurally positive for the Indian pharma. As far as the acquisition is concerned, my sense is that it should definitely add to the earnings visibility as we go forward from here.
Brijesh, your view on Zydus?
Yeah, so actually, to be very frank, on a weekly time frame, there has been distribution during the second week of the February month. And most probably, right now, I'm pretty confident that we can see another 10 odd percent kind of a correction from the current level. So maybe somewhere close to 800 is what I can see on the way down. So let's review it whenever it comes to 800. But then 10% odd percent, 10% kind of a odd correction can be seen in this counter.
Right. Now, let's shift our focus from pharma to chemicals, wherein the National Stock Exchange has launched a new index called Nifty Chemical Index. This index is designed to track the performance of companies within the chemical sector that are part of broader Nifty 500 index. Now, let's see what is the detailed explanation. Now, index will include top 20 chemical stocks based on their free float market capitalization, meaning free float means portion of company shares available for public trading, and the preference will be given to stocks traded in the NSE derivatives segment. Now, the Nifty Chemical Index will serve as a benchmark for asset managers and passive funds. And if I were to talk about the methodology, the weight of each stock in index is determined by its free float market capitalization. And to prevent any single stock from dominating index, there are the caps. So no single stock can have a weight exceeding 33%, and the combined weight of top 3 stocks cannot exceed 62%. Now, if I were to talk about the base data and value, the index base date is from April 1, 2005, and at that time, if you see, the index was assigned a base value of 1000. Index will be reconstituted semi-annually, and it will be rebalanced quarterly. If I were to talk about the key constituents who will be the part of this index. So some of the major companies that I'll be speaking that will make up the index, which includes Pidilite Industries, then SRF, UPL, PI Industries and Solar Industries India. So these are the top the major companies that will be a part of Nifty Chemical Index. Well, Gaurang, good to have chemical index now will be a part of Nifty index. Now, your view when it comes to all the whatever the pressure is going in the chemical industry, because now everyone is saying, okay, now demand is coming back. Maybe the price have not realized, or the realization in the prices have not gone that up, but maybe the things are on track. But wanted to know your view. How are you seeing this?
Well, it's been more than delayed, to be very honest, because that Europe +1, China +1 was going to kick in. We are way out of the restrictions and the COVID-related, borders that were drawn. But there is no significant improvement in the earnings. That's the sad part. And to answer your question, whether this is likely to pick up, well, we do have that positive view on the pickup, not only on the domestic front, but also on the global arena. That's where it's going to be equally more important. While it is good to have Nifty Chemicals Index, but only having Nifty in the new index in form of chemical index is not going to work. Companies need to contribute in terms of earnings. Out of the 4, 5 or 6 names that you mentioned, I think Salora is the only one that I'll leave out. On other names, whether it is UPL, Pidilite, PI, SRF, we have coverage on all these 4 names, and including Aarti Industries, we have positive coverage.
Got it. Brijesh, how are the charts looking for, you have, any stock that you are tracking whose charts are looking great in your radar?
Yeah, so basically there are 3 stocks which I would like to convey. One, the Pidilite, the structure from the derivatives point of view is also looking positive. There has been a long build up in the Pidilite, more both from the daily and from the weekly time frame. So Pidilite is something which can see a good bounce from this current level. 2900, 2950 can be some technical bounce which one should keep a watch on. Coming to UPL, I think after the news there has been a correction, and again it has come back to the demand zone. So this level of 600 is quite a decent support. So I think it's a good opportunity from the risk reward point of view. And again we can have some good trading opportunity in this UPL. It can go back to 650, 660 level. So it's a kind of a trading bet. And one more stock which we are continuously recommending, and even though when the market was correcting, this was pretty holding strong, was SRF. So if anybody can look at the weekly and monthly structure, it is giving a multi-time frame kind of a breakout. So the short to near term outlook will be extremely positive. So even whenever there is a small corrections, I think there should be a buying opportunity in the SRF, and UPL stands to be a kind of a trading bet.
Rajesh, for giving us those details. But moving on, the recent sell-off has pushed several stocks way below their lowest target prices. And these stocks, by the way, have pretty good amount of analyst coverage as well. So now the question we are asking today is, do analysts need to rework their targets? Now, we've put a criteria of stocks with over 10 analysts actively tracking it. 309 Indian stocks currently are covered by more than 10 analysts, and 101, which is 1/3 of these, are currently trading even below their lowest target price, forget their consensus target price. Now, if you talk about the stocks trading with the highest difference to their lowest target, on top of the list you have a Suntech Realty. The difference from the lowest target stands at 38%, Sonata Software at 27%, and the same goes for Dhanuka Agritech. We also have something like an REC, Moltech Packaging, and Somani Ceramics, which are currently trading at a 22 to 25% discount to their lowest target price. Now, in terms of the analyst stance on the top 5 counters, for a Suntech Realty, analysts are bullish because of the steady progress across the project and the sustained project portfolio expansion, as well as the company now being debt-free and net cash positive in Q3. The key concerns lies to the exposure of the single Mumbai metropolitan region market, as well as regulatory, partnership, and macro risk. For something like a Sonata Software, it has a strong order book as well as AI deals working for the company, and management also expects the traction in healthcare, banking, and finance to continue. But on the concern side, management has guided for a fall in revenues. We also have Dhanuka Agritech. Lastly, the asset-light business model is fueled by a strong launch pipeline and healthy volume growth despite a tough environment. But on the concerning part, we do have that management has lowered revenue and EBITDA guidance for FY25 with issues with scaling up technical plants. But on this, I'll take, I'll come to you, Brajesh. From something like a Sonata Software or a Suntech Realty, or even something like the stocks that I mentioned, Dhanuka Agritech or REC, anything that pops up from the charts for you?
Yeah, I just gone through the stocks. Maybe the Moltech Packaging and even to some extent Suntech Realty. The structure is not very positive, and we are not very keen on recommending those stocks as of now. Maybe the RAC would be the only one stock where I think there can be some opportunity, because again, purely from the technical point of view, in the previous week there was a good buying which took support at 350 levels, and now we are just seeing some kind of a relief rally. So opportunity lies in RAC. Maybe some bounce back can be there. 450, 460 can be watched on. But rest of the stock, I think even the trend and the base is not forming as of now. So it would be a cautious kind of review, not too much keen to add any fresh longs.
Right. Well, thank you, Brajesh and Gaurang, for joining this conversation. And that's all the time we have on the show. Stay tuned to NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar, and my co-anchor Rucha. Well, Rucha, if you look at the markets, it has slipped below the 22,400 level, while the small cap and the mid cap indices continue to underperform the benchmark.
Oh, for sure. A little bit above 22,400 as we speak, but yeah, for sure, it's a bleeding day for all the markets. It's Nifty Bank versus the Nifty 50 as in the index as a whole. Well, Nifty Bank is up about a 0.5%. Nifty 50 is down about the similar levels. Nifty IT is the worst sector, down about 4% in trade. If you can pull up the sectoral heat map, we'll be able to see Nifty IT is the worst performer, followed by media, realty, PSU banks and metals. But what is doing good is the Nifty banking index, the auto index, FMCG, pharma and energy. Advances to decline ratio 1:1.87 is what is looking up as we speak right now. But also let's look at the constituents which are pulling the Nifty 50 index down. Most of the IT majors, as you can see, Infi TCS weighing very heavily. Axis Bank Bharti is also down after it announced the partnership with Starlink over here. But the ones which are doing well are the banking names: HDFC, Kotak Mahindra, Tata Motors and Reliance. Reliance Jio, well, it announced again a partnership with Starlink. So as we can see, Bharti is down, but Reliance is in the green. So that's strange over there. But also let's talk about the kind of IT movement that is happening. All the stocks in the red eyes, as I said, the losing ones, the most losing ones is Infosys, down about 5.5%. Yesterday also IT was bleeding in trade, but we'll definitely cover this during the show. TCS, HCL, Persistent are the ones which are losing, but a little less than the others. But also let's pull up the Nifty banking constituents. The ones which are not doing well are AU Small Finance, Axis Bank down about 2.5, weighing the most on the index in negative form. But the one which is doing well is IndusInd. Strange, 5.5% is what we could see over here. At the start of the trade, it was in the red about 4%, but now it seems to have been recovered over here. We also have Kotak Mahindra Bank, which is doing very well in trade and benefiting the index to stay up in the green. HDFC Bank also doing well. Let's look at the broader markets as well. Nifty Mid Cap 150 down about 1%. A small cap 100 slightly a bit in the red, 0.3% as we speak. But let's shift focus at the AMFI numbers for the month of February. Well, the industry's net inflow stood a little about at 40,000 crore versus net inflow of 1.8 lakh crores last month. My colleague Neeraj Shah joins us with more details on this one.
Well, the monthly inflows of February, there are 2-3 ways to look at it. Now, if you look at the SIP flows, let me start with that. There is a 400 odd crore reduction. Now that, to my mind, is explained by the fact that month on month, that is explained by the fact that February is 28 days, Jan is 31. So that explains SIP flows. So SIPs have stayed true to nature. What has gone down, most importantly, so the active equity funds have seen net inflow dip to 29,303 crores versus inflows of 39,688 crores month on month. A lot of it is explained by mid-cap and small-cap funds. Mid-cap funds have seen net inflow go down to 3,400 crores versus 5,148 crores. Small-cap funds have seen net inflows go down to 3,722 crores versus inflows of 5,721 crores. So nearly 2,000 crores gone in small-cap funds and nearly 1,800 crores or 1,700 crores gone in mid-cap funds. Large caps are okay. 2,866 crores versus inflows of 3,063 crores. Flexi-cap funds are okay, about 500 crores lower. Mid-caps and small-caps have seen a large dip. Sectoral and thematic funds, not a bad thing actually to happen, have come down to 5,712 crores versus inflows of 9,017 crores. And NFO flows are down as well. So effectively the scare in the markets, remember, 1 year of very low returns or no returns in certain cases, and certain fund managers going out and saying that SIP flow should be removed, done away with. I think that is probably what has led to this. Now the key question is, does this continue in March, wherein March is stable, or does March continue to see a downtick in inflows? One hopes that that doesn't happen in a big way, except for certain pockets where it might be prudent to do so. So sectoral funds, for example. But I think March is a litmus test. Why I say this before I end, why I say this is because even in the Macquarie feedback from European Union investors, Macquarie was told that global investors are watching out for what the Indian domestic retail investor does in mutual funds. So I think it's a very important barometer to keep in mind.
Well, sticking to the mutual fund data, in fact, as Neeraj sir was pointing out, if you look on a month-on-month basis, yes, the net equity inflow has come down by around 10,000 crore rupees. But who are the main contributors? Which segments or themes are the main contributors to this fall that we are seeing on a month-on-month basis? Firstly, we need to understand that there are 3 less days compared to what we had seen in the month of January. And if you look at scheme-wise, is the sectoral and thematic funds where we have seen the most amount of inflows going down. It has come down by nearly 3,300 crore rupees, which means that of the 10,000 crore rupees, 1/3 is well contributed by lower sectoral and thematic funds. Then there is small cap funds and mid cap funds, which have also led to a downtick of around 3,500 odd crore rupees combined basis. Then there is large and mid cap fund, which have seen a decline of close to 1,500 crore rupees. So to sum it up, nearly 80% has been contributed by these 4 schemes, which have led to this lower downtick in the net equity inflows, which means that around 10,000 crore is what the equity inflow has come off, and 8,000 has been contributed by sectoral funds, small cap funds, mid cap funds, and large and mid cap funds. So that is the main thing that we should watch out here. In fact, if you remember, sectoral and thematic funds have been always been volatile, because largely it depends on whether there is a new fund offer or not when it comes to sectoral and thematic funds. So it doesn't seem to be a bigger fall if you look data into perspective when it comes to the net equity inflows. Apart from that, which are the sectors, in fact, where mutual funds have added or reduced exposure? When it comes to adding exposure, financials, metal, Healthcare is where they have added exposure in the month of Feb, while they have reduced their exposure in sectors like industrials, IT, auto and auto ancillaries. Apart from that, their cash levels continue to remain higher at around 6.1% as against 5.6% that we had seen in the previous month. And which are the stocks where they have put in most of the money, and which are the stocks where they have actually exited? When it comes to large cap, they have bought Samil, Power Grid, Zomato, Varun Beverages and ITC, while they have sold PNB, Indian Oil Corporation, Wipro, PFC and Bharat Electronics. When it comes to mid-cap names, mutual funds have bought most of Vodafone Idea, Yes Bank, IDFC First Bank, HPCL and NHPC. So a clear shift what we are seeing from large-cap IOCL to a mid-cap HPCL in the month of Feb. And on the sell side, we are seeing Suzlon, Ola Electric, IndusInd Bank, NMDC and Hudco. And lastly, when it comes to small-cap names, there VMart, Bandhan Bank, Crompton Consumer, South Indian Bank and Piramal Pharma is something that mutual funds have added the most in the month of Feb, while they have sold Motherson Sumi Wiring, City Union Bank, Manappuram Finance, CSE and HCC. So this is broadly where mutual funds have actually bought and sold, or the mutual fund activity that we have seen in the month of Feb so far.
Okay, well, very interesting piece over there, Soumit. But speaking of mutual funds, well, we'll welcome our guest who will speak us more on the markets. Well, on the show, we have Mr. Mahesh Ojha, the AVP of Research and Business Development at Hensex Securities. Thank you so much. It's always a pleasure speaking to you with Mr. Ojha. Kind of volatile markets. First off, I would want to ask for your opinion on the kind of recovery that you're expecting in the short term, if any, that's pertinent to mention. So what's your Nifty target around this point in time?
I think we have a near bottom. So I think immediate, if you see on March may be volatile, but from April onwards, we may see some more upside. I think 23,000, 23,500 could be coming in April and May months. Currently, we are in a mid stage where some consolidation going on there, and all the investors which are HNI and ultra HNI, you can say they are also busy in some their work. So I think market could consolidate here, but if you see immediate after April on, from April onwards, we may see some more upside potential from upside. From banking sector, we are optimistic for upside. I think private sector banks can do well, and as well as public sector bank can do well. So some overweight on banking as well as pharma sector. So both the sector which we are preferred is banking and pharma. So currently we are optimistic, and slow and steady consolidation could we see here. But after from April onwards, we are optimistic for some upside.
So you're optimistic in the near term, but yes, it could be volatile. Okay, got that point. But let's also focus on the IT sector, which is trading in deep cuts today. Infosys emerged as the top laggard. It was on the back of a lot of events. First up, I will start with Morgan Stanley, which has come out with a note wherein, they have remarkably cut target prices for most of the companies. As you can see on your screen, Infosys has been downgraded to equal weight with a target price of 1740. LTI, Mindtree, TCS, Coforge are all overweight with their respective target prices. But what is interesting over here is the kind of discretionary expenditure which is actually under pressure. Most of the companies actually indicated how discretionary is doing well, etc. But in the recent LTI Mindtree management meet also, they mentioned that discretionary spends are yet to pick up. Coming back to Morgan Stanley, Wipro, Tata Elxsi, Cyient, as you can see, these three are the underweighted names for them. But in terms of the overall sector, well, they expect recovery to happen, but this will largely be very gradually, and therefore they see downside risks in terms of revenue growth and valuation multiple is what Morgan Stanley has pertinently brought out in their note. Valuations are a concern for most of the stocks in the market, where in fact mid-cap and small-cap valuations were the key triggers of this downfall in the markets that we could see in the last 2 to 3 months over here. Now, in terms of currency, yes, currency does support the earnings, revenue growth, etc., but that is only up to an extent. Valuation multiples have more room for downside risk is what they mentioned. Therefore, in terms of key traits, well, they prefer TCS over Infosys, Tech Mahindra over HCL Technologies, and Coforge over Emphasis. Another point which I want to point out is the kind kind of recession indication that people were talking about, that Donald Trump had mentioned when he refused to rule out that his tariffs could trigger a US recession. Now, this will impact the discretionary expenditure that the clients will be facing, and a reduction in that discretionary expenditure will therefore weigh on the top line of the IT companies. But coming back to you, Mr. Oja, on the IT services part, very mixed opinion on the street with respect to Nifty IT, but what's your take? Will you actually play it stock specific, and if yes, will it be top tier or mid tier?
I think in IT sector, very uncertainty there. So we are facing some selling pressure in IT sector. I think this could be a good opportunity for accumulation. TCS in large cap stock like TCS and Infosys, if anyone getting in these type of valuation. So these guys, see, brokerage have downgraded their target. That doesn't mean that the stock doesn't have valuation. So I think a stock can accumulation in this range. So TCS could be first pick from our pick, and the second on Infosys. Both the stocks are preferred in accumulation from near to 6 to 9 month horizon. If you see Infosys 3,500 level and Infi in 1,570 levels, it's I think it's a good pick and a good time for accumulation in longer term horizon.
And what about some of the mid-tier names? Would you prefer that one, Mahesh?
No, we will prefer only large cap in first line because we are seeing some more uncertainty in IT sector. So currently we are only stock specific, and we are seeing only large cap. So after that, were any stabilization look, we will sort out another stock also.
Okay, all right. Coming to you on LTIMindtree, actually, before coming to you, I would like to mention that they had the management meeting yesterday, wherein they had mentioned that discretionary spends remain muted. But Mahesh, they were the ones which called out for an uptick in discretionary spends, if I'm not wrong, a couple of quarters back. And a few of the management changes has also been reflected, but they mentioned that these changes will only be at a very small scale and will not have major impact on the stock as a whole. Specifically talking about LTIMindtree, what do you think of this counter? Do you think that this is the right point for an investor to get into it?
Yeah, I think these levels are good, and 4,200 to 4,500 level could be a consolidation range. Once it's above 4,600 level, we can see up to 5,200 to 5,400 range. Stocks looks attractive on these levels, so I think accumulation can be start from these levels, but start in a staggered way because currently market in IT sector some uncertainty. So this is the opportunity for accumulation in any dip side. So I think LTI could also be considered.
Okay, so LTIMindtree, just giving a context, over last 6 months dropped about 30%. Over last 1 year dropped about 13%. Just give us some kind of pick between LTIMindtree and someone like, say, a Tech Mahindra. Any kind of long short trade if you would recommend, maybe for a year's time in IT?
No, that would be not preferable from current view because both the companies working are something different. So I think we are only doing longs in large cap, but from stock specific and some medium to long term horizon. So LTM could be preferred, and Tech Mahindra also could be preferred in lower level. But yes, we will look on TCS and Infosys in first space.
Right, moving on. Tata Motors is the other stock that remains in focus. The company met multiple analysts, and what are the key takeaways coming out of that? We have Puneet joining us with all those details.
Well, thanks for that. So there are 5 key takeaways from this particular meeting. The first one's of course on Jaguar and Land Rover, and I think this is the biggest one across the verticals that the company operates, and that they maintain their guidance of about more than 8.5% EBIT margins for Jaguar Land Rover business in FY25. Why is this important? Is because in quarter 4 they will have to achieve a 10% EBIT margin to meet the guidance of about 8.5% for the whole fiscal year of FY25, and that was something that the market had some concerns about. But now that the company has come out and affirmed this, it's a big positive sign going forward, because Jaguar and Land Rover both account for 70% of the company's overall revenues, and hence it's a big driver in terms of valuation as well as growth prospects. Apart from that, they didn't mention that while Nuvama feels that JLR's performance in FY26 is likely to be stressed because of discontinued Jaguar models. The new ones are expected to come in the fourth quarter of FY26 specifically, and that could be something to watch out for. But there are multiple levels of profitability to get improved even from these levels as well. We've seen a stellar run in terms of the financials of JLR, even though the sales have remained same at around 4 lakh units per year. But the EBIT margin has grown by roughly from roughly 8% to 15% in the last 5 years. So definitely a big pivot on that. The second one's some theory on the US remaining steady for the Land Rover business. Now a lot of sales happening in that market. While Europe has been subdued and China has been falling, US has been steady, and that's what the company expects. They're expecting China to remain weak, but players like BMW and Mercedes will get more impacted because of higher share of sales from China. Apart from that, retail situations is challenging because they've reduced their footprint by 30% in terms of store sales. Apart from that, Kotak is seeing some trends gradually improving in Europe as well as in UK. So key watchable going forward as well. Finally, on India passenger car and the commercial vehicle business, they mentioned a very big aspect that they are repositioning the Curve model as well as the Altroz model, which has been kind of disappointing in terms of sales. So it's going to be a big pivot, and watching into FY26, that's one key update. The other one's launch of the Harrier EV is something that the company is very bullish about, apart from the Sierra models, both in petrol as well as in electric. And finally, what brokerages are estimating, Kotak has retained its ad rating but lowered target price to 750, while on the other hand, ICICI Securities has upgraded the stock to a buy. Target price of 831 rupees per share. So overall, it's a big positive momentum continuing in JLR at a time where there was some, reaffirmation needed in some key aspects such as JLR's guidance, and that has come true. Hence, the positive impact on the stock price.
Right. Thank you, Puneet, for that detailed takeaways coming in from Tata Motors. But Mahesh, coming to you, how is Tata Motors looking like as a stock? On a last 6-month basis, if you look at it, has corrected nearly 33%. Does it offer value to investors at this moment? If not, then any other top pick in the auto sector?
I think Tata Motor is preferred in this sector and low P compared to other. And we can say Tata Motor safety is more than any other counter in a particular space. And we are already suggested our client in lower level for Tata Motor in long. So I think Tata Motors has much more upside potential in 1 year. If you are looking for 1 year horizon, I think 800, 850 level could become. And if any surprise from in result, we can see upward journey continue. But from current perspective, if you are looking from medium to long term perspective, we are optimistic for at least 750 plus level in a 3 to 6 month horizon.
Okay, well, shifting focus to the pharma sector, we have Zydus Life Science, which is buzzing in trade after the company cracks its new deal. It's set to acquire 85.5 approximately of Amplitude Surgical. My colleague who tracks this sector closely joins in with more details. Varsha, take it over.
Thank you for that. So yesterday there was a con call which was conducted because due to this acquisition. Now let's see what are the key highlights of that con call and the investor presentation stated by Zydus. They've been doing background work on medtech for the last couple of years, and the medtech can be for India what pharma was 30 years back, which is a sunrise sector as per the management. And among different subsectors, top 5 to 6 players usually take 60% of market share as per the management, and this is changing now, and the regulations, that means a lot of best practices are also being picked up. The proposed acquisition is a platform for a company to execute global medtech strategy, and a company that is Zydus Medtech aims to be new growth driver for the Zydus group, and they focuses on key 3 priority segments, that is cardiology, nephrology and arthroplasty, and company will be focusing on expanding its global footprint and also will pursue vertical integration as well. Now this acquisition positions medtech as a key growth driver for Zydus, and they're going to expand in other European countries, and France still has upside potential, and company is also expanding into US once it get once it expands its robotic offerings. And initially there were no plans to expand in India, but now companies thinking to expand in India as well. We do have brokerages views as well. Let's see what Incred Equities is saying. They say that deal appears to be fairly priced, and Amplitude, the company which Zydus will acquire, the operating cash flow remains weak and the free cash flow is negative for the company, and they expect operational efficiencies and synergies to gradually enhance performance, and a meaningful improvements will materialize over the next 1 to 2 years, while Axis Capital has maintained reduced rating with target price, which has upside potential of merely like 1%. What they say is that Zydus' new venture create uncertainty, and expansion into biosimilars and medtech carries risk according to Axis, and the key drugs face upcoming competition, and with this the EBITDA margins, if you see, is expected to drop to 24% by FY27.
Okay, well, a lot of questions, Mr. Ojha, but because of crunch of time, we'll have to wrap this conversation over here. Thank you so much for joining us. It's always a pleasure speaking with you. Well, with that, it's all the time that we have on this edition of Profit Top Trade. Stay tuned for IMC.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can.
Welcome, this is India Market Close. I'm Agha Vakil. I'll take you through how we are looking at markets pan out about 1.5 hours before we see it end. Right now, the Nifty is down by around 0.4%. We haven't seen too much traction. The Nifty Bank up by around 0.4%. But again, a very mixed day of trade. Let's take a look at the Nifty heat map to see where there is a pull and push, and in fact, which is, well, influencing the Nifty 50 index. So IndusInd Bank actually looking at a recovery, short covering in fact, up around 5%, followed by Kotak Mahindra Bank and HDFC Bank. And I reckon that these three banks are the reason why the Bank Nifty is also moving higher by around 0.4%. What is, however, under pressure is the entire IT pack. So we have weakness in Infosys down 5%, Wipro, Tech Mahindra, HCL Technologies, all of them losing out. In fact, even TCS has declined by around 2%, thereby putting extreme pressure on the Indian IT index. What about the broader markets? Let's take a look at the advanced decline ratio and see how things are faring there as well. And where, as you can see, not an encouraging sign. In fact, we have just one gainer for two losers in the broader markets out there on the NSE at the moment. Let's talk about the broader markets too and see how things are panning out there. Well, if we can actually pull up the mid-cap and the small-cap index, the mid-cap index is down around 1% and the small-cap index is also down around 0.5%. And in terms of your key gainers and losers as far as your broader markets are concerned, on the BSE 500, perhaps you can pull that up as well. We have NLC up 4%, Balrampur Chini, Godfrey Phillips, UTI Asset Management and Schaeffler, all of them advancing anywhere between 3 to 5%. And on the losing end, we do have weakness in FSL, the Ramco Cements, HLE Glasscoat, Indus Towers and Coforge. All in all, it's a market in which the IT sector particularly stands out towards the downside. And besides that, we have plenty of other losers as well. But with that, I will hand it over to Puneet to take us through the next conversation. Puneet, over to you.
Well, thanks for that. So definitely it's, we're going to be speaking to Mr. Vishal Chaturvedi, who's the head of cell business at Ola Electric. Mr. Chaturvedi, good afternoon and thank you so much for joining us today. A little while back, there was a very big, exchange filing that the company had released about, being EBITDA break-even in the automotive segment in Q1 of FY26. So that's essentially in the next couple of quarters. I just wanted to start off first with that and then get into the details of the cell business as well. Specifically, you mentioned that the company is seeing roughly about 90 crores of savings because of cost optimization as well as the network transformation reduction program that you had. So just if you could start off us with that.
Thank you for having me here. And yes, we did file in the exchanges that we have undertaken network transformation and the whole front-end transformation, and we have finished this transformation, and which would lead to 90 crore of savings, and hence we are aiming for Q1 EBITDA profitability for our automotive segment.
Specifically, I just had a follow-up because you mentioned that, and you mentioned it very well in the press release, that apart from there have been some layoffs. If you can firstly confirm that, because there were some media reports speculating roughly about 1,400 to 1,500 as a second round of layoffs. Has that already been effective? And the savings that you mentioned specifically for headcount reduction, does that include the second round of layoffs?
Yeah. So if you read the press release that we and the release that we filed with the exchanges, we broadly categorized our efforts in three broad buckets, right? So one is the whole network transformation, the other one is the warranty and services, and the third one is the people, like the headcount reduction. So all the we've built in a lot of automations in our front-end processes, bringing in efficiency, leading to reduced headcount. So all of that has been factored in the savings that we filed today.
And specifically because you reported roughly negative 28% in terms of EBITDA margin loss in Q3. How is Q4 shaping up? Because you mentioned that this will effectively become an EBITDA break-even business in the automotive side. How much of that effect will we see in Q4? And while I know you can not give any specific number, what is the kind of range that we can expect in terms of improvement from Q3 in terms of EBITDA margins for the automotive segment?
Yeah, so our results for last quarter was out, right? And all the transformation initiatives have been executed in this quarter. So you'll see, some benefits of it in this quarter. But largely, all the execution that has happened will translate into results in the coming quarter, Q1 FY26. That's where we get profitable at an EBITDA level, like breaking even at EBITDA level.
Now, just one question specifically, on the store count, because in December you all went from roughly about 700 to 800 odd stores all the way to 4,000. Now there have been some reports that there has been some investigations happening in terms of the operationality of these particular stores. If you can just clear the air, how many stores are currently operational as of today? Out of those 4,000 stores, is it that all of them have started doing business specifically, and do they already are commencing sales? How many of them already sold their first bikes over the last couple of months?
Too many questions, too many data points, Puneet. But so yes, as of last quarter, we had about 700, 800 stores, and we took our sales point from those numbers to about 4,000 plus. Now, the good thing is that a lot of these stores, like most of these stores, have now started contributing to our sales number. And the network overall takes time to mature, because all our net expansion came predominantly in the tier 3, tier 4, tier 5 markets in the country. So these the stores that we have, the network will continue to mature like in this quarter and the coming quarter.
Any kind of quantification that you can give us in terms of the operational store count as of today?
So we have our own stores, and then we have the multi-brand retail outlets as well, from where we sell to. Both put together will have about 4,500 sales point across the country.
I'm sorry to pry on this, Vishal, but what would be the number specifically? Is it about 2,000 stores that are currently operational in the country?
No. So we as I said, both put together, we'll have about 4,500 sales point, and our own stores would be in the range of 3,500-ish.
Okay, all right. And just wanted to talk about one of the press releases that you had put out on March 4th. You had received a letter in terms of the PLI for the advanced battery chemistry. If you can talk to us about that, what is the timeline? Because earlier it was said that from Q1 onwards you'll start integrating these cells in your scooters itself. Does that still count? And if you can talk about any kind of response that the company will file from this letter to IFSC. Yeah.
So, Puneet, so we were we won the ACC PLI, and we're the first companies to actually install all the capacity. as per the PLI. And as commented earlier, we are in the position to start our mass production from Q1 FY26 and integrate it with our products. So we are on track to deliver that in the coming quarter.
Just final couple of questions. One was on the electric bike segment. Now, you had mentioned that you will be launching the bike in March. Any kind of update that you can give currently on the same?
No, so we are on track. As we speak, we are on track to start delivering our motorbikes to our customers end of this month, early next month. So that will start flowing into the numbers as well in the coming quarter.
So is the launch expected in the next couple of weeks before the end of this particular month? Is there a launch event that's planned?
So we did launch our product in this quarter, like last month, right? And the deliveries are scheduled now to our consumers, which will happen as per the earlier timelines that we had committed.
And just one last question on the Gen 3 scooter sales, because that was expected to, have a bearing also on the positive side. And I just wanted to, club this question with with the expectation that management had put out that EBITDA break-even will happen at 50,000 units. That's what was said by Mr. Bhagesh Sharkar in the Q3 conference call. Currently, while February was an anomaly, you are selling roughly 25 to 26,000 odd scooters in the month. And with this update in terms of reduction of about 90 crore savings, what is the current number in terms of EBITDA break-even? If you can just update us, would it be lower than 50,000 now because of this new network, cost savings that are happening?
Yeah. So again, couple of questions. So one, as we take this network transformation and other initiatives on the cost side, so our overall cost base has gone down, right? That has resulted in our goalpost, getting better in terms of unit that we need to sell for breaking even, right? So all of that has resulted in us actually breaking even at a lower units in the coming quarter. And coming to your Gen 3 point, we have already started deliveries to our customers, beginning of this month. As part of the network transformation that we spoke about, right, we had a bit of hiccup in terms of registration, where we to better our customer experience and to also have a point around cost, we moved the registration process in-house. And now if you see, and so there was a bit of hiccup in terms of registration numbers on Vahan for the month of Feb. Now, if you see, our registration numbers are back on track. In fact, it is better than our Jan and Feb sales daily run rate. So we are back on track. You'll see all the numbers going forward on Vahan, which will result in market share as well.
And Vishal, you did mention that because a lot of sales was expected to spill over in the month of March, and if I just go by the numbers, 25,000 is something that you sell on a monthly basis.
Yes.
In February, as per Vahan, you sold about 8,300 odd units. So those kind of 16,000 will definitely go into March, apart from March being a strong month, because you also had a base year effect of the subsidy in the last year. So would it be safe to suffice that in this particular month you would be expected to show more than roughly about 40 to 50,000 units? Would that be a safe assumption to make?
I mean, that we'll have to wait for the month end, but as I said, we had a registration hiccup in the month of Feb because we moved all our registration process in-house. We are back on track in registering. So the orders that were pending for registration in the month of Feb, you'll start seeing the impact of it in terms of volumes in the March numbers.
Well, Vishal, thank you so much for speaking to us right here on NDTV Profit, giving us a lot of clarity on a number of issues. Thanks so much for joining in, and we look forward to our next conversation. But thank you so much for joining us today.
Thank you. Thank you for having me. Thank you.
So Harsh, specifically Ola Electric, multiple filings over the last couple of weeks. I think we did try to get some clarity on those aspects, but stock has corrected from the listing levels as well, seen some pressure. But
and outperforming today, Puneet.
So outperforming today in a market like this, but at a very interesting juncture, like valuations have halved from what it was at listing.
Yes.
And management is expecting better performance going into Q1. So a lot of things to watch out for.
Well, yeah, and you'll also want to see whether they, under the current circumstances, whether they can continue to gain market share, because I think that will also be the key with regard to where the Ola story starts to play out. Thanks so much for that perspective, Puneet. But really sector in focus today is the Indian IT sector. Let's pull that one up. Let's also look at the constituents within the Nifty IT, because clear pressure across the board. You had a couple of notes, of course, and we've discussed that pretty much through the day. But it's definitely sector of the day. And, we're going to break down as to why we're seeing the kind of cuts that we're seeing on the Nifty IT today. Rucha's here with that perspective. 1,350 points shaved off the Nifty IT today, Rucha.
For sure, 3.5% down in today's trade. Nifty IT top losing stock is Infosys, followed by LTTS, and also this has been the case across not only the mid-tier names but also the top tier are losing out. And there are a few factors behind this. First, I'll start with the Morgan Stanley note. It came out with a note on the IT sector as a whole, wherein in particular stock they have actually cut the target prices and also downgraded Infosys from an equal weight to a downgrade rating, and the target price cut has fallen down to 1740 rupees. This is also followed by LTI, Mindtree, TCS, Coforge. All the three maintained overweight over here with their respective target prices. But moving on to the next slide, we'll see that there are three stocks wherein they have maintained their Okay, we'll move on to equal weight first. There are these four stocks wherein they have maintained their equal weight rating with a target price over here: Tech Mahindra, HCL Technologies, Emphasis, and LTTS. So mix of a top tier and mid tier names, but underweight is what they have on stocks like Wipro, Tata Elxsi, and Cyient. There you go, 265. 5400 and 1210 is the target price they have for this. But in addition to this, they also believe that there are downside risks which they see in terms of valuations, though the currency depreciation might support the margin and it will be maintained at the current level. But what is more alarming is the valuations, and therefore they still are recalibrating growth and multiples as well. Well, in addition to this, they also mentioned the key traits that are being given by them. They prefer TCS over Infosys, Tech Mahindra over HCL Technologies, and they also prefer Coforge over Emphasis. But as I mentioned, yes, they did mention about how the valuations are expensive and still see some downside risks with respect to the sector as a whole. Well, apart from that, I would also want to highlight the kind of recession fears that are going on in the market. Well, Donald Trump denied the fact that that might be recession because of the tariff that they are imposing. Now, this will have, or this might have, an effect on the discretionary expenditure of the clients in the US. So his reduced discretionary expenditure might affect the top line of the IT company, and that is why this kind of downfall was even seen yesterday in the IT sector as a whole. But apart from that, they also mentioned that for selected stocks, multiples could become polarized over here, and Infosys, if I would focus on specifically, which is down about 5% in trade, this one has a higher share of exposure to discretionary expenditure, and a hit on discretionary is what has gotten the stock down in today's trade. So overall, bad sentiment on IT because of what is going on in the US as well, and yes, the Morgan Stanley note that I pointed out.
Okay, thank you so much for that, Rucha. And to take this discussion further, because you're seeing the kind of knock across the IT stocks, at least in markets today, we have Sumit Pokharna, VP Fundamental Research Analyst at Kotak Securities, joining us to talk to us about exactly this. Good afternoon, Sumit. Interesting confluence of factors was supposed to actually aid the Nifty IT. You were expected to see rate cuts, which could hopefully push IT and discretionary spend higher. You were expected to see a business-friendly administration in the US to actually aid numbers for Indian IT. You were also expected to see Gen AI spend start to pick up and IT benefit from that. None of that really coming through. What's the sense at this point? And is this kind of 3.6% move justified in an environment like this?
Yeah. So you have correctly highlighted the key concerns out there. Expectations are building up about slowdown or recession in US. So that's too premature as of now. But yes, whenever uncertainty comes and the expectation of inflation building up because of the tariff war, what that may result in delaying or postponing of rate cuts by Fed. So which is not healthy for BFSI vertical in particular. So that leads to lower IT spend by BFSI, which is the highest IT spender among all the verticals. So that is not good. And another point which we have noticed is that healthy pipeline has been built up by most of the companies. But what is going wrong is the conversion, which is stuck in limbo. So you have pipeline, but that is not converting into orders. So that is a big concern. Another point which we have noticed is the increased competitive intensity for large deals, which is putting pressure on the pricing part. So again, that is a concern for this. So given all these factors, the stocks have corrected a lot.
Okay, Sumit, stay with us. We also have Shivangi Sada. She's an analyst of equity, derivatives and technical at Motilal Oswal Financial Services, who joins us on the show. Good afternoon, Shivangi. Thanks for joining in. It does seem like we're looking at volatility, some amount of volatility return, at least in the broader markets. Maybe the benchmarks not so much, but I want your view. How are you doing and dealing with the Nifty 50 at the moment? And if you could also give your view on the Bank Nifty. Shivangi, I think you're on mute.
So we've seen that Nifty index has witnessed some sort of pressure at the higher zones. It has been struggling to hold above 22,500 mark. But the pullback move from the yesterday session has been quite well. And today we are witnessing, after the range-bound move, we are kind of heading towards the higher levels of the day. But overall, there has been a good support base buying at 22,300 marks, which will act as an important level as a support zone. So keeping that in mind, we could buy on any declines for the next upside immediately towards 22,650 and then 22,900 marks. So buy on decline to continue for the Nifty index. We've seen consolidation of the last 4 trading sessions, which requires a little bit of unwinding at 22,600 zones for the next fresh leg of rally to continue. Now, talking about Bank Nifty, this index has been underperforming from the last 1 week, but there has been NBFCs which have been supporting this entire financial space. Also, talking about the heavyweight banking stocks, the ICICI Bank, HDFC Bank, these have been some of the names which are lifting the spirits for this index. So overall, we have been, struggling to hold above 48,000 today. But overall, till the time we hold above these levels, it's a good sign, and we could buy on decline. We've made a good, bottom near 47,700 on an immediate basis. So 47,700 would be an important support to watch out for buy on decline in Bank Nifty for the next targets of 48,750 and 49,000 level.
Okay. Thanks for that view, Shivangi. Sumit, I want to come back to you and I want to stick to you with regard to IT because that's the story of the day. So Sumit, what are those factors which are going to lead the revival, and how long are you penciling in terms of time for a revival to start to kick through?
Yeah, that's right. So discretionary spending is the most important piece which we need to focus on. It remains muted as of now and will remain at similar levels for at least the next quarter. So that is the timeline which you were asking for. Then companies are prioritizing cost savings, including from savings from IT, providing vendor consolidation opportunities. So that is another thing which the opportunity is giving. But what is important is you need to see some green shoots, meaningful green shoots in discretionary spending, which will push or revive the sector. So at least for next quarter, we do not see anything happening on that front.
Yes, Sumit, we've heard this for way too long. We're seeing some bit of green shoots, but really that's not translating to numbers. And therefore, I want to ask you on a different tack. What is leading to this apprehension on the index? Because technically, yesterday versus today, nothing major has changed per se on the global front. So would you just believe that given the circumstances that are playing out, valuations were a little elevated and that's what's happening? Are we entering a bit of a correction in IT? And if that is so, if there is limited visibility for the next quarter or two, do you expect more of a correction to come through over the next maybe month or two?
Yeah. So the first part is that we are living in a very dynamic scenario right now. So you have rightly mentioned earlier, people were expecting that 2025 we will see the demand revival or discretionary spending going up. But then the political change in US has and the tariff war, the scenario has again changed, which nobody had anticipated that it will be that severe first. So it's a dynamic situation and market will react accordingly. Coming to the valuation part, certain pockets were definitely expensive. So we have seen a major correction happening out there. But still few companies where the business is very strong and they have seen all these ups and downs, they will come back very strongly. So I think Gen AI gives a very great opportunity to Indian IT companies. And we will come out with strongly with these new offerings which the company is working on.
Okay, Sumit, quickly on to what you prefer at this point. What would you suggest in terms of a buy at this point, and how are you looking at mid cap and small cap IT valuations as well as opportunities? What are you liking within that space?
So we in the large cap space, we like TCS, Tech Mahindra, LTI Mindtree, and Infosys. LTI and Coforge in the mid cap space. However, we have been negative on HCL Tech, Cyient, LTTS, Mphasis, Wipro, Tata Elxsi, KPIT, and like Tata Technologies. So one should for grabbing this opportunity, market is giving a good opportunity to create a long-term portfolio and focus on large cap quality companies, and mid cap we can focus in LTI Mindtree and Coforge.
Okay, thanks so much, Sumit, for coming in, giving us that perspective. Good speaking with you on a day like this, where we're seeing a bit of pressure, I mean, much more than a bit of pressure on the IT index. Again, if we pull up constituents, and we have Shivangi with us to talk to us about technicals. Shivangi, Infi down nearly 5. You have an LTTS down 5+%, a Coforge down 4.5%, a Wipro down 4%. Any of these names something that you're looking at from a trading perspective, or would you currently stay away from IT?
IT stocks have been, underperforming, and we've seen that any meaningful, bounces have been utilized for selling itself. If we talk about the heavyweights as well as the smaller banking names, I think all of them have been quite a lot in pressure. But overall, I think we would want to, stay light on the IT pack for now, and gain. And wait for it to gain momentum, and then switch to these sectors. But overall, the other sectors like some of the consumption names, also the banking and financial pack, and the metal space is looking quite positive for the time being.
Okay, point taken. Stay away from IT at this point. Okay, so you've highlighted metals as possibly a pack that you'd look at. Give us your picks first for this afternoon.
So for the afternoon, I've picked something from the travel and tourism space. First up is Indigo. We've seen that this stock has been resilient despite the market volatility. And from the last 7 to 8 weeks, we've seen that it has been shifting its base higher, which means positionally there has been good support-based buying. Now, stock is trading with comfortable volumes, and after the cool-off of the last earlier this week, we've seen that the last 2 sessions have recovered from the retracement levels, so looking quite positive. Recommending a buy here with a target of 4,900 and a stop of 4,600 zones. Now, on my radar, second pick is Bajaj Finance. The NBFC in the financial space have been an outperformer in the entire market in the last 3 to 4 weeks, and Bajaj Finance has been one resilient stock which has outperformed from the last 16 weeks. So it has been, respecting its upward sloping channel as well. So trend line has been respected, and we've seen a price volume surge today. We've seen multiple attempts at 8,200, which has been a buying zone for this stock. So recommending a buy here. So the next targets that we're looking at for Bajaj Finance is around about 8,800 and a stop loss of 8300 zone.
Okay. Okay. So those are some to keep on your radar as well. Thanks so much, Shivangi, for joining us this afternoon. We'll let you go on that note, and with it, we'll also slip into a very quick break. We have plenty lined up for you. We have a conversation with Mark Faber on the other side. We also have Sudeep Bandyopadhyay, Kush Bora giving us their calls, and we have Heard on the Street. So stay tuned. It's a packed show.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Welcome back. This is India Market Close. Well, we are actually now at the time of the show when my colleague Soumit Sarkar joins us to tell us all about the chatter on the street. Well, this segment is called Heard on the Street, and Somit is going to tell us exactly what he is hearing about. So, Somit.
So, multiple stock-specific actions that we are seeing. Firstly, Siemens is one stock that remains in focus, and what dealers are indicating is that for the second consecutive day, they're seeing block deals coming in by FIs on this counter. So, selling pressure coming in for Siemens. Second stock is Tata Steel. Again, sell flows on FI desk today in trade is what I'm understanding specifically to Tata Steel. For Grasim, in fact, dealers are indicating that there are some buy flows. So the stock is down around 0.6. In fact, yeah, it has recovered from its lows, and that's what the dealers were indicating, that there were buy flows on the domestic mutual fund desk, and hence we could have seen this kind of a recovery when it comes to Grasim. And then there is a couple of stocks that have been in focus in trade today, that is Indus Towers and Paytm. So both these counters, if you look at, have been beaten down today. In fact, Paytm is down because of the overall sell flows that we are seeing on the tech stocks, and Indus Towers because of the Starlink thing. But what I'm picking up is that large HNIs have been accumulating both these counters at the lower levels currently. So that is what is interesting here for Paytm and Indus Towers.
The other thing that's interesting, Somit, and you cover the space closely, is the fact that there's also the Starlink tie-up, and how much could that actually impact an Indus Towers? What's the sense there, and is that possibly also keeping a lid with regard to how the stock is performing? And would it therefore also cap returns even though there are buy flows?
So that is actually what I was speaking to multiple investors, and what I'm understanding here is that for Starlink to be a big success, pricing is the most important thing, and pricing could not be lower for Starlink, given the fact that they have entered various developing nations in past, and African nations. Even in fact in Nigeria also, the lowest price that they're offering is $25, and in India you get mobile services and broadband services in less than $5 or $3 per month. Yeah. So they won't be able to beat that. So it will obviously enter the Indian market, but it will cater to a very niche segment. So becoming a mass product is the chances of it becoming a mass product is very less. Hence, Indus Towers' existence won't come into question. Obviously, there will be more tower requirements as and when mobile density needs to increase or mobile connectivity needs to increase. So, tower requirement obviously will be there. And the most important thing that various experts and large HNIs have indicated is the fact that there's a big possibility that Indus Towers might announce a dividend in the fourth quarter. And that dividend could be anywhere between 20 to 25 rupees. And if you consider that, then the dividend yield for Indus Towers at current price stands at around 6%, which is much higher than what even a PSU offers you at this moment. So that's the most interesting part coming in for Indus Towers.
Absolutely. 6% dividend yield on Indus Towers. That's very, very interesting. Thanks so much, Somit, for bringing us all of those insights, as always, every day at this hour. But let me go across to Sudeep and take a view from Sudeep with regard to Indus Towers in particular and telecom in general. Sudeep, this buy flow and action within Indus Towers, keeping the stock in focus, even though the stock is actually down today, roughly 4.5% lower as we speak. But the kind of dividend yield it offers and the kind of cash flow that it generates and the kind of tailwind that telecom currently has, interesting time to accumulate this one?
Oh, absolutely. I think, these corrections are opportunity to accumulate these stocks, and you're absolutely right. The dividend income is strong, and of course, the telecom density will go up only in India, in a country like India, and the services of Indus will be even more in demand. So there's absolutely no problem. The Starlink's entry and, things related to that has actually no direct repercussion on Indus at this stage.
Cool.
Okay, well, I believe we also have Kush Bora here joining us. Well, Kush, good afternoon. Thanks for joining in. What are you making of the markets at this point in time, the benchmark specifically?
Hi, again. Hi, Sudeep. Well, consolidation, and that's the name of the game, at the moment. We've seen a bit of a recovery last week around this week. If you see yesterday also, we did, hold above that support zone of 22,300, 22,200. We recovered, lost ground today, also a very similar structure. So this does suggest that there is, strength in the markets from these levels at least. 22,500 is perhaps going to be the pivotal level, the straddle that we spoke of last week. About 300 points range that is still playing out well, 22,200 on the downside and 22,700, 800 on the upside. I think that's going to remain the range for the market. One of the reasons for that is for the markets to move higher, you need the heavyweight sectors to participate, which is banking and Nifty. and currently that's not happening. Today, yes, the Bank Nifty is up about 0.5% or so. But if you see from early February onwards, this index has been in bit of a downward sloping channel, and time and again on the channel I've spoken about how on the way up Bank Nifty might not outperform as it did on the way down. So unless one of these sectors turns a corner, or perhaps both, the upside on the Nifty could be limited. But the fact that we've tested 22,300 a couple of times and rebounded from there, I think does give us support. As I said, as long as 22,200, 22,300 zone is held, you should continue to stay long on the Nifty. The higher targets are 22,700, and once that is taken on 22,880 as well. Bank Nifty, I still remain a little skeptical on.
Okay. Thanks for that view on the overall market, Kush. But, just quickly give us your picks for this afternoon as well.
So on the long side, I've got ITD Cementation. We've discussed about this stock a couple of times in the past. It has a broad range of 540 on the upside to about 520 on the downside. It's now broken out of that range, sustaining yesterday. The move was on the back of good volumes. Today, the stock did open soft but has moved higher. So there is strength clearly visible in ITD Cementation. Target 565, 585, 525 is the stop loss. On the short side, I think it's very easy to guess is stocks from the IT space, which is startup technologies. By the way, yesterday Cyient was one stock that we discussed as a short trade, and the second target on that was 1225. That target was hit today. Tata Technologies continues to reel under pressure, has been doing so for quite some time now. But what's interesting is that in the last 8-10 odd sessions, while some of the other stocks were trying to stabilize, this one still continued to slide down on the back of very strong volume. So targets on the downside are 620 and 610. 640 is the stop loss, and that's for the March futures.
Okay, interesting. Shifting focus to the Amphi numbers for the month, which have come through. Industry net inflow stands at roughly around 40,000 crore versus the 1.88 lakh crore last month. Neeraj Shah joins us to tell us all about these numbers, contextualize it, because we're going to have a quick conversation on the other side of that. Neeraj.
Well, the monthly inflows of February, there are 2-3 ways to look at it. Now, if you look at the SIP flows, let me start with that. There is a 400 odd crore reduction. Now, that to my mind is explained by the fact that month on month, that is explained by the fact that February is 28 days, Jan is 31. So that explains SIP flows. So SIPs have stayed true to nature. What has gone down, most importantly? So the active equity funds have seen net inflow dip to 29,303 crores versus inflows of 39,688 crores month on month. A lot of it is explained by mid-cap and small-cap funds. Mid-cap funds have seen net inflow go down to 3,400 crores versus 5,148 crores. Small-cap funds have seen net inflows go down to 3,722 crores versus inflows of 5,721 crores. So nearly 2,000 crores gone in small-cap funds and nearly 1,800 crores or 1,700 crores gone in mid-cap funds. Large caps are okay. 2,866 crores versus inflows of 3,063 crores. Flexi-cap funds are okay, about 500 crores lower. Mid-caps and small-caps have seen a large dip. Sectoral and thematic funds, not a bad thing actually to happen, have come down to 5,712 crores versus inflows of 9,017 crores. And NFO flows are down as well. So effectively, the scare in the markets, remember, 1 year of very low returns or no returns in certain cases, and certain fund managers going out and saying that SIP flow should be removed, done away with. I think that is probably what has led to this. Now the key question is, does this continue in March, wherein March is stable, or does March continue to see a downtick in inflows? One hopes that that doesn't happen in a big way, except for certain pockets where it might be prudent to do so. So sectoral funds, for example. But I think March is a litmus test. Why I say this before I end, why I say this is because even in the Macquarie feedback from European Union investors, Macquarie was told that global investors are watching out for what the Indian domestic retail investor does in mutual funds. So I think it's a very important barometer to keep in mind.
Okay, Neeraj, thank you so much for getting us all those updates. So firstly, well, a lot of data to sift through, and for that, and perhaps get a better understanding and insight into the month of February, we are in conversation with Suranjana Borthakur. She is the Head of Distribution and Strategic Alliances at Mirae Asset Investment. Suranjana, good afternoon, and thanks for taking the time out. I guess the biggest thing that stands out here, and also perhaps also on expected lines, is that the flows, the net flows in mid caps and small caps have come off. Notwithstanding, the month of February is just 28 days, in. What are you making of that?
I think, hi, good afternoon. I think overall, if you see in terms of the inflows, I think, like you rightly mentioned, mid and small, as well as I think the sectoral segment is somewhere where the inflows have tapered down a little. But if you see the overall numbers from 39,000 to 29,000, which is, I think, a 9-month low, which is there in equity inflows. I think mid and small, while it is also to do with a little bit of getting spooked in the market, but I think the large and flexi, which are the two categories where the incremental flows are continuing to come, I think there the inflows remain intact. I think sectoral, which was getting a very disproportionate sort of allocation a couple of months back. If you see 2 months back, it was getting an inflow of about 15,000 crores, which is last month was around 9,000 crores, has now come down to around 5,700. And this is in spite of about 7 NFOs that happened in this category, which garnered around 2,000 crores. If you see the overall NFOs which have happened, that is actually this team has continued in terms of number of launches, because 29 new products were launched last month. And I think that garnered somewhere around 4,000 crores. So the inflows through the NFOs have tapered down a little bit. I would also think that the ELSS category usually, which sees a little bit of uptick during this Jan to March period, has actually seen not too much of an uptick because of probably the changes which have happened in the union budget, which actually makes the new tax regime more attractive. I think also if you see the debt inflows which have outflows which have happened, it's actually to do with the financial year end. I think there's a little bit of outflow that happens, and in the below 1 year category, if you see, there's been more outflows. Gold is again a segment. Gold ETFs is a segment which has been getting good inflows last month as well as this month. Obviously, to do with the fact that the volatility usually pushes investors towards more safe haven assets. But I think SIP flows is again something which has marginally come down, but this is to do with the shorter month as well of February. I think hybrids again as a segment, if you see, most of the categories the inflows have come down except for the multi-asset category, which I believe multi-asset is becoming increasingly a very interesting category for a lot of new investors also to come into the mutual fund segment.
Right. Suranjana, Harsh also joining in. I wanted to contextualize this for us. Is it a concern at all that the fact that you've seen net inflows shrink and shrink quite sharply, and we're at 9-month odd lows, as you correctly said?
I think, Ash, if you see, I don't see this as a significant concern, because if you see, the inflows have actually come down a little bit in the, small cap, mid cap, as well as thematic. Thematic was getting very disproportionate flows, and sometimes through the NFO routes. So it's not a bad thing to happen, a little bit of tapering down there. I think the categories which are, from a valuation point of view, making a lot of sense, the large cap and the flexi cap categories, they are continuing to get inflows, which I believe is a good thing.
Okay. And what, in your view, in your perspective, do you believe that this 15% correction on the Nifty and the near 20% correction in the mid cap and small caps from the highs, and we've seen a bit of a bounce back, no doubt, but from the highs, do you think it will spook investors largely because you're head of distribution and therefore you may have that visibility? Do you expect it to spook the Indian retail investor? And at what point would you be worried in terms of numbers and metrics? Would you be worried if and kind of how would you assess that?
I think, retail investors in India or investors in general in India have actually matured a little more. So, which is why you see that in spite of quite a correction which has happened in the last month, I think you don't see a very significant drop, especially in the larger categories. But yes, if the SIP flows were to drop very dramatically, that would be concerning, because that is something which is a data which is probably getting tracked globally. And that is something, you want to see long-term commitments from investors, especially, during these times of correction. It is the best time to actually accumulate more. So therefore, staying committed in SIPs during this period is very, very important. And if the customers recognize that, if the investor recognizes that, that actually is a very positive trend from my point of view. And it looks like the correction or the number coming down in SIP is not that dramatic, which I believe is because, it's just to do with the month being shorter.
We also have with us Nikhil Rungta. He's the co-CIO of Equity at LIC Mutual Fund. Nikhil, good afternoon to you as well. Your quick view on what you're making of the data at the AMFI data for the month of February.
See, first of all, thank you for having me here, and good afternoon to you and your viewers. See, what we believe is the numbers actually are much better. It reinforces our thesis that the retail, the SIP flows will continue. I mean, what we have seen is the numbers, the gross inflow is lower, primarily due to lower lump sum, due to weak market conditions during the month, and also due to lesser number of days. But on the SIP side, as everyone can see, at around 26,000 odd crores, we are largely stable. Local investors, both retail and HNIs, continues to hold their ground. It seems that it's more like a cautious optimism amongst them that the worst may be over. So we believe the numbers are actually very good, and it reinforces our thesis that the SIP, the retail numbers, are a structural story in India.
Yeah, fair. So Nikhil, Harsh also joining in. Fair. SIP, I agree that it's been resilient in terms of the number. But when you're looking at total net flows, it's also fallen sharply in that sense. Do you see this as par for course, given the fact that we're seeing markets also correct, and therefore the typical retail investor will get a bit spooked? And what will that signal be, if at all, of some sign of panic?
See, in terms of gross inflow, as you mentioned, that the numbers are lower, that's we believe is because of lower lump sum number. Lump sum, what we believe is, the investors who are knowledgeable, they generally come out with higher, invest higher lump sum during the time of correction. But when we talk about these small retail guys, they generally go with the flow. So when the market is up, say we have 7 days or 10 days of rising market, we'll automatically see these lump sum number also start coming into the picture. And this stability is given by our SIPs, which continues to remain strong. So it's just a market phenomena is what we believe.
Okay, all right. Well, okay, Harsh, you have one more question?
No, believe let's wrap the conversation.
Yes.
So thanks, Nikhil, as well as Suranjana for joining us this afternoon, for giving us all of those perspectives with regard to to flows, especially with regard to what AMFI data has come out today, and give us good perspective as well, right, Agam? Yeah. Because currently it seems domestic money is largely the single piece which is supporting markets. Yeah. Never seen the kind of selling that we've seen with regard to FIs, and despite that, markets have not fallen significantly.
Yeah, well, look,
which is the key
I will take a small positive from here is that our markets have certainly deepened over the course of the last 10 years, and when you would see a significant outflow, a relative one from the FIIs, maybe 10 years ago, we would have seen the correction to be a lot steeper as compared to what we have seen right now. But on that note, we are going to slip into a short break, and on the other side, we continue with all the market action. Be back in just a bit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private capital expenditure, from where I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers, and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your
Welcome back. This is India Market Close, but we are taking stock of the banking index, and perhaps if we can actually take a fundamental view of names like Kotak Mahindra Bank, IndusInd Bank, as well as HDFC Bank. Sudeep, let me come to you on this one. Firstly, of course, after having so much discussion around IndusInd Bank, it seems like we're seeing about a short covering here. But notwithstanding that, HDFC Bank and Kotak Mahindra Bank also showing a little bit of resurgence in today's day of trade. What are you making of the entire private sector pack at this moment?
Well, as far as IndusInd is concerned, my thought is let's wait and watch. The kind of sharp correction we've seen yesterday based on the forex desk losses which were disclosed, I think a bit alarming, and they have engaged an external consultant. So let's wait and watch what the external consultant comes up with. Is the figure of loss net level continues to remain around 1500, or does it go up or come down? Let us see that. There's no point trying to catch a falling knife. Of course, at current price level, which is about 0.7 time book, it's very attractive and definitely much cheaper compared to its peers. Otherwise the bank, I think, is worth looking at. But at this stage, let's wait and watch how things unfold as far as their forex challenges are concerned. Overall banking, we are generally positive, but whether to buy now or whether to wait for things to improve further is a question. Definitely, the way the predictions or inflation are, they are coming down, and food inflation after a long time is going to come down. The announcement is expected sometime later today. But, so once interest rate starts coming down, which they have already, I think banks do benefit. And obviously, it's worthwhile looking at a bank like in HDFC Bank and also State Bank of India, I would add to the list. They definitely do look good. If I have to pick one bank amongst the large cap banks, I think SBI is one I will stick to.
Okay, thanks so much for those views coming in, Sudeep. But onto an NDTV Profit exclusive. My colleague Sajit Mangat caught up with Blackstone CEO and co-founder Stephen Schwarzman, apologies for that, talking about the firm's investment strategy and how India has been a game changer for the global firm. Let's hear him.
The journey in India has been fascinating, actually. When we decided to come here the first time in 2005, we announced that we were going to be having an objective to invest $1 billion in India. And at that time, that was a huge amount of money. And we ended up being on the front page of every newspaper in the country, on television. It was very unusual and unexpected for us. And now, of course, we've grown massively here in India, one of the top 10 business houses in the country. We have aspirations to be much bigger over the next 5 to 10 years. We've learned how to work in India. It's not like everywhere else. And we actually didn't have great success our first few years. And what we realized was that we weren't doing what we used to do. What we do almost everywhere else in the world is when we're buying companies, we buy the whole company. Sometimes the people who sell it to us keep some of it, and then we decide, how can we make this business grow better? Because Blackstone are business builders. We started out buying minority interests, which is what people were doing at that time. And what we found out is that that was a frustrating strategy for us. And it didn't always have a good outcome. And so we changed what we were doing. And we went back to our roots around the world. And we said, okay, India is different in a lot of ways. But controlling and managing a business is pretty much similar around the world. And once we made that change, we've done amazingly well. And our results in India are our best any place in the world. And we've grown to be the largest foreign company in India, the largest owner of real estate in the country, the largest leverage buyout firm, private equity firm, you call them now, in the country. And it's been a remarkable experience. And you don't do that without having amazing people working in India. And what we've learned is that the talent pool here of extraordinary people is very high. So we feel very lucky to have been here. We were here really early. I always thought India would be an interesting place. When I grew up, my father had been in India for World War II. He was in Calcutta and for the U.S. Army. And I had a little jar of carved ivory that he brought home with pictures of elephants on it. So I grew up looking at that every day. And so I always wondered, what it would be like. So I had this very positive feeling about India just from childhood. And it's turned out to be an absolutely wonderful experience for us at Blackstone. And we're going to be bringing more of our business areas.
This is a once-in-a-lifetime conversation with the CEO of Blackstone, Stephen Squashman, telling us about how he has changed his strategy when it comes to, his investments, or rather Blackstone's investments in India. Do catch that entire conversation at 4:30 p.m. today. But we move back to Indian markets and the immediate, and at this point in time, let's also take stock of what's happening with the IT space. Perhaps if I can go to Kush and take his view on some of the more weaker names from the frontline index. Kush, what are you making of the IT names? Anything that stands out that would make for a potential short even at this point in time?
Rather tricky. Let me just start with a quick word on the index. And if you map the rally that had began somewhere in April 23, the index is now at 50% retracement. This would be a good point for the index and the space to perhaps consolidate, if not rebound. Because if that doesn't happen, then you're looking at another about 2,000 odd points start to where the index could actually slip to 34,000, 33,850 to be precise, where 51.8% retracement comes in. Now, as far as the names go, again, we have been speaking time and again that I wasn't very comfortable with the move that the IT index was making, and I did feel that this would continue for some time. Similar is the case even now. However, I would give it one benefit of doubt, or one green shoot that is appearing mildly, if you can call it that, which is that the Nasdaq has actually gone into an oversold territory and could see a rebound, and that could perhaps lift some sentiment back home as well. Basis that maybe some of these shorts that are already in the system could actually be covered at the current juncture. So I wouldn't suggest shorting at the moment, because a stock like TCS had gone into oversold territories and is rebounding from there and once again starting to see fresh shorts. My suggestion, don't go for shorts in the IT pack just yet. Any kind of a rebound, about a 3 to 5% kind of a pullback move, closer to resistance levels, should be taken as an opportunity to sell in some of the IT names. And you could start with the big ones like TCS and Infosys.
And Sudeep, your take on IT, because that's definitely sector of the day. We've taken a couple of views on IT as well. But what's your take at this point? Would you go out and buy meaningfully?
Not really. In fact, I have been liking IT for quite some time, and I believe that the kind of growth momentum in US will help the Indian IT companies in a big way. And to an extent, it was true also. But with the kind of volatility which has come in with the new administration and the kind of the policies they are coming with, probably will lead to a slowdown, if not recession and stagflation in US. And if that does happen, the IT spending definitely will slow down in US. And that this definitely is not good news for IT companies world over, including Indian IT companies. So I'll be a little cautious at this stage. Let things settle down as far as all these tariff tantrums and pretty much everything else. only then I think we should take a call. Look, if the US growth slows down, there is no way Indian IT companies will do well. We have to keep that in mind. And at this stage, we are staring at that. And I would be a little careful as far as IT is concerned. Now, there are sectors and there are companies which will probably still continue to do well. Let's say, the travel and tourism. Now, Coforge caters to travel and tourism. So probably Coforge will still continue to deliver and do well, but not companies focused on BFSI. So you have to pick and choose, but I think it's going to be a little difficult for the next few months at least.
Okay, let's also in conversation cut across to my colleague Tamanna, who is in conversation with Mark Faber, talking about tariffs, US recession, and a lot more.
Okay, so what does that mean? You are saying that if the statistics were true, the United States is already in recession, Germany is already in recession. What does that mean for asset classes? You say in your latest report, the Gloom, Boom and Doom report, that the best is over for the darling of Wall Street, the Teslas, the Nvidias, etc. Is that what we're going to see more of?
In November, I wrote a report, the Trump top. Stock markets peak out amidst a wave of incredible optimism and great expectations and high valuation, high level of speculation, and high retail participation, retail people who have no clue about stocks. And the same has happened in India. In India, there's a huge wave of speculation that persisted last summer and so forth. And now the stock market has imploded much more than the index would suggest. The same happens now in the US. The US is the biggest bubble in history, both the debt market, the bond market, and the stock market compared to the real economy.
Okay, so a lot to unpack there. I'm going to come to the Indian question in just a bit, but you were saying that you talked about the Trump top. What are we seeing right now? Are we seeing the Trump bottom? Are we seeing the worst over? When you hear President Trump talking about tariffs day in and day out, then announce some, walk back on some, what do you think is going to happen?
I love Mr. Trump because he's truly clueless, but he's very convincing in what he says. And he changes his mind every 2-3 days, depending who walked into his office and convinced him of some new wisdom. I like these tariffs. The tariff idea is one of the worst economic interventions you can dream about. I mean, everybody in the whole world knows that it's going to be disastrous if each country introduces tariffs. It will kill the economy. But Mr. Trump is very highly confident that this will work out and it will make America great again. It's a complete joke. But the valuations in America are very high relative to the rest of the world. The US has a market cap of over 50% of the world's stock market cap. So I think the FANG stocks and the Magnificent Seven, they will go down and the money will flow out and go into depressed assets. Some of these depressed assets you can find in Europe, some in the mining sector, and mostly in emerging economies. And I think emerging economies will grossly outperform the US in the next 5 years.
Okay, so that's important because if I talk about emerging economies, and let me pin down on India, the flow has been in the opposite directions. All roads lead to America right now as far as global flows are concerned. You're saying that could reverse? How does the Indian market then look?
All flows lead to NVIDIA and Tesla, the two stocks in America. They're the darling of speculators worldwide, and then a little bit of Bitcoins. And now these flows are reversing. In fact, most retail investors have suffered colossal losses in the last 2 months. I go to bars every day. I can see before this implosion in the last 2 months of these stocks, Nvidia, Tesla, and the cryptocurrencies, in the bars, 50% of the people were day traders who traded day and night in these instruments. And they made $50, $100, and they went drinking into the bars and so forth. And now the bars are empty. These people, these day traders, have all been wiped out. Wiped out. Same in India.
No. So one sec. Let me get to the India story. This is the second time you've alluded to what is happening with retail investors in India. Right now you are live on our market closing show. People watching you are those who are trading, maybe squaring off their positions for the day. What is your word for Indian investors right now in equity?
Sell if the market rebounds and get out. We are faced with a global bear market in assets that, in my opinion, will last for several years. Several years, in real terms, inflation adjusted. Now you print money, maybe it goes up, but it goes up less than the rate of inflation. The problem will be at some point the strength of the currency. The currency will continue to decline, the rupee, especially, and that I want to stress, especially against the price of gold, silver, and platinum.
No, so right now, what is your advice to investors? Are you saying look at metals, look at gold? And if you are saying the Trump trade is reversing, emerging markets are going to be hot, why not India?
Because whereas some emerging markets have been in bear markets for up to 10 years in Asia, you look at China, Hong Kong, even Indonesia, Malaysia, and so forth, these markets have been in bear trends for a long time, and they're now in uptrends. Especially, say, we have to look at the individual sectors. You know, the Western media has 10 years ago, they couldn't write more positive about China and Hong Kong and everything. And now you cannot find an article that is positive about Hong Kong, China. Everything is negative.
Right, so that's Mark Faber, of course, talking about the gloom and doom with regard to global markets and not just India, but clearly hinting that sitting on gold, silver, and platinum will pay off much better returns than in markets. Interesting conversation. Catch the full conversation at 6 p.m. today, only on NDTV Profit. But let me come back to Sudeep. Sudeep, markets in general, what are you doing at this point? Because we're seeing a bit of a rebound. So what's your sense? Have you loaded up? Have you stocked up? Are you waiting? What's your cash to equity component? And what kind of a mix were you sitting on at the start of this correction?
Well, Harsh, my belief is that volatility is here to stay. Because we are in a rebound, bit of a rebound, doesn't mean that we have crossed that hump and there will be a smooth ride upwards now. There will be further volatility. There will be further downsides at some point in time. So it is better to be careful. That's what my first opinion is. The second thing is, if you're a long-term investor in India, my strong view is that you should start looking at stocks which have corrected significantly, and there is growth potential in those stocks. There are multiple sectors, there are multiple large cap companies also, which after correction does look interesting. Now, if you have a time horizon of maybe 1 year plus, there is definitely an opportunity of picking up some of these stocks. Don't pick up at one shot, pick up slowly over a period of time, but do start investing in the market, because over a long period of time, it will give you fantastic returns. The global volatility is here to stay. And I think till the time Trump administration continues, there will be volatility. But domestic factors are improving. The inflation print, which will be coming today, probably will be much benign, which will enable RBI to go and cut rates. The growth momentum in the economy, which had kind of stalled, is going to come back with the injection of liquidity by RBI as well as interest rate reduction. It's not a immediate transmission, but it's over a period of time. I think things will start improving. I'm not talking about Q4 things drastically improving, but maybe Q2, Q3 onwards things will start improving. So the correction in Indian market, which was warranted because of high valuation, that to an extent has happened. Now we have to wait for performances to catch up and things to start improving from here on. So buying good quality stocks slowly is the advice.
Okay, a couple of stocks really moving in trade, and Kush, I want your view on this one, and it's a bit of a controversial one, BSE.
No controversy for me there. The stock actually moved quite a bit, and hence you're seeing profit booking a sharp one at that, I might add. And of course, the recent bit of news not helping. But if you are still a believer in the India story and the capital market story and the financialization, all of that, I think there's a good chance that this tip might turn out to be a good buying opportunity. Incidentally, the retracement on this one that you're seeing from the up move that started mid-July, the low that it made yesterday is exactly at the 61.8% retracement. So you've got those supports also acting up. The stock trying to regain the 200-day moving average. For me, this dip is a buying opportunity. The recovery might not be V-shaped, but at least the kind of levels that you're seeing today give you a good entry point.
Okay, well, with that, we have a very interesting analyst meet around Tata Motors, in which we've had a lot more updates with respect to JLR as well as the domestic business. And for that, Puneet is now joining us to give us more details. Puneet.
Well, thanks for that. So we've just collated some of the key aspects from multiple brokerage reports in terms of what was said in the analyst meet. And the biggest takeaway is that the company has mentioned that the JLR guidance of 8.5% EBIT margins for FY25 stands. Now, what that means is that in Q4, the company will be required to do EBIT margins specifically of 10% in the JLR business specifically, and that's something that the company hasn't done over the last few quarters. So it's going to be a big challenge. But because the company has said that almost at the end of the quarter that the guidance stands, that's why we're seeing the positive momentum on Tata Motors. Do note, JLR forms roughly 70% of the company's revenues. So it's a big valuation as well as growth driver, and hence the positive outlook. Apart from that, they've also mentioned that the JLR will be net cash positive. That will effectively mean they'll pay off the debt of the JLR business, and effectively both entities, the India entity as well as JLR, will become net debt free at the end of FY25. They've also mentioned that the multiple levels of profitability growth of JLR will continue going into FY27. It's moved from 8% EBITDA margins to 15% over the last 6 years, and the journey continues. With regard to tariffs, as well as what's happening in the US, the company mentioned while China outlook remains subdued as of now, Land Rover's performance is outperforming the industry currently, especially in the USA. They've seen some reduction in terms of roughly about 30% in JLR outlets in China, and that's been an ongoing process over the last couple of years. But specifically in the US, they are seeing bigger models such as Range Rover drive the growth. Finally, just a couple of comments on the India business. The passenger vehicle space is expected to do better in FY26, and growth should be driven by repositioning of the Curve brand, and that's something which a model that's not done very well for Tata Motors, as well as repositioning of the Altroz brand with new models as well as colorways. They mentioned that focus will be on enhancing capacity as well as service networks, and the CV business specifically remains one of the pillar stones going into FY26. MHCV seeing a recovery. IFL says that Tata Motors has done a good job to stem any kind of market share loss in a tough environment, and with that, ICICI has mentioned that they've upgraded the stock to a buy from an ad rating earlier, target price of 831. Kotak has retained its ad rating at 750 rupees per share. It's lower from 800, but maintaining JLR momentum. And Nuvama, while mentioning that valuations is in favor, they are expecting more positive triggers for the PV business first to upgrade the stock. So overall, it's a positive momentum for JLR as well as Tata Motors going into FY26, and stock prices is reflecting whatever was discussed across the verticals.
Okay, Puneet, thank you so much for getting us all those updates. Kush, I'll come back to you on this one. Last week, Tata Motors did make a little bit of a low. Since then, it has recovered. What are you making of this bounce? Is this a dead cat one? Or, well, do you think that there could be some legs to this up move that we've seen in Tata Motors?
So Agam, before that, just a quick update is that 600 is a very interesting level for Tata Motors. The reason being that the last time around, or rather, in 2015 when it was at the 600 level, it took the stock about 8 years to come back to that level. Now, the reason 600 is interesting is because the low that it made in the last couple of days is also close to that mark. So as we can see that the stock is very close to the long-term support zone. Now, while there has been some positive, moves in the last couple of days, the volumes have also been rather interesting. This stock has a tendency to perhaps consolidate for a very long time. So, if you do have that kind of a view, 12 months, 18 months, or longer, it's perhaps when you should start considering Tata Motors. At the moment, this bounce could well prove to be a dead cat bounce. The resistance comes in at 685 kind of levels. So, if once that is taken out, perhaps you could see near-term rebound. But I think from a long-term perspective, and as I said, 12, 18 months or more, that's the kind of view if you have. That is when you should start considering, picking up Tata Motors, not from a near-term momentum trade.
8 years is certainly a very, very long time to wait on a stock, only to give you zero returns. And point taken there, Kush, certainly. But now that we are with you, if you have any buy today, sell tomorrow ideas or STBT calls for now.
I do, given the strength in the market, it's a BTST idea, and that's on the Indigo stock that has been doing rather well for itself. Some profit booking along the way, which is actually a very healthy sign. But on the days when the stocks move higher, the volumes have picked up, the delivery volumes have been higher, so that strength, fairly evident. From a near-term perspective, you're looking at targets of 4,800 and 4,900, stop loss close to the 4,600 mark.
Okay. Sudeep, if I can quickly come to you with regard to a Tata Motors and a Bharat Forge. Both of these stocks buzzing. Tata Motors on the back of good commentary, we spoke about that, but Bharat Forge on the back of a JP Morgan note. Talking about FY26 could be a soft year for growth. EU business viability is being evaluated. The PV business should witness growth in FY26. And defense, there should be new order wins coming through very, very soon. All of those positive on Bharat Forge. So quickly, your views with regard to a Tata Motors and a Bharat Forge.
As far as Tata Motors is concerned, I'm little, at this stage, I'm a little careful. I think there is enough and more volatility around the corner with all these tariff issues troubling all of us. And, they have large business in China, large business in, Europe. So I'll have to wait and watch and see where things stand once all these, issues have been stabilized. So I'll be a little careful on Tata Motors. If I have to play the entire automobile space, I'll probably go to auto ancillaries and try and pick shares there. They also will have these, tariff-related challenges, but they can navigate and manage things better. As far as Bharat Forge is concerned, I'm equally positive on the defense business picking up. At this stage, defense business is relatively small, but the potential for this business to pick up is significant. Their other businesses are doing reasonably well. There may be some challenges as far as US business is concerned going forward, but defense business definitely should start doing very well in a couple of years' time. So if somebody is taking a long-term view, Bharat Forge definitely can be considered for buying in small quantities.
Interesting one, Bharat Forge. Now quickly on to what to watch, because plenty happening even on the macro front between today and tomorrow. You'll have India as well as US CPI data coming through. India IIP numbers also expected. US crude oil inventory, US monthly budget statement, and OPEC monthly report are just some of the other things to keep in mind. You'll have a couple of dividends which will come through, and as a result, some of those may also get adjusted in terms of stock price on the back of that. You have the extraordinary general meeting for Hindustan Construction Co. as well as Imagica also to look out for. Certain announcements may come out on the back of that as well. So all of those to keep on our radar. But while we're talking, I want to quickly also take Kush's view with regard to Balrampur. Stock is buzzing. Your quick view with regard to this one, 7% higher.
Good move, but this is after a bit of a fall that the stock has seen. I wouldn't go out and buy it just yet. For me, this is an exit opportunity if you hold Balrampur Chini. So no fresh positions recommended. If you have any, not a bad idea to book profit and exit.
I want a fundamental view on BSE from Sudeep as well. Sudeep, what are you making of this stock now that the dust has settled? Do you think this is an opportunity to buy into it, or do you want to wait?
If you're an aggressive investor, want to take an aggressive position, it is definitely worth buying. There are a few triggers coming, which NSE listing is around the corner. Once NSE listing happens around that time, there'll be tremendous buzz around this exchange stocks. So the things will pick up. Once NSE lists, obviously it will list on BSE. So the significant trading volume is expected. So BSE will gain from that. There is this excitement going around, weekly settlements and things like that, different dates, and there is a lot of volume being garnered by BSE through a different settlement date at this stage. So things are volatile, but things are looking up for BSE. Correction has been very sharp and brutal. So yes, if you're an aggressive investor, buy and take it forward.
Well, thanks so much for that, Sudeep, Kush, for all of those views. If you're an aggressive investor, buy BSE. That's really the conclusion from Sudeep. Thank you so much for joining us this afternoon. Quickly on to where we are, where the Nifty is concerned, where are we closing in at? No complaints, frankly, from the way we started, Agam.
Yeah.
We've closed just about 0.1% lower. I mean, it's the second time in 3 days that we've closed lower, yes, but yesterday, after a positive day, this doesn't look as bad.
Yeah.
Just about 30 points lower. And essentially, it's the heavyweights carrying the index ahead. Let's look at the advanced decline on the Nifty by looking at the heat map, maybe. There you go. Some big movers, 1.6% higher on an HDFC, 2.2 on a Kotak. And why I highlight those is because they are heavyweights in their own right on the Nifty. And therefore, a couple of those big movers, let's look at the contributors on the Nifty as well. We'll likely see exactly that. While Infi was the big loser and IT was the big drag, TCS, Infi, both of them, but more than enough steam with regard to where financials are concerned, HDFC, Kotak, and maybe a little bit of Reliance aiding the index. And therefore, we've closed not as badly as one would typically suppose on a day when the Nifty IT is down 3%, Agam.
Certainly. But let's also take a look at the broader market advanced decline ratio, and that's not very encouraging. Perhaps on expected lines, because we really haven't seen too much traction. So we've not seen a big change. For the NSE overall, one gainer for two losers right now. In terms of your broader market indices, that is the mid-cap and the small-cap indices, they are under pressure. Mid-cap index is down around 0.6%. The small-cap index is also down around 0.3%. The losses are not considerable, they're not substantial, but well, losses are the same. Let's also take a look at the BSE 500 gainers and losers here. And while we do have gains for something like a Balrampur Chini, NLC India, Godfrey Phillips and Crompton also looking at an up move along with Adani Green. We also have some weakness in FSL. Of course, it's from the IT space. Actually, Glasscoat has moved higher in terms of the losers in the list, and Century Textile and PB Fintech is the other one that we've been talking about through the course of the day. All in all, perhaps as far as the benchmarks are concerned, consolidation continues. It's what a lot of these technical analysts have been talking about, and we just have to wait for more cues before we actually start seeing a discernible trend. But on that note, it's a wrap on this edition of India Markets Close. This is a big thanks from Harsh, me, and the entire team who put this show forward. Thank you for watching, and we'll be back in just a bit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very, very warm welcome to you all for this NDTV Profit conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on.
Welcome, you're watching Market Express and I'm your host Himakshi Bahuguna. Now let's get straight into the show. US benchmarks end the session flat with a negative bias. The Nifty ends below the 22,500 mark, whereas the Sensex ends above the 74,000 mark. Broader markets underperformed. Sectoral action mixed on the Lal Street. Huge losses coming in IT. Index falls into bear market territory, enforces Wipro drag. Media, PSU banks and realty follow. Nifty auto, pharma and private banks emerge as winners. Rupee ends flat after opening week against the US dollar. The weakness comes amid volatile sentiment due to uncertainties over trade tariff. IndusInd Bank share price erases losses to inch higher. The stock has been under pressure following a series of news impacting the investor confidence. Financial year 2024 annual report of IndusInd Bank on NSE suggests that the chief executive officer sold 80% of holding near the peak. Sumant Katpalia held up to 35,000 shares at the start of financial year 2024. About 1.98 lakh shares were vested as ESOPs. Further, 1,85,991 shares were sold at an average price of 1,524 rupees per share. Katpalia currently holds up to 48,000 shares. Executive Director Arun Khurana also sold 2.14 lakh shares at 1,499 rupees per share and currently holds up to 40,000 shares. The Department of Financial Services steps in to take stock of the issues dominating the news around IndusInd Bank. Sources tell NDTV Profit that Financial Services Department recognizes issues including accounting discrepancies, governance challenges and leadership concerns at the lender. The Department of Financial Services is in talks with RBI ensuring thorough examination. With this, the government wants to maintain stability and integrity within the financial sector. Meanwhile, the IndusInd fiasco serves as a wake-up call for the Reserve Bank. As per sources, the RBI supervisory departments are talking to banks on foreign currency positions. The supervisors seek specific compliance reports on current positions. Central bank supervisors also seek clarity on bank mark-to-market positions on foreign currency borrowings. After an intense tussle over how airwaves should be assigned for satellite internet, Reliance Jio finally signs deal to bring SpaceX Starlink internet to India. The announcement follows Bharti Airtel announcing a deal yesterday. A part of the partnership, Jio and SpaceX will offer broadband services across India, including the most rural and remote regions. This includes plans to offer Starlink equipment via its retail stores. The Starlink solutions will also be available through its online storefronts. Airtel's Sunil Mittal welcomes the collaboration between telecom and satellite companies, calling it a major step towards global connectivity. Hailing the partnership, Mittal referred to his speech at the recently concluded Mobile World Congress 2025 in Barcelona. At the event, he urged telecom and satellite companies to work together to ensure universal coverage. The recent market correction might have made investors jittery. Motilal Oswal says the sharp correction offers opportunities. Also says that certain factors that Indian equities may be in the latter stages of correction. Minimal foreign outflow impact is getting smaller. The brokerage firm expects double-digit earnings growth in FY26. Morgan Stanley highlights some headwinds for the IT sector. In the rapidly evolving space of information and technology, the shifting macro environment contribute to the flurry. Morgan Stanley sees downside risk coming for both the revenue growth of India, IT services and valuation. According to the brokerage, some stocks multiples could become more polarized. With a lower GDP growth in the US, IT sector is in the front line of impact. Gulam Zia of Knight Frank India weighs in on the recent realty downturn. The realty expert says that the premium segment of housing is picking up. He highlights the problems in mid and lower end segments. Zia says that the money from the market bull run has gone to investments in premium segment. He believes that the loss in equity markets will affect developers and also expects the housing prices to remain stable in the future. Now, viewers, it's time for a quick break on Market Express. Stay tuned to NDTV Profit. We will be back with all the action.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Reviksit Bharat.
headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every unloam, you have to have vilom. You can't just keep doing up and up in the breading also. You have to come down. So the correction and healthy correction is a very integral part of the market.
The private
Hello viewers, today we are joined by Mr. Sharan Hegde, the founder and CEO of 1% Club in an exclusive conversation. So welcome to NDTV Profit, Sharan.
Thank you so much for having me.
So as you know that markets currently are bleeding, we are going through a bear run and we are also surrounded by a plethora of retail investors who are going through this for the first time. Now they are young investors and they are from a generation who have never seen a market correction that has continued for this long. So what would be your advice to them?
All right. Firstly, I would like to say that we are not yet in a bear run, right? I think we're far from reaching that point. Just to give you some context, in the 80s, the US market went through almost 7 to 8 years of bear run, where the markets didn't really move at all for like almost a decade, right? For us, it's just been a couple of months. So I think, firstly, we need to calm down, right? It's not like the end of the world, like what people are saying. And secondly, you're right. Most of the people in India, or at least on social media, most of them have invested just in the last 1 or 2 years. I personally have been investing for the last 10 years. So when people are saying markets are bleeding, their portfolio is red, but for somebody who has been investing for almost a decade, their portfolios are still green, right? So the moral of the story is if you've been a long-term investor, then this sort of a market correction is not really looking bad on your portfolio. But if you're somebody who's just been investing 1 or 2 years, then yes, you're seeing your portfolio in the red. And this is exactly where investor behavior comes into the picture. Some of the greatest investors in the world said that, investing is much more about your psychology than about the numbers. So at this important juncture, what people do with their money is really important because you're not just using logic to make a decision. There's a lot of emotional triggers which is, affecting your decision-making process. And what I personally follow is a proper diversification across asset classes. Although equity is my favorite asset class, almost 50% of my money is in the Indian markets and another 15-20% is in the US market. I'm well diversified across gold, crypto, real estate, bonds, private investments. So I have a portfolio which is well diversified. So even if half of my portfolio is not doing that well this year, I know that my other asset classes are really performing well. So only when you have that diversified approach, you have that peace of mind. But if you are sort of somebody who is after that quick money-making strategy where you're like, okay, I saw that the Indian market is performing well, so I'll put all my money in the Indian markets, then you might be in trouble right now.
Now, coming on to something more specific, 1% Club. You recently received a SEBI registration as well, and that was a big day for you.
Yeah.
So now this happened during a time when the regulator was curbing a lot of illicit advice that is, circulating on social media handles.
Right.
So how do you feel that your operations have changed in tune with such, curbs or such an environment after getting the registration?
I would say the license was just a matter of formality. We've not really changed anything at all from day one. For us, getting the license was more from a business objective, that until that point of time, we were not able to really give financial advice on a one-on-one consultation basis, which is what people really want. There's only so much of education that you can do on social media. But when it comes to implementing the strategies, that's where people go wrong. Like we're talking about the current market situation. A lot of people had invested in the market over the last 6 months, 12 months. But right now, when the market is not doing well, people really need that hand-holding support, which they don't have access to. Like when you fall sick, you can go to a doctor at a hospital. But when you don't know what's happening with your portfolio, who do you go to? You're nobody, right? So we sort of wanted to build a company which sort of creates financial doctors for the country. So that is why we took the license, so that we can provide that kind of a service. But nothing has really changed in the way we operate our business or the way we, communicate to our audience. It was just a matter of formality, and SEBI was kind enough to give it to us. They trust in what we are doing,